Good morning. It is 9 a.m. on Tuesday, February 1st. This is Yahoo Finance Live. I'm Julie Hyman alongside Brian Sazzi. Got a little teaser look at the futures there, so let's do it. Let's look at them. The Nasdaq yesterday narrowly avoiding having its worst January on record. It actually finished higher by 3.4% yesterday, bringing the decline for January to only 9%. Still pretty lousy, but we are seeing a little bit of strength in the futures here this morning. They have been bouncing around, by the way. They've actually turned around from some earlier declines. Part of the reason why, perhaps, delivering big margins. UPS beats estimates on prioritizing price increases over volume gains. Look at those shares, up 9.5%. Don't miss our exclusive interview with CEO Carol Tomé. That's coming in the next hour. Drilling more oil. Exxon Mobil is going to increase spending on new oil wells and other projects by as much as 45%. That's what it announced this morning, along with its earnings. Those shares are up by about 0.5%. And slashing the dividend as AT&T makes its Warner Media spinoff official. It cuts its payout to investors, and it's paying the price in terms of share performance. They are down by 5%. But we start this morning with the latest thinking on the Federal Reserve and the interplay with markets. Because as you know, Brian Sazzi, we've seen a lot of banks increasing their estimates for how many times the central bank is going to raise interest rates this year. And also, there's a lot of discussion about by how much they're going to increase rates at each meeting, especially the first meeting. That was part of the subject of Brian Chung's interview yesterday with Federal Reserve Bank of Atlanta President Raphael Bostic. And Brian is with us now. So there is a lot of gaming out going on right now. And Bostic contributed to that discourse, I guess, Brian.
Yeah, certainly. And a lot of conversation right now about, as we get to that next meeting in mid-March from the Fed, whether or not they'll move by more than 25 basis points. And keep in mind that the possibility of a double rate increase, if you will, or a 50 basis point hike hasn't happened since 2000. So I had the chance to ask the Atlanta Fed president if he sees that as a policy option on the table that he would prefer. Take a listen to what he told us yesterday.
That's not my preferred setting of policy action for the next meeting. Really, when I started looking at this year, I had three moves, 3 rate increases in mind, and March increasingly was looking like it's the right time to do that. But the other thing that I've been very mindful of is that the economy has been a surprise to us and a surprise to the upside repeatedly in ways that has left me really just observing how the world works and keeping my options open so I can adapt my policy.
Out of the Fed funds futures contracts markets and the pricing in of the possibility of the 50 basis point rate hike before that interview was somewhere close to around 15% chance. And now that decreased to about a 10% chance as of this morning. Again, there are a number of other Fed speakers throughout the week that we're expected to hear from. But consider that the commentary that we heard from the Atlanta Fed president, who said that he was expecting 325 basis point increases throughout the course of 2022, is a bit below what the Wall Street is expecting in terms of projections for how many rate hikes over the course of this year. When you take a look, for example, at Bank of America, we had Ethan Harris on yesterday talking about their call for 7 rate hikes over the course of this year. That would imply 125 basis point hike in each of the remaining meetings through the rest of the year. Of course, it seems like the consensus baseline is somewhere closer to 5 rate hikes. That is indeed also the highest probability from the Fed funds futures contracts, and the likes of JP Morgan Chase, Goldman Sachs, Wells Fargo also calling for 5 rate hikes. Again, we'll see if that is above or below where we actually end up getting Fed policy, because as we know, guys, there's a lot of economic data that needs to be coming out before the Fed makes those decisions, and a lot can happen over the course of another 11 months, guys.
Well, and as one of the charts in Ethan Harris's own note illustrated, markets tend to be too hawkish when it comes to the number of rate increases they predict. Thanks so much, Brian. Appreciate it. Well, let's talk to somebody else about rate increases and the effect on the markets. That is Liz Young, SoFi's head of investment strategy. Liz, it's great to see you. So where are you at in terms of the number of hikes you're looking for? And I guess more importantly, for your purposes, the effect on the markets.
Well, I think that there are some voices out there that have gotten a little bit too hawkish. I'm not going to try to call an exact number, because I think what's actually going to happen is that the Fed's going to move a couple times and then wait and see how it affects the markets where the inflation readings are. And I think that some of the 5 to 7 hikes this year sound like a little bit too much. And here's why. So when you look at the 10-year Treasury, this is the thing that's really important to pay attention to. As the Fed funds rate approaches the yield on the 10-year Treasury, the market gets nervous. And you never want the Fed funds rate to go above the yield on the 10-year Treasury. And I've been saying for a little while, the Fed doesn't care about our feelings anymore. And what I mean by that is, I don't think it's going to protect us from some market volatility. Obviously, we've already seen that in January. But what the Fed does care about is the yield curve. And as it starts to hike rates, if that spread between the 2-year and the 10-year gets too narrow, or we start to approach an inversion, they're probably going to back off. So I think 5 hikes might even be a little much. 7 hikes, in my opinion, is definitely a little much.
Well, Liz, do you think the market will force the Federal Reserve to just care a little bit more about its desire just to produce strong profits and strong gains? By that, do you see one more downturn in markets just to remind the Fed that perhaps they may want to go slower than they like?
Well, I think the first priority for the Fed right now is controlling inflation. And we might see a perfect world where inflation starts to cool off at the same time as they start to hike rates. And then you've got the volatility in January behind us, which even seasonally, that's a good thing. So hopefully the volatility calms down slightly as we move into spring. And if that's coupled with inflation cooling off, they won't really have to do much. And it's not going to be necessarily a dovish pivot to say, okay, we don't need to be as aggressive as the market thinks we need to be. Now, I think what's important too to remember is that what they're trying to do is get the economy to a place that you can think of as cruise control, right? We keep calling it the terminal rate. We used to call it the neutral rate. But basically what they want to do is get the economy to a place where it can hum along at a comfortable level of growth and where inflation isn't something that's hindering that growth. And that's really the concern right now on their minds, that if we let inflation do what it's been doing, it would start to hinder growth too. So it's not just because we're raising rates, there shouldn't be all of this growth fear. Inflation usually means that there's healthy demand in an economy. And when you've got an economy that's 70% driven by consumption, healthy demand is really important. So I think that they're doing this at the right time. It's just left to be seen how quickly the market will let them do it and how palatable that's going to be to certain sectors.
Right, and that point that you're making on growth is an important one, and it's why usually during tightening cycles, stocks still go up because there is still that growth. I want to pick up on another point that you mentioned in a recent note, which is that earlier this year and kind of late last year, markets didn't make sense or didn't make as much sense. You can always find a little pockets of irrationality in the market. What do you make sense right now? What is sort of working as it should in the market? What relationships have reasserted themselves?
Yeah, so the point that I was making in the note was that last year, for bigger parts of the year, it didn't make sense. So you'd see these rallies in some of the high growth areas, some of the high beta tech areas, when yields were rising, and that did not make sense. So I always try to watch the patterns in the market, and you want the patterns to make sense both in the bond market and the stock market. And if something doesn't quite connect, that usually tells me that there's a dislocation, it needs to eventually correct itself. So what's happening already in 2022 is that although we've had a drawdown and we've had a move back in all the major indices, the pattern of what's happening in each sector and even each industry group makes sense. So you're seeing semiconductors get hit the hardest. And then you see things like banks do pretty well, energy do pretty well. Those are the cyclical areas of the market that either are benefiting from rising rates or are benefiting from economic expansion and a reopening. And then things that are getting hit are the more growthy areas as rates rise. And also remember, the 10-year Treasury yield rose 30 basis points very quickly to start this year. So you want to see sectors respond in a normal fashion. What that also means to me is that we had this shakeout, call it whatever you want, a re-rating, a shakeout in January, and it brought us a little bit closer to reality. The S&P was trading at 22 times forward earnings before. Now we're closer to 19 times. We're still above the long-term averages. Long-term average is about 16. The 5-year average is about 18. So even at 19 times, we're still trading above, which also tells me there could be more volatility to come as we approach that first hike. And remember, the Fed hasn't even moved yet. We're just doing this all on speculation.
Liz, based on what we've seen at our earnings season, do you think corporate America is justifying those valuations you just mentioned?
I think corporate America is strong right now, but when we talk about corporate America, we're generally talking about earnings. And earnings season that we're in right now is still the fourth quarter of 2021, expected to be 20% or more growth. That would be the fourth quarter in a row of more than 20% earnings growth. And that's amazing. That's great. Here's the issue. We're now used to that. We're used to hearing 20% growth, 30% growth. As we start earnings in 2022, so when we start to get Q1 2022 earnings, it's going to be much less exciting than that. Full year 2022 earnings are expected to be about 10%. Now we know those are usually underestimated, so we might come in above 10%, maybe closer to 12 to 15%, but that's still less than what we saw in 2021. So what's going to be really important for investors to look at is to parse through each sector and each industry group and choose the best of breed in those areas, choose the companies that have pricing power. And when we say that, we mean the companies that can pass through some of these inflationary pressures and their demand won't suffer. And you want the companies that have a good cash flow position, because as borrowing money gets more expensive with rate rises, you want companies that can finance their own expansions.
Good criteria to look for in this market. Liz, thank you so much. Liz Young is head of investment strategy at SoFi. Good to see you. I want to tell you about one more headline we're watching this morning. It has to do with Pfizer, although not affecting the shares, but it's really good news for people with young children. Pfizer, according to reporting from the Washington Post and others, is expected to seek authorization from the Food and Drug Administration as soon as today to authorize its COVID-19 vaccine for children 6 months up to 5 years. And again, that's according to various reports here. That has been something that parents have been waiting for. And the timing of this is going to depend on whether the FDA is being asked to grant the emergency use authorization for 2 doses of its vaccine or 3 doses of a vaccine. So we will keep an eye on this. But either way, it could either be granted in late February or until March, depending on the number of doses. All right, we're going to take a quick break. When we come back, we're going to be talking about Exxon Mobil numbers out this morning as the company increases spending on new drilling.
Exxon is out with better than expected quarterly profits. The oil major also outlined a new $10 billion stock repurchase program. Joining us now is Wells Fargo Securities Senior Analyst Roger Reed, who covers the oil space. Roger, nice to see you here this morning. You mentioned to us in break, and you were right, that this time last year, many folks were wondering if Exxon would be cutting its dividend. Now they're outlining cost cuts and a new stock buyback plan. What is the state of Exxon here going into the new year?
Yeah, Brian, you think about the change, a year makes a year and a half. But I think the key issue for Exxon at this point is if you look at some of the things they highlighted, where cash flow came in for the quarter and where they expect to take the break even. So break even in the low 40s right now, goal to get to the mid 30s in terms of oil price when we mentioned break even. And if you went back to 2020, that was around $51. So you had a company that's done a dramatic or enabled a dramatic reduction in cost and in their overall cost structure. At the same time, you've had oil prices go up quite a bit. And so you put those two things together, you get a much, much better situation here in terms of earnings and cash flow.
And Roger, it's Julie here. They're putting a lot of that cash flow to use by spending. They are increasing their spending now, right? As much as 45% this year for drilling on new wells. And there's an irony here too, right? Because the company is talking about going carbon neutral by 2050. Here they are drilling new wells. Is this the right strategy for them to be taking? Is that a good use of their cash?
Well, I think it's always tough when we talk out to 2050. As to exactly how things will unfold. But if you look at part of Exxon's, what they would call, net zero situation, it comes down to several things, right? You'll move into more renewable fuels on one part. They intend to be and have been and intend to remain, I guess I should say, a leader in carbon capture and storage technology. So you go back and look at this most recent offshore lease sale, and I know, the big talk was how it has been pushed away. But the real story there was Exxon took leases in shallow water blocks off the upper Texas coast, and the idea is using those for storage. So I think net zero will take a lot of different forms. Back to the question of their CapEx. Oil prices are $90. We're hearing all kinds of talk about, shortage of supply growth. And so some of the increase in spending is necessary, right? And some of the spending increase is a function of getting back to what is normal. If you were to look at Exxon spending pre-COVID, 30 to 35 billion, they fell to 15 billion. So they're talking about a range in the low 20s, kind of splitting the difference here, really.
Roger, it seems as though there's a better tone, more of a halo around this report from Exxon compared to what we heard from Chevron last week. Which stock is the better stock to own here?
Well, a year ago, we went positive on Exxon. We were neutral on Chevron. We thought that a lot of what you've seen Exxon do here would come through, right? Companies get in trouble, companies change tactics a little bit, they change strategy, and you've seen the positive outcome for Exxon with that. In September, we actually upgraded Chevron to overweight as well. So for us, I would say, we feel pretty positive on both. Exxon's tremendous improvement from where they were and the fears that were out there on the stock, made it a little bit better of a performer over the last, sort of 12 months or so. But both companies are doing what you want them to do, which is be careful with investments, generate better returns, get costs out of the system. Exxon a little more, internally focused. Chevron was able to do some acquisitions, and both have been able to take advantage of a improving market in terms of asset sales, which has also helped out.
Hey, I just quickly wanted to ask you about the reorg also, right? The company announcing yesterday, timing a little bit interesting or I shouldn't say it announced it. It leaked yesterday, seemingly, that they were going to be consolidating their offices, moving away from suburban Dallas, consolidating into Houston. Does this feel like the right move? It seems like Exxon now, compared with the Exxon of a couple years ago, is just a more disciplined company, and maybe that's another example. Is that your read?
You know, from the outside, I wouldn't say the company was undisciplined before, but I will say that management is a lot more forthcoming with what they're attempting to do, both in the near term, medium, and the long term than what we've seen historically. And I think that, reflects Darren Wood's, efforts as CEO. And I think it also reflects, some of the things that have happened on the ESG front, right? That you have to address some of these issues with more clarity, with more specifics than before. The move to Houston, I mean, they built a campus on the north side of Houston that opened, I don't remember, 2017, 2018 timeframe. And there's been a little bit of a thought process. Wouldn't they move from Dallas to Houston given that new facility? So I'm not terribly surprised they're doing this shift. I'm sure between Houston and Dallas, there'll be some nice rivalry over, who's the winner out of this. But that's about all I'd really add on that front.
Yeah, although when it comes to the oil business, I think Houston's already probably the winner in that department in terms of the amount of industry it has there. Roger, before we let you go, because I know you want to hop off and get on the conference call, I think this might be the first work from home setting we have had with a turkey. Is that a turkey?
That is a turkey. He met an unfortunate end a couple of years ago.
Well, it makes it for a very unique work from home shot. So you have that going. He at least can be remembered in posterity for that. Roger Reed, thanks so much for being with us. Had to ask you. I had to do it. All right. Have a good time on that call. Senior equity research analyst at Wells Fargo Securities covering energy for us. And Saz, we're going to talk about UPS coming up in just a bit.
Yeah, sure. Hard to follow that one, but yeah, big quarter out of UPS. Stock is soaring. We'll be right back.
Among the earnings today, we are watching UPS. Those shares higher by 10% this morning. As you can see, the company's earnings and sales beat estimates. That sales increase, by the way, was 12%. And effectively what we've got going on at UPS is that it's raising prices. At least that's part of what is going on. The company raised, I believe, prices by 11%. Average revenue per piece shipped, I should say, rose by more than 11%, even though average daily shipping volume was down about 0.6% during the holiday season. The biggest part of that decline happening outside of the United States. But all of this means that margins came in ahead of what analysts had been estimating. And that is the strategy that UPS CEO Carol Tomé has really focused on during her tenure, Saz.
Julie, today that is not UPS. That is UPS, as in sales are up, earnings are up. And I tweeted out this morning. I've not seen a quarter like this before from UPS, a storied company, industrial giant, pretty much everywhere around the globe. So they came out here really operating margins up in every business segment they do. Also, their outlook for this year, they said they're going to reach some targets that they laid out for 2023. 1 year ahead of schedule. UPS looking for about $102 billion in sales this year. Operating profit margins 13.7%. They weren't supposed to achieve these things until 2023. They are saying today they are a 1 year ahead of schedule. And look, Julie, some of the drivers here, obviously a massive ongoing shift to online shopping. They're able to push through a lot of price increases in this environment. Also, too, they just in the quarter, Carol Tomé said on the earnings call this morning, they shipped their 1 billionth COVID-19 vaccine. So this company is a major player, even more so than they were, at least in this economy.
Well, we've got an exclusive interview with CEO Carol Tomé next hour, and there is so much to talk to her about, including pricing and the margins and the performance that we've been talking about, and the on-time performance of the company during the fourth quarter and the holiday season is worth mentioning as well. Workforce issues, there's a lot to cover. So make sure you don't miss that interview, again, coming up in the next hour. Some other things we got to talk about this morning, though, in terms of movers. AT&T is one of them. That company now confirming how it's going to spin off Warner Media. It will be structured as a spin-off transaction, so confirmation of that. And each current shareholder is going to get about a quarter share, 0.24 shares to be exact, of the new company for each share of AT&T stock that they hold. The stock is down because the dividend cut. The dividend payout ratio going to be about 40% of cash flow, which is about $1.11 a share. Now that compares with $2.08 a share before this deal. So it was expected, Saz, that there would be a dividend cut, but still, it's not necessarily welcome news for investors.
Oh, wait a second, Jill. I just got to wake up. I fell asleep thinking about the future of AT&T without a high-growth business like Warner Media. That deal is expected to fall asleep. It's expected to close that deal in the second quarter. But really, and I think back to, look, we just had the MoffettNathanson folks on last week to talk about AT&T, and they brought up a good point. Where's the desire to own a stock like this, Julie, that of a company that is barely growing because it is playing in more now after it spins off these assets in the competitive phone business, and they're a low, slow grower, and now you have to wonder when might they hike that dividend back up again. It's unclear, but here's a company that looks to be in debt reduction mode here, and that's not necessarily a great thing for investors.
Yeah, I mean, people always held this kind of company. You know, phone companies traditionally weren't big growers, right? Until they started getting into other types of businesses. You held them for the cash flow, you held them for the dividend, and $1.11 ain't nothing, right? I mean, it's still higher than other types of companies out there.
There's more catalysts elsewhere. T-Mobile cutting hundreds of $millions in costs out of their business. Profits are responding. Verizon, big quarter last week, integrating that TracFone acquisition. At least they have catalysts. AT&T, I'm still trying to figure it out.
Well, I guess investors are too, and that's why the stock is down today. All right, we are going to take the opening bell in just a minute here. Ahead of that, we're seeing futures indicate a higher open coming off of a dismal January, but a couple of very strong days for the Nasdaq that meant that it rescued itself from a worst January ever, had only in the top 10. And electric vehicles back ringing the opening bell this morning there at the New York Stock Exchange as we're looking at a higher open. Seeing a little bit of optimism creep in here as we start February this morning. Our Jared Blickery just pointing out to us we have a record high for UPS here this morning on some of the elements we were just talking about. And we've got that higher open. Before we get to Jared, just want to mention one more stock that we are watching this morning. It's AMC. Brian Sozzi, one of your favorites. Do you have worse things to say about AT&T or AMC? I think AMC no contest probably, but the company coming out with preliminary numbers this morning, $1.17 billion in revenue. Again, that's preliminary revenue figure, and adjusted EBITDA. It's providing still pretty big ranges for some of this stuff. So EBITDA is going to be $146.8 million to $151.8 million, but it looks like that some of this guidance is enough for the stock to be trading higher this morning.
Yeah, and it's still reporting a net loss here for the 3 months ended December 31st. I know they really want to focus on these adjusted operating profits numbers, but I don't really care this morning. They still report a net loss. It's challenging. The movie theater business is still very, very challenging. You had AMC CEO Adam Aron. He's been dumping a ton of stock here, and I understand the market's reaction to this, but still a lot of red flags left in this business.
Yeah, I guess so. So we'll see if it can hold on to some of these early gains that we're seeing in the stock, or if we return to the volatility that we've been seeing for the meme stocks. Jared Blickery, weigh in here. What are you seeing in these markets here today?
I'm looking at the S&P 500 on the Wi-Fi Interactive, and guess what? We are right at the level that I've been wanting to see the bulls climb to, but they're going to have to beat it. Let's take a 2-day look and see what's going on here. Actually, let's make it 3-day, because we have been in rally mode for the last 3 days, although we were down a little bit today. Tuesday morning, first hour of trading, very important. Oftentimes it sets the direction for the week. And let's take a look at a 2-month chart so we can kind of plot what's going on here. Here's the high, the all-time high. Here's the most recent low. And here's the middle, and we are right back in this zone. So I'm watching basically 45, let's call it 15, all the way up to about 60, 70, 75, anything in here. So this is the ideal short zone for the bears. And if they don't get it done, if we get it closed right around 4,600, much less above, probably going to see those all-time highs again. So let's get to some heat maps and see where the market is taking us today. It looks like industrials are in the lead, along with materials, healthcare, and consumer discretionary. Kind of an interesting mix right there. Suggests that commodities are doing well, except energy's down. And then you have utilities and real estate. It's the biggest laggard. So I think we're going to see a little bit more order shakeout. Not going to make too much of this just yet. Let's take a look at some of the big winners. Tesla taking a little money off the table. It's down about just over 1%, but it was up over 10% yesterday. Had a really nice day. Best day since the beginning of the year. Didn't do much in between, but January 1st and 31st were good days for Tesla. Also want to take a look at the travel sector, and let's see what's going on here. A lot of green, but not a lot of dark green. So we're seeing some modest gains for Carnival Cruise Lines, Norwegian Cruise Line, each of those up more than 1%. American Airlines also up more than 1%. Not a lot of movement there. Let's take a look at ARC. We do have a lot of green, and let's take a look at what's happened over the last 3 days. A lot of these names finally breaking to the upside, but is it a dead cat bounce? Remains to be seen. I think it's going to depend on what the S&P 500 does. Finally, I want to take a look at our leaderboard today. These are our sentiment indicators. Transports flying high, up 2%, probably on that UPS beat. And let's see what the transports are doing, up 4% today. Year to date, still down 5%, but not a big loss for the transports. ARC doing well, biotech and retail are some of the leaders here.
Jared, let's stay on the transports here and hang with me while I tie it all together. If you could show UPS, that'd be great. I believe you noted it was at a record high, but what are you seeing also in Amazon? 21% of UPS's U.S. business is tied to Amazon. So theoretically, if UPS is out here with a good quarter, you might see a pretty good quarter from Amazon soon.
Let's take a look, because we got those earnings on deck this week. I have Amazon right here. Not sure if I'm going to be able to locate UPS off the tip of my tongue here, but let's see. Amazon's up 0.4%. Now, Amazon had a pretty big day. Let's take a look over the last 3 days. Yeah, up 7.5%. So really bouncing back, clawing back some of those big losses that we saw early on. I'm going to take one stab at getting to UPS. Maybe it's in our trending tickers. And if not, I'm just going to have to move on. But that's the risk we take with the Wi-Fi Interactive, isn't it? All right, here we go. Not seeing UPS here. Maybe it's going to pop up in a little bit, but I'll get those transports. I'll get that heat map for you the next time we talk. Sozzi.
That's a good plan. That's a promise. That's a date. All right. Thanks so much, Jared Blickery. Appreciate it. To be fair, we've looked at UPS a lot this morning, so it's good to have that broader context as well. All right, we are going to take a quick break. When we come back, a lot of headlines in electric vehicles today. We're going to talk about some of them and look ahead to General Motors and Ford.
It's a big day for the auto geeks. China EV makers Xpeng and NIO reported dips in sales for January compared to December, likely as the semiconductor shortages rage on globally. Numbers come ahead of GM's results after the close of trading today and Ford later in the week. Julie, seeing some mixed action here in trading between NIO. NIO shares are actually down on their deliveries. NIO saying they delivered 9,652 vehicles in January, up 33.6% year over year, but that was down slightly from December's total. Xpeng also reporting growth year over year, but again, those sales fell compared to December, and that's what appears to be what the market is really locking in on here.
Yeah, I think we got to talk about the context too, because yesterday, U.S. listed China shares broadly had their best day of the year, along with that big surge that we had in the Nasdaq. And also over the weekend, a Chinese government agency talked about the importance of the technology industry. They said internet specifically, but there was sort of a halo effect to the technology industry more broadly. And so the kind of mixed action that you see coming today comes off of really big outperformance yesterday. So that could be something to keep in mind too, Saz, as we're looking at how these stocks are doing.
Yeah, you really do get the sense that the semiconductor shortage rages on. You know, we just talked to Ford CEO Jim Farley last week. Look, he acknowledged that the supply chain challenges are going to persist from time. Now it's really a matter of how is this factored into these companies' outlooks when they report. First up out of the gate will be General Motors tonight. They'll be the guinea pig in terms of guidance, but GM, shares are down 10% year to date. Ford continues to win that battle versus GM in terms of headlines and just I would say new product introductions in the electric vehicle space. Ford shares only down about 2.5% year to date. So if you're a GM investor, you really want to hear, how they are, I would say, cost cutting. I think there's a lot of fat there that they need to trim, but also to what extent is the supply chain challenges that they dealt with last year, any signs of easing there, I think the market wants to hear about.
Yeah, it seems like that the car makers here in the US are not yet being rewarded for, at least not to a large extent, for some of their electric vehicle aspirations. Certainly that's true of GM. Ford is being rewarded to a higher extent. But to your point, I really think that the focus is going to be more on those supply chain issues, kind of what's going on now. How many cars are you able to sell now versus the big picture electric vehicle plans of the future. That could change, certainly, especially if Ford later this week comes out with some more numbers and clarity around the Lightning and what kind of demand they're seeing and what kind of deliveries they can actually make of that vehicle given chip shortages. So any kind of commentary around all of that is going to be of vital importance.
You better believe it. All right, switching gears here a little bit, some food for thought for investors after a challenging January for the markets. An investor buying the S&P 500 10% below its high, regardless of whether it was the trough, would have netted a median return of 15% over the last 12 months, according to a new research out of Goldman Sachs. And of course, this is our Yahoo Finance stat of the day. The overall takeaway, historically speaking, it has paid off to buy on the dips. Again, at least that when it comes to history. All right, do stick around. Much more ahead coming up here on Yahoo Finance Live. We'll hit some crypto headlines next.
In cryptocurrency news today, India is making headlines. It has been resistant to legalizing cryptocurrencies, but may have taken some steps now in that direction. At least that seems to be how it's being interpreted. Our David Hollerith covers cryptocurrencies for us. So walk us through this move and what it means.
Yeah, so yesterday or earlier this morning, I guess you would say, India time, India's finance minister announced First, a 30% tax on virtual digital assets, which to us sounds like cryptocurrencies. Most of people, news outlets have been taking it to mean cryptocurrencies. So there'd be a tax of 30% on cryptocurrencies, which is good for a lot of people, especially the investors in the country, because India is one of the countries that has gone back and forth a lot in terms of whether or not they want to ban cryptocurrencies or try and figure out how to regulate it somehow. So this is really positive news for crypto investors, seeing that there is some sort of effort to regulate the technology. Then also on the other side, India is also sort of setting dates for their CBDC rollout. So the central banks also going to sort of start testing and piloting a digital currency. And they've given a date for the launch of that currency to the public for sometime this year or next year. So two sort of milestones being taken on different sides of the digital currency landscape for India.
Hey, David, switching gears just a little bit, just got an alert that MicroStrategy disclosed in a filing that they acquired about $25 million worth of Bitcoin, average price of $37,865 per coin. MicroStrategy has been very aggressive in buying coins. We'll talk to CEO Michael Saylor later in the week, but what are you hearing from your contacts right now on prices?
In terms of prices, a lot of people, just hearsay, a lot of the investors say that they think the bottom is in. It depends on your time frame, I guess you got to say. But we've obviously seen a lot of the prices, sort of the selling pressure easing up over the last couple of weeks. And, MicroStrategy has become one of these odd forces in sort of the Bitcoin market where, they can sort of shape the dynamic sometimes, depending on when they bought, because they obviously want to buy at cheap prices. But will do it on a regular basis. So it's usually a bullish sign. But obviously we still have a pretty rocky macro environment ahead of us. So, it's sort of short term, things are looking better. Long term, we're not really sure what's going to happen this year for risk on assets.
David Hollerith, always plugged into all things crypto for us. We'll talk to you soon. All right, some breaking news here. NFL legend Tom Brady, well, he's retiring. Let's bring in Yahoo Finance's Josh Schaefer, who's been covering this story for us. Josh, we saw it coming, right?
Yeah, Brian. I mean, we started hearing rumors of this and reports of this on Saturday. ESPN's Adam Schefter, who's normally pretty accurate on these type of things, told us he was retiring on Saturday, and the Brady camp kind of came out about an hour later, said, hold on, maybe not yet, maybe not yet. Brady came on his own podcast last night and said he had been going back and forth on it. And then this morning we get the official Instagram post from Tom Brady. He's retiring at 44. This was 22 seasons into his career. He won 7 Super Bowl rings, and he didn't win a Super Bowl this year, but he's kind of going out on top in some ways. He might be an MVP candidate this year for the NFL. He led the league in passing yards and passing touchdowns once again, and came back from that 27-3 deficit a few weeks ago and almost continued on in the playoffs. So certainly Tom Brady at 44, going out on top in some ways and kind of passing, I think, what most people expect of a 44-year-old from a health standpoint for sure.
Josh, I'm applying my stock knowledge to this one. I can't imagine that the Bucs are feeling too good today, and the value of their team has to be down, has to be lower. But more broadly, what does this retirement mean for the NFL, you think?
Yeah, I think we're going to see, the next phase of quarterback. We've been talking about that a little bit on the show with the upcoming Super Bowl, right? You have Joe Burrow, and Matt Stafford's a little bit older, but some younger head coaches there with Sean McVay. And then you got Patrick Mahomes and Josh Allen. We're going to see those stars. The NFL needs to bring those stars up to the level that we've had Tom Brady for the last couple of decades. People have tuned in to see Tom Brady and either root against him or root for him. He's kind of been that polarizing figure that everyone has an opinion on. So we're going to have to see the NFL kind of create that character again. I mean, sports are all about characters and narratives, and the NFL is going to need a new one. And for Brady, it'll be interesting to see what he does with all of his brands that we cover here on Yahoo Finance. What's next for TB12? What's next for Autograph, his NFT company that's partnered with DraftKings? He just started his own clothing brand. So maybe we'll see the next generation of Brady, the entrepreneur, and maybe he'll come and talk about it with us on Yahoo Finance at some point, Brian.
Come on, Tom. Come on, Tom.
I think sometimes I feel like the last person in America who doesn't care about Tom Brady, but I appreciate the news anyway. I understand a lot of people do. So my condolences to all those folks who like to watch Tom Brady play football. We're going to take a quick break. When we come back, Apollo Funds has picked up a $760 million minority stake in Dune producer Legendary Entertainment. We're going to get Sazi's take on that next. Well, we've got another kind of content acquisition, or at least a stake for content acquisition. Apollo is buying the film company Legendary, which was responsible for what? Dune, Brian Sazi. What's your take?
Yeah, Apollo investing $760 million into Legendary Entertainment here, Julie. Really, Apollo is, along with many other, some private equity players like a Blackstone, they're getting involved in the content space. Of course, Blackstone made a pitch or an investment in Castle Media. The cost of content is going up, and the private equity industry sees an opportunity here. So Apollo, which is, of course, the parent company of Yahoo Finance, putting more money to work into Legendary Entertainment to try to help them grow their business, perhaps finance more films, just increase more content, and boost what they are in fact doing over here. So another interesting transaction in the private equity industry. This is the PE industry is sitting by some accounts on north of $1.3 trillion in dry powder. So I would not be surprised if you see more media type deals over the next coming months. And keep in mind, Julie, we still have Amazon out there trying to close its deal for MGM. So very interesting time in this space. And we'll talk more about this deal with Apollo's head of private equity, David Samber, in the 11 o'clock hour. Looking forward to that conversation.
Yeah, so am I. Thanks a lot. Appreciate it, Sazi. So we'll be watching to see if we see some other content deals like that. Before we take it a break, I want to take a look at what is going on in the markets at this point in time. We are seeing a mixed picture here today. So it's a little bit of a respite, I would say, from some of the recent action that we've seen in the markets, where we have seen such wild swings, right? In the major averages. We saw obviously a very big January downturn before a very big upturn late yesterday in the Nasdaq. Today, just looking at some of the groups that are on the move that are pushing and pulling us in different directions, we're seeing tech and real estate and consumer discretionary stocks lag today. Energy stocks are the top performers along with industrials. So that's the kind of balancing act that you're seeing equal. Not much change in the major averages, or a mixed picture to be more accurate in the major averages. We could see more movement coming later this week. We're going to get earnings from the likes of Alphabet and Amazon and the car makers, as we've been talking about. As we've also been talking about, coming up in the next hour, we're going to be speaking to UPS CEO Carol Tomé. We'll also be talking with Muddy Waters' Carson Block on the state of the SPAC market. Spoiler, he's a skeptic. And perhaps not surprisingly, it should be interesting to get his comments and our exclusive interview with UPS's Carol Tomé. Stay with us.
Welcome back to Yahoo Finance Live on this very busy Tuesday morning. I'm Brian Sozzi alongside Julie Hyman. It's a new month for the markets, folks, which many probably welcome after an ugly January that saw the S&P 500 notch its worst monthly performance since March 2020. Today, we're seeing some more mixed action on the screen. Dow slightly in the green, S&P 500 and Nasdaq both in the red right now. Now, here are some other things we're watching for you at this moment. Low on juice. AT&T shares are getting hit after the telecom said it would roughly halve its dividend payout as it prepares to finalize a sale of Warner Media to Discovery. That deal is expected to close in the second quarter. And delivering gains, shares of UPS are soaring to new highs as the logistics giant blew away analyst profit forecasts for the quarter and delivered an upbeat outlook for this year. We'll have an exclusive interview with UPS CEO Carol Tomei coming up, so do not go anywhere. And sifting through the software stock rubble, we'll chat with the CEO of software player Qualtrics following its solid earnings report. Is the software stock sell-off overdone? It just might be. But Julie, where did all this volatility go? Last week, a really violent time for the market, seeing some more subdued action this week.
Yeah, we are, although who knows if that's going to change. We just got some job openings data. JOLTS rising to 10.93 million in December from 10.78 million. Again, 10.93 million openings in the month of December from 10.3. So job openings ticking up here. We also just got the ISM manufacturing data for January, 57.6. Which is a little bit better than estimated. Prices paid, though, much higher than estimated, 76.1. That's higher than the 67 that economists were looking for and the 68.2 of the prior month. So for December, new orders coming in ahead of estimates, 57.9. And the employment index within ISM, the Institute for Supply Management is what that stands for, by the way, 54.5. So overall, that ISM manufacturing suite looks pretty good, but that prices paid number is perhaps a source of concern. You combine that with the job openings numbers, and we still see a picture where perhaps various American firms are having trouble filling jobs. That also, by the way, perhaps presages what we could see on Friday. We've got the monthly jobs report coming out on Friday, and we've got a number of estimates for non-farm payrolls for actually a drop in hirings in the month of January, some as high as 400,000 losses, jobs cut, or I should say a drop in overall workers in the United States. A lot of that likely having to do with the Omicron variant, causing different closures, causing sicknesses as well during the month. So that's something that we're going to look ahead to even as we see these JOLTS numbers, Saz.
Yeah, it's the good thing here, Julie, is I know if we do get that negative print on the headline, which I have to give a shout out to Joe Brasuelis. He came on our program last month on Jobs Day and said, hey guys, we might get a negative print or negative headline result in the jobs numbers for January. And he may very well be right, but I have to say, just talking to all these executives that we do, you're not getting the sense that they're worried about a recession. One of the top things they are worried about is not cutting jobs. It's can they find enough people to bring into their workforce and enough talented people that can do the jobs that need to be done. So in many respects, Julie, this is a continuation of the story we saw last year.
Yeah, and I should mention the quit rate as part of the JOLTS figure that we just got was at 2.9%. That's about 4.3 million people quitting a job in December. So that number, I'm not sure what it was the prior month. I'm going to have to go back and do a quick check here. But that's something that feeds into all of this as well, that, we keep trying to point the finger at sort of one thing for what's going on in the job market. And it seems like what has emerged is that it's a number of different things. The quit rate is part of it, that people are quitting both because they want better pay, perhaps at a different job, but also because they just want a different job, period. They want maybe a different quality of life. They want more flexibility. Perhaps they want a hybrid workplace. You have people with childcare issues. You have people who are concerned about COVID. So it seems like there are a number of different things contributing, and hopefully we can add further to that picture come Friday.
You are on the mark. All right, from jobs back to markets, the hype is giving way to reality when it comes to the SPAC market. Shares of many companies that came public via SPAC last year remain under pressure this year as investors sour on loss-making startups. So what's next for the SPAC space? Joining us now is Muddy Waters research founder Carson Block. Yahoo Finance's Akiko Fujita is here as well. Carson, always nice to get some time with you. Help us understand this pressure we continue to see on the SPAC market. Why that loss of investor appetite?
Well, I mean, obviously we've got broad dynamics that have impacted this to some extent, right? Which are the rise in interest rates leads to a sell-off in speculative assets. But I think structurally, the problem with SPACs, and over the long term, maybe a few of them will turn out to be reasonable investments. The structural problem, though, is you're generally giving 20% of the company away to the SPAC promoter. So these are not designed really to create wealth structurally. They're designed more to transfer wealth. And so the incentives to put a SPAC together are very strong to just do something, just close some transaction, and then you as the SPAC promoter get hundreds of millions of dollars in your pocket, and you can sell out of that. So that, I think, is the structural issue that's really been, been catching up, or the chickens that have been coming home to roost here. The other thing that pushed it along was the SEC publicly stating that, okay, you actually, as SPAC promoters, you previously assumed that you could make whatever public projections you wanted that, could have really little connection to reality. So the SEC said, in actuality, you might be liable for that. Now, that's a legal gray area, but that also dialed back the willingness of company managements and SPAC promoters to get out there and, tell these fairy tales about, like sales growing 700 times in 5 years.
Carson, on that front, I mean, you've kind of been raising the red flag since spring of last year when we really started to see the peak of the SPAC boom. You've particularly been focused on SPACs in the EV space, saying essentially, and I'm paraphrasing here, that they're preying on retail investors. When you look at names out there, like a Lucid, like a Lordstown, Nikola, I mean, are there any in particular that you think are especially egregious?
I mean, Lordstown and Nikola. I think it's a really interesting commentary on where we are today, that these companies, which, I mean, the businesses, and I haven't looked at them, in any detail to be clear, but, I think there's a good chance that these businesses are essentially close to valueless when all is said and done, yet there's still real market cap there. And so I've taken to joking for a little while that 700 million is the new zero. But, when you look at those companies, the new zero is actually, multiple billions. So there's still a lot of froth there. And I think one of the things that it's a really interesting behavioral finance phenomenon that it's similar to negotiations, right? Studies show that if you're the first to try to frame a price or frame deal terms, it kind of anchors the discussions there. And when these companies have gone public with market caps that are enormous, it seems like, there's this sense that as they shrink, even though the market caps are still way too big for these businesses, there's this attitude that like, well, they started out this big and now they're only this, so this is probably okay. It's probably a value. So I don't know. I think in future years, behavioral economists are going to have like a field day analyzing this period of time.
Carson, it's Julie here. There have been so many SPACs or companies that have been public over this method over the last year. I should say there have been so many de-SPACs, perhaps. In and of itself, is the fact that a company chooses to come public that method a warning sign, all else being equal? In other words, do you sort of just not invest in these out of hand and look to IPOs and direct listings, for example, if you want a new listing?
Well, look, I mean, there certainly has been a track record of IPOs that haven't been great either, but the SPAC process is a much lighter touch way for a company to go public. Now, you can't look at it and say, per se, every company that's gone public via SPAC is uninvestable because it's gone public via SPAC. But if you're going to look at probabilities, the probabilities are much higher that something that went public via SPAC versus IPO should be deemed uninvestable.
Carson, specifically on the SEC, obviously they're reviewing the structure of these SPACs. We've heard Gary Gensler talk more about the need for transparency. And I wonder if you think that really is the issue here. Is it the structure of these deals, or is it the fact that investors don't often really know what they're putting their money behind?
Well, I think it's all of the above, but I guess when we look at things structurally and what the legal framework had been assumed, what the assumption was as to the legal framework there are 2 points to make. So first of all, the structure. Again, the SPAC promoter is going to get usually 20%. So I'm friendly with somebody who was a major shareholder in a company that did go public via SPAC, and it was actually a real business. And the SPAC promoter is a SPAC promoter that's been successful in doing SPACs. That SPAC promoter told the shareholders, the major shareholders, said, look, I don't care what I pay for this business, okay? I'm going to get my shares and I'm going to blow out of them. So you tell me how much we pay and we'll do it. And so that's the perverse incentive that structure creates. So that's number one. Number two, if you're going to bring a company public via IPO, you're generally not allowed to make projections of future results. That's called conditioning the market. That's prohibited. Now, with the SPACs, though, because it's not an IPO, the company already went public, it's an acquisition of a business, they've made these projections that really have almost no basis in reality. And so I think for a lot of investors who were, especially the new retail investors who came in the market post-COVID, I think that they didn't understand that you really can't trust this. So when the company is coming out and saying, yeah, we did $7 million in revenue last year, in 5 years we'll be doing $1.4 billion, or that's our projection, they didn't know enough to be skeptical of that. So I think that issue, and that's what the SEC has tried to address, has tried to say, you know what, you don't have carte blanche to just throw predictions out there that have no basis in reality. So that kind of dialed back the hype that's surrounded a number of these de-SPAC transactions.
Carson, I want to bring it back to what you do. And I wonder if you have current short positions or short recommendations on any SPACs that we don't know about already.
We are, well, nothing that, I don't announce shorts until we're ready to announce shorts and generally releasing research. But no, we've closed out we've actually closed out, nicely the SPACs that we had publicly shorted. So we've been happy with that. Although in retrospect, we were a little bit early to close out. But since you never have a crystal ball on where the market's going, I'm not going to cry over that.
Carson, I think the last time we spoke, we were talking about the risk of investing in Chinese stocks, particularly those listed in the U.S. Obviously, you were early to raise the concerns around Luckin Coffee as well. When you look at the landscape right now, is there a case for investing in Chinese companies, or is the risk just simply too high?
So, all right. So I guess when people ask me about, should I invest in China, the answer that I give is, look, stocks go up if there are more buyers than sellers. So will there be a point in the near future in which massive allocators of massive pools of money say, hey, China's GDP is expected to grow, blah, blah, blah. Of course, nobody believes the GDP numbers, but that gets ignored in these conversations. It's expected to go blah, blah, blah. Let's increase our allocation to China equities to this. And, then you've got money flowing into the space. Plus you have the passive flows into it. So those can push stocks up. Now, regardless of the quality of the numbers and the quality of the companies. Now, I guess what I would say to people who think that they should be long China for that reason, the risk that you get is overnight, without warning, the government pulls the rug out from underneath the companies in which you're invested. And we saw that a decent bit last year. And that's the nature of the system. That is a system that encourages fraud on a widespread basis. But that system in which there's really very little rule of law and there's no accountability to U.S. regulators effectively, that system can just blindside you all of a sudden. So that's what I would say is, go in eyes wide open, and maybe it works for the next however many years, but you have to understand that there's a risk. You're going to wake up and you're going to be in tears over these stocks that you're still owning. So if you can live with that and you think that there are going to be flows of funds into China equities, then maybe you should go long.
Well said. Muddy Waters Research founder Carson Block, always nice to get some time with you. Yahoo Finance's Akiko Fujita, good to see you as well. All right, coming up, shares of UPS are on fire following the company's much better than expected earnings this morning. We'll have an exclusive chat with UPS CEO Carol Tomei. She just got off her earnings call to come on with us, so please do stick around.
UBS shares are trading higher by 6%. That's after the bank posted its highest annual profit since before the financial crisis. The company announced plans to nearly double its share buyback program, authorizing up to $5 billion after it bought back more than $2.6 billion worth of its shares in 2021. Net profits up to $7.5 billion last year from $6.6 billion in 2020. It maintained its guidance as well for its wealth management division. Starbucks' union push is spreading. Employees at the coffee chain now petitioning to unionize at 54 stores across the United States. This pursuit comes after Starbucks workers in Buffalo, New York first voted to unionize. That happened last month. And all of this, by the way, is ahead of Starbucks' first quarter earnings results announcement. That may be affected by the push for unionization and also the Omicron variant. The hit online word game Wordle has been acquired by the New York Times, which will integrate the daily puzzle into its game suite. Joshua Wardle, the maker of Wordle, said the game will initially remain free to new and existing players, though wasn't clear on the possibility of a paywall in the future. The Times did not disclose the exact price, but said it bought Wordle for a number in the low 7 figures. Reportedly, Josh Wardle initially made the game for his girlfriend. We're going to take a quick break. When we come back, we'll be checking on markets and speaking with Carol Tomé, the CEO of UPS. Stay with us.
All right, President Joe Biden has a long list of things left to get done, says Yahoo Finance senior columnist Rick Newman. Rick is here with us now. Rick, what's priority number one for the president?
Wow, I guess getting some kind of action on this Build Back Better legislation, which has just flat out died. I've been going back and looking at what Biden and his fellow Democrats in Congress tried to do in 2021. Some of these issues have just fallen apart completely. Remember, Brian, when they were trying to raise the minimum wage? That was one of the first things they tried to do in the first couple of months of Biden's presidency. Just to remind people, the minimum wage is $7.25, and the Democrats kind of took a hard line on that. Progressives said, we're going to raise it to $15, and we're not going to settle for anything lower. Well, guess what? They didn't get that at all, and we still have a minimum wage that has not gone up in years. Another thing, remember Biden was talking about raising taxes on businesses and the wealthy, raising the corporate tax, raising the income tax on millionaires or multimillionaires. Nothing. Focus. Nothing has changed. And I think the prospects for anything like that happening in 2022 are becoming vanishingly small. And where are the green energy investments? We've heard some regulatory activity out of the Biden administration with regard to things like higher fuel economy standards, but we have almost nothing, no money actually appropriated from Congress for this big green energy transformation that was a huge part of Biden's campaign plan. So Biden did get an infrastructure plan. He got some other things done, but many top Democratic priorities completely unfulfilled right now.
I know these issues are complex, Rick, but is there sort of one thing we can point the finger at as being the reason why this stuff is not getting done?
I actually think you can, Julie. I think the Democrats have tried to do everything, and they have completely confused voters. And I think on the progressive side of the Democratic Party, the perfect is the enemy of the good. Just go back to the minimum wage. There are probably a lot of workers who would be better off if the minimum wage had gone up from $7.25 to, let's say, $10 or $11. And you could have gotten much more support for minimum wage around $10 or $11. Perhaps even some Republicans would have gone for that. But because there was a faction within the Democratic Party that said, nope, it's got to be $15. I mean, think about it. We're going to settle for nothing less than doubling the federal minimum wage. There were a number of Democrats who said, look, that's not going to work in rural America and parts of the country with lower living costs because that would just hurt businesses too much. So Democrats have nothing to show for any effort to raise the minimum wage. And given that is really a core issue for the Democratic Party, I think that is a genuine concern for voters, you know, who are considering what to do in the 2022 midterms. Can Democrats really get anything done?
Rick, the administration is still out there doing the media rounds, trying to keep Build Back Better alive and well. But what's the reality of that? Is that any chance of that passing in any form, even pieces of it this year?
It sounds like they're not going to get the social welfare part of that plan. So the main part of that is either a 1-year or a multi-year extension of this broader child tax credit. That's expensive. And that was one of the main points of breakdown as this legislation kind of fell apart in December. So let's say they take that out and they just go for a smaller set of things, such as some of that green energy investment. There could be more support for that. Problem with the whole approach up till now has been they have just larded tons of different stuff into that legislation. Voters don't know what's in it. Many legislators don't know what's in it. So when you have a big, expensive piece of legislation, we're talking pushing $2 trillion here, and voters don't even know what's in it. You've got a messaging problem at least, and you probably have a political problem too, which has turned out to be the case because Biden can't get it done.
So true, Rick. All right, Yahoo Finance senior columnist Rick Newman, always good to see you. We'll check back with you later. And we'll be right back. Shares of UPS are soaring as the logistics giant blew away analyst profit forecast for the fourth quarter. The company also delivered an upbeat outlook for 2022, most notably on profit margins. Joining us now for a Yahoo Finance exclusive is UPS CEO Carol Tomé. Carol, always nice to get some time with you. Good to see you here this morning. Look, I tweeted out this morning, I think there are a lot of investors that are not used to seeing this type of quarter from a storied company like UPS. Help us understand some of the biggest drivers of the business right now.
Well, Brian, it's great to see you, and thanks for asking me to come on your show. You know, when I came here, we took a hard look at our business model, and what we understood is that what got us here to be the largest logistic company in the world wasn't going to get us to where we needed to go. Our customers were changing, our competitors were changing, and the rate of change was accelerating. So we took a hard look at our business model and started to pivot into the segments of the market that really valued our end-to-end network, like SMBs, and I'm delighted to see the progress that we're making in that regard. In fact, SMBs, as a percent of our total volume in 2021, grew 420 basis points. Nearly 27% now of our volume is with SMBs. We also leaned heavy into healthcare, leveraging our healthcare logistics and cold chain solutions. And that's translated into an amazing business. A healthcare portfolio, $8 billion this year, on its way to $10 billion by 2023. So a lot of really positive movement on the top line. And then as it relates to productivity, well, we're laser focused on productivity, and I'm really delighted by the progress that we're making in that regard. So when you grow your revenue faster than your expenses, your margin expands, and when you have a disciplined approach to capital like we do, well, your return on invested capital also expands. And gosh, we delivered a 900 basis point improvement in return on capital this year, so super proud of the team.
Carol, I was just thinking now, I think every conversation you and I have had maybe over the past 8 or 9 years, of course, when you were the CFO of Home Depot, we've talked about return on invested capital and profit margins. So let's talk about it here. Margins up in all 3 of your segments in the fourth quarter. Are gains like that sustainable? And what is driving that?
We think they are sustainable, and we've guided that our margin will expand in 2022. In fact, hitting the consolidated margin in 2022 that we thought we would hit in 2023. So we will be achieving our consolidated targets 1 year ahead of our plan. What's driving it? Well, again, we're leaning into the segments of the market that really value our end-to-end network. We are working revenue quality hard. You know, we used to think a package is a package. That's just not the case any longer. And so we are leaning into the segment that values our end-to-end network. And we've also taken advantage of a demand capacity imbalance. And that's going to stay for a while. We know that there are upstream supply chain jams. You know, air freight demand has returned to 2019 levels, but the capacity has not yet returned. And when you have that kind of an imbalance, well, pricing remains firm, and it's going to stay that way for a while.
Carol, it's Julie here. I want to get into this on the pricing question. There's remaining firm, and I guess there's getting firmer. So I'm curious how much more pricing power, how much you think you're going to be able to continue to raise prices in 2022?
So our largest customers are typically, we negotiate a 3-year contract with them typically. So we set prices with them for 3 years, and we're about 60% of the way through those contract negotiations. So we've got about 40% more of contract negotiations to occur, and there'll be pricing movements within those large accounts. As it relates to our general rate increase, we just announced our general rate increase for 2022. That was 5.9%. So that gives you a sense of the pricing dynamics today. And it's not just about pricing, though. It's about the service that we provide. And we provide a premium service. In fact, during the last peak, we had the highest service levels of any integrator as measured by an independent third party.
Carol, it was my understanding that UPS is piloting or testing dynamic pricing or charging higher prices where demand is the greatest. When did something like that go out nationally?
So we're still in the process of working the technology that's necessary to really empower dynamic pricing, but it's part of our future. Think about airlines and how successful they've been with dynamic pricing. The same should be true here for our company.
Carol, I want to ask you about labor. You were talking about the service that you provide. Certainly part of that is because of the workers that you have. And in this working environment, you have to pay them a certain amount. So how much is that a challenge for you guys right now? Not just paying the workers what they are demanding, but finding the workers as well.
Yeah, we're really fortunate, Julie, in that we have always had very attractive and well-paying jobs. In fact, a third of the people that we hire in for temporary workers during the holiday peak season end up staying with us as full-time UPSers. These are great paying jobs. So pay has never really been an issue for us. Now, parts of the market in the United States where we've seen some wages get a little bit ahead of what we were paying, we had to make some what we call market rate adjustments, but that's all factored into not only the performance that we just reported, but as well as our outlook. This isn't just a job. This is a career. When I think about people who are in senior leader positions in our company, many of them started as part-time UPSers. So that sets us apart from a lot of the world. As it relates to, I will call it technology, because there's a war on talent for technology. We are working on really cool projects here, and technologists want to work on cool projects. For example, we just announced the first phase of what we're calling Smart Package, Smart Facility, where we're putting RFID tags on all of our packages and adding technology in with wearable devices. So no longer will there be a manual scan. It'll all be done through the wearable device. If you are a technologist, that's pretty cool. We're working on robotics, we're working on drones, we're working on just a number of very cool technology projects. So people want to work for us. And I'll tell you this, I measure UPS happiness through a likelihood to recommend metric. And likelihood to recommend in our IT team is 81%. That's pretty good. When people are happy, they're going to stay with you.
Carol, and I can see you're happy even just talking about those technological changes, which is cool. I also want to ask you about the unionization of your workforce, which is a big part of who UPS is as well. We are seeing that union push at some other employers. And as someone who has now had deep experience with that, I'm curious what advice you would offer to other companies, because in many ways that has worked to UPS's advantage, or at least in some ways it has. So I'm curious what you would advise other CEOs whose workforces are working towards unionizing.
Well, 75% of our workforce in the United States is covered by some sort of a collective bargaining agreement, the largest of which are with Teamsters. And we've had a 100-year history with the Teamsters, and we love our Teamster UPSers. We also have work councils outside the United States, so we're very accustomed to working with unions. I think my advice to CEOs is understand what are the needs and wants of your employees, how best to serve them.
Carol, I think and recently I saw a UPS truck was held up and just at gunpoint, a driver. These are scary times. What can you do to prevent workers from just going through that situation? How do you rethink the network just to even bolster employee safety?
Employee safety, number one. It's an employee bill of rights, a UPSer bill of right to leave work the same way they came to work. And sadly, there's an increase of violence and arson and theft around our country. So we are doubling down on training our people as to how to react if they are ever faced with that situation. In that case, if I'm thinking of the case you're referring to, Brian, our driver did exactly what he needed to do, and he got out of that situation just fine. We don't want them to, obviously, to engage with the bad folks. We want them to disengage. So we are also increasing safety throughout our company with security, cameras, as you can appreciate, all the ways that you can put protection around your people. Their safety is number one in priority to me.
Good to hear. Also too, switching gears a bit on the inflation front, are you seeing any signs in your business that inflation has neared a peak?
Well, it's interesting that our largest expense is compensation and benefit, and for the most part, that's contractually guided. So we don't see a lot of inflationary pressures coming into our business. So I can't really give you a good comment on what's happening in the country.
But in terms of just growth in here, we're getting a lot of folks, I think, out there on Wall Street. They're concerned about a slowdown in this country as we move to this land of higher interest rates. I remember back when you were on the board of directors or at the Federal Reserve Bank of Atlanta. Put your old school Fed hat on here, Carol. I mean, do you see the economic recovery at risk because of these rate hikes?
Well, the projected growth of GDP is still very high as we look at 2022, north of 4%. That's still pretty growthy in the history of the United States. And taking interest rate moves to put a cap on the inflation rates that are facing the country seems like it's a wise thing. It shouldn't tip the growth rate negative.
Interesting. Lastly, Carol, again, as I mentioned at the top, this is not the UPS a lot of folks have come to know. Are we watching a rebirth of this company? And what do you think the next decade will be like for UPS?
It's really an exciting time for us. We say internally that we're writing the next chapter of this 115-year-old company. And when we think about, well, what does that really mean? It means providing the best digital experience powered by our smart global logistics network. Because everything is moving to a digital experience from our shippers to our recipients. And we want to make this the most simple and frictionless and fun place to do business with. So we're leaning into technology in a way that we never have before. Not just technology that we build, but that technology that we buy through SaaS solutions to make sure that it is frictionless and seamless. I'll give you one example. In 2021, we took 5 websites that had over 3,300 pages of stuff consolidated into one website with 500 pages of information. And we saw the page views grow from 10,000 a month to 600,000 a month. This is the way that customers want to do business with us. This is the way that prospective employees want to consume information about us. This is about how communities want to learn more about all the good work that we do in our company. So expect to see the best digital experience of a trucking company that's available.
Well, you'll have to give me some tips offline, Carol, on how to boost page views. I'm all about boosting page views, but always good to get some time with you. UPS CEO Carol Tomé, good to see you. Stay safe. We'll talk to you soon. All right, coming up, we'll talk with the CEO of software player Qualtrics, who just reported another impressive quarter. Stick around.
Well, as we know, software stocks have been having a tough go of it over the past couple of months, but we've seen a bit of an upturn as of late. Qualtrics helping matters. The shares are down a little bit today, but we've seen an upturn recently after the company reported its earnings. The Qualtrics CEO, Zig Serafin, is with us now. Zig, first of all, help us understand what Qualtrics does for people who are not familiar with the company and this sort of next phase of sort of relationship management software.
Yes, good morning, Julie and Brian, and thanks for having me on and having us on. Well, Qualtrics is focused on helping every company that is becoming a digital company to focus on the core experience of the customer, the employee. And so we help to be able to build deeper connections, build deeper, more authentic relationships with their customers and their employees. And most importantly, take right actions at the right time, whether it's related to the product, whether it's the way that the customer is being engaged digitally or in person. And all of that ultimately ends up showing up in the way the brand is related by the customer or the employee.
You know, Zig, when your biggest customers are coming to you now, those accounts that are worth more than $1 million annual recurring revenue, what is their biggest need right now as we have settled into this hybrid work environment?
Yeah, Ryan, and I'm glad you called that out. We had about a 93% increase in our $1 million plus customers and in our annual growth for that. And we had 61% subscription growth in the fourth quarter. So we're seeing an acceleration in the business. You know, you had Carol Tomei on just a moment ago, UPS CEO and one of the innovators around what it takes to be able to lead in this marketplace. And what customers are doing, and as you heard Carol talk a little bit ago, is tuning in more into the hearts and minds of their employees and of their customers, taking friction out of the system, and ultimately using that as a way to be able to better engage with the business that they end up serving and using that as a differentiator. And that's where the experience management system that we've built comes into play, which is being able to help make timely decisions, be able to help know where the friction that's being taken out of the system actually can end up making a difference and moving the needle on the business.
And Zig, I wonder if you are frustrated at all, because you guys are showing this progress that you're talking about. You came to market not that long ago after spinning out from SAP, and you've been caught up in this software sell-off. Is that frustrating? And what do you want to try to communicate to potential investors?
You know, Julie, we've been at this for a while. This company's been around for 20 years, and we've been a high grower. We've been an innovator in our category. The analysts are responding to our overall progress and our performance. If you look at the number of buy ratings that are on the company, and look, we're taking a long-term view. We see a robust market that's ahead of us. We've continued to have consecutive growth of performance, and we're frankly seeing acceleration in what we're doing. And the company could not be more relevant. And look, the investors that see that are also investing in the long run. They're not watching the day-to-day. They're looking at the fundamentals of this business. And we could not be more important currently in the way that companies end up using this platform to engage with their customers as part of a digital transformation, to engage with their employees, to be able to understand what's on the hearts and minds of their employees, to be able to build high-performing workforces, to attract talent that they need to be able to bring in as part of a company. So those are the factors that we're paying attention to in the way that we're leading this market.
You're just building on Julie's point, Zig. There's been a lot of volatility in markets, lots of concern about economic growth slowing down. Are you seeing any pause on those large contracts, those large deals that you've been closing?
Well, we saw strong demand in the fourth quarter. We're coming out of the year, and as I mentioned, we had 61% year-over-year growth in our subscription. We're guiding towards north of $1.4 billion in 2022, and I would say that the demand is, effectively robust and it's sustained. And what's guiding that and what's driving that is experience matters more than ever. You heard Carol Tomei talk about this quite eloquently, and the way that actually is helping to be able to shape and create innovation and frankly differentiation in their marketplace. And many other companies, many other industries are seeing this across the four core experiences of their business, in the way that they engage with their customers, in the way that they bring their employees to be able to better serve their customers, to build market-leading products, and ultimately be able to set apart the way that their brands are positioned in their markets. And we're at the heart of that, and that's partly what's driving this business.
And so, Zig, I would ask you a similar question to what I asked Carol, which has to do with finding good people right now. I know it is very competitive within technology. And so, are you finding them? And what are you having to pay them? Are you having to raise pay for folks to get them on board?
Yeah, Julie, it's a great question. And, there's not a CEO, there's not an executive that I talk to these days where the war on talent is a real reality. It doesn't matter what industry that people are in. And, what's behind a lot of this, and a lot of our research shows this, is that people want more flexibility and they want more choice. It's been, a very low barrier these days to be able to identify a new job and to be able to make a switch. You can do that within a click of the mouse. Technology has made more options possible for the way that employees engage with the employer and who they work for. And so compensation is certainly one factor, but there are many other factors. In fact, most CEOs that I speak to will say that the old playbook for how you end up leading a workforce is being thrown out, and there's a new playbook that's being written. And our technology in the employee experience area, we have an employee experience system, helps companies to be able to understand what really matters to different segments of a workforce. What does it take to be able to attract new talent? How do you engage a team and be able to create a total rewards program that is partly compensation, but what are the other factors that actually will resonate? How do you shape the culture? And so what we're finding is as these changes are taking place, the companies that are leading are those who are tuning in to better understand what's on the hearts and minds of their employees and use that to differentiate the position that they have in their marketplace.
And it's tougher than ever, of course, with this hybrid/remote work environment for many folks. Zig, really good point, really interesting conversation. Thanks for being here. Zig Serafin is the CEO of Qualtrics. Thank you. We're going to take a quick break. When we come back, we're going to dig once again into today's market action. Stay with us.
All right, welcome back to Yahoo Finance Live on this Tuesday morning. I think it's Tuesday, Julie. I'm not so sure. It's been a very, very busy Tuesday. I've totally lost track of time, but seeing some I don't know, muted action. At least week over week, S&P 500 slightly in the red, Dow slightly in the red. Dow is now slightly in the green. Changes that quickly. Nasdaq leading the losses here. Look, I thought we were going to see a continued spate of volatility, Julie, this week, but that is not continuing. And really, look at UPS shares. Holy cow. I mean, this is a market cap company, over $200 billion. I cannot emphasize this enough. You do not see these types of moves usually from large cap industrial companies. UPS shares up 14%. Of course, Carol Tomei, just on our network in an exclusive interview, talking really that, they're seeing just a lot of strong demand. Of course, that shift to online shopping, helping shipping COVID-19 vaccines, helping them as well, but also just a focus on doing better.
Yeah, really impressive move there. I've also been watching what's going on with Treasury yields today. That's because we got some economic data around 10 a.m. with that JOLTS data showing an uptick in job openings, the quits rate at 2.9%. So looking ahead, really, I've got my eyes on that Friday jobs report. We also got an ISM report for manufacturing, a measure of manufacturing in the U.S., coming in a little bit better than estimated, but it was really the prices paid and estimated, but it was really the prices paid component that was much higher than estimated that I was watching closely. That means also connecting it to that Friday jobs report that we'll be looking at average hourly earnings to see what kind of increase we see there, what that means for inflation, and by extension, of course, what it means for the Federal Reserve in a world where there's one bank out there, Bank of America, that says we're going to have 7 interest rate increases this year. We'll see if that's true. That does it for Brian and I. We're going to go drink some more coffee. Brian's going to write 20 stories, and then we'll be right back here tomorrow morning. Akiko Fujita and Brian Chung are going to take you through the next 2 hours right here on Yahoo Finance Live.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. Stocks A bit of a split picture here to start off the month. We're seeing the Dow just dipping into the green here, up about 49 points, but the Nasdaq and the S&P 500 trading pretty flat there as investors fail to find their footing. New economic data pointing to an uptick in job openings, with 4.3 million Americans quitting their jobs in December. An uneven economic recovery, the global picture pointing to a growing divide between advanced and emerging economies. World Bank President David Malpass is going to be joining us this hour to discuss his outlook for the year. And the end of an era. 7-time Super Bowl champion Tom Brady calls it quits after 22 years in the NFL. The greatest of all time, saying it's best to leave the game to the next generation of athletes. We've got much more to go on that. Brian, we'll be talking about that a little later in the show, but let's start this hour with a look at where stocks are trading right now. Pretty flat right now. After what we saw yesterday, really a rally to round out what's been a choppy month, we did get some new economic data out on the labor market this morning, pointing to job openings in December, ticking up to 10.9 million last month, Brian.
Yeah, absolutely. And what the JOLTS report kind of shows us is lag data. I want to point that out. So this is not covering the economic situation right now. This is really only reflecting perhaps the beginnings of the Omicron variant as well, because it only covers the month of December. But again, that number coming in at 10.9 million, what that measures is the amount of job openings that were in the economy as of that time. And that's still extremely elevated. So even though it is a takedown when you compare it to the November numbers, it's, again, not showing any sort of substantial alleviating in the pressures that we're hearing anecdotally from businesses both big and small in terms of the inability to plug the jobs that they still have posted. Now, if we talk about the quits numbers, again, this is kind of an important number that shows you the turnover, worker power, and the ability to leave their jobs and find new ones. 4.3 million was the number for the month of December. Again, still elevated, and the quits rate actually essentially remaining unchanged between November and December at 2.9%. So the dynamics that we've seen play out over the course of 2021, showing that workers have the ability to shop for other jobs, definitely remains intact. Of course, whether or not the Omicron variant, because of the just concerns about getting sick again, could definitely weigh on the January numbers. But of course, we won't get those JOLTS data until sometime in early March. So again, we'll have to watch for that data. Of course, all eyes now on that big employment report coming this Friday morning, Akiko.
Yeah, certainly, and a lot of speculation around that could be a pretty disappointing number. You know, when you look at the stock moves today, it kind of feels like investors are still trying to find their footing on what these rate hikes are going to look like, whether it's 4, whether it's 5, whether it's 7. Taking a look at bond yields right now, we have seen them push higher with additional economic data coming out this morning on manufacturing data pointing to slowing growth, factory activity falling to its lowest since November of 2020. And then those ISM prices paid index rising 7.9 percentage points. So those cost pressures continuing to go up. And Brian, some interesting comments in your conversation with Atlanta Fed President Raphael Bostic yesterday, who didn't seem to rule out a hike of 50 basis points, but sort of said that that's not preferred right now.
Yeah, and this is the challenge for the Fed, right? If we just take away all of the complicated jargon around, are they going to raise by 25 or 50 basis points? When's quantitative tightening going to start? All of this is about what the Fed is going to observe in the data in the coming months. And kind of as you illustrated with the ISM data, and as we kind of explored earlier with the JOLTS data, this is going to be a very tumultuous time when it comes to the data because of the Omicron variant having an impact on the data that's only going to start to get published now, even though the wave is starting to come down now. Keep in mind that the peak of everything was really in January, it appears. And again, the data that we'll get on the labor market and inflation for that month and that period won't be coming out until later. And I asked the Atlanta Fed President Raphael Bostic about what he would expect to see this Friday morning. Take a listen to what he told us yesterday.
Well, I'm expecting that number to probably come in a little lower than what we've seen for the last several months because the impact of Omicron has been real. And it has created some tensions in terms of employers' ability to fill the positions. And I think that's going to reflect itself in this first number. I would say, though, that it's not my expectation that that impact of Omicron is going to really last and persist for some time. And I'm hopeful that we're going to see a rebound in labor markets in the February and March reports
And my translation of his remarks there is we need to look through what could be a very disappointing print in January and look towards those February and March jobs reports, which won't come out for a few more months because of the impact of the Omicron variant, which makes it all the more difficult for the Fed to try to engineer this soft landing that they're trying to do. We know that they will raise interest rates at some point. They will shrink their balance sheet at some point. It just depends on how hawkish are you. I asked him, are you more like a peregrine falcon or more like a red-tailed hawk in terms of the hawk spectrum? He's apparently a big birder, but the birder community has informed me that apparently owls, which is how Bostic describes himself, is apparently the same type of family as falcons. And the I don't really understand the bird. I know I don't.
It's tough enough to get the messaging right for the Fed, right? Now you're asking for a comparison.
I'm making it worse.
Of what kind of bird?
I'm making it worse. He said that he's an owl, but again, I don't really understand the distinction. But again, well, maybe I'll have to ask that of other Fed presidents as well.
All right. Well, we'll come back to that. Maybe we'll put up a chart at some point on what each Fed official likens themselves to. But let's get back to those interest rate hikes, because certainly that has raised concerns, or we have seen a sell-off in tech out of concerns about how aggressively the Fed is likely to move. Tech stocks certainly looking to recover after a volatile January, with all eyes on Google and Amazon as they prepare to report their quarterly results. Let's bring in Brent Thill. He's Jefferies analyst. Brent, let's just start with what we saw in January. I mean, certainly a really bad month for tech. It felt like investors kind of found their footing again after those Apple results that came out that were certainly strong. How are you looking at the state of play right now?
Yeah, for tech, I mean, multiples overshot to the up. And what I think we're seeing is a healthy correction, number one. Number two, the numbers have been really good. Fundamentals have been good. So what we're just dealing with is a low interest rate environment yielded just huge multiples in tech that probably were unsustainable across the board. We've been talking about, software multiples being way above historic average. And so that's cut across from semis to internet to software. And I think tech is taken a needed timeout. It overheated. We're now back at a spot where, Google's, low teens EBITDA multiple, which is very favorable for a company that's going to deliver mid to high teen EBITDA growth, growth multiple below its growth. Amazon certainly has come in hard, hasn't really done anything in terms of the last year in terms of the stock after the big run into COVID. So we think the setup, feels better now. You have multiples that are making more sense. You've got a 15 to 20% off sale in tech. And to your point, you saw Microsoft report, right? Things fundamentally were phenomenal. The CFO was like, everyone settled down on Wall Street. The world is not ending. Our fundamentals are great. And I think Amy Hood, the CFO of Microsoft, is one of the best. And she was out there, saying, look, guys, it's all clear. It's not as bad as you think. As you mentioned, you've seen some of these other great tech companies report, ServiceNow, a handful of others that have put up good numbers. So I think the fundamental backdrop is still very good. Everyone's worried about the COVID hangover. Do we digest all this digital environment, and are we going to go through a little bit of like digestion and hangover after we kind of went to the digital trade? And as the world reopens in the back half of this year, I think there's still some worry. Are there better opening trades? Like travel and Uber and other names that are tied to the reopening. So that's a theme in conversations we're having with investors, which we think will play out. But ultimately, I think things are pretty good. Amazon's situation is completely different, and we can talk about that, why that setup is completely different than the other tech names.
Hey, Brent. So I do want to get into the specifics later, but I guess on the macro picture, I mean, it seems like the Fed tightening is weighing certainly on this investment thesis, maybe getting out of the riskier stocks and just kind of going for more safe haven assets. But is there an interaction between the 10-year yield, for example, and these types of tech stocks? Because if anything, what we've seen is that the Fed is intent on wanting to steepen that yield curve to a level that's above the 180 basis points that we're seeing on the 10-year now.
Yeah, I mean, I think it's going to be hard for tech to work. A number of the banks on Wall Street have said, hey, are we going to see 3 rate hikes, we're going to see 5, or, like the numbers are all over. Everyone's got their opinion, but ultimately, I think higher interest rates are not good for some of these multiples and are not good for some of our names. If you look back in 2015, 2016, Workday went from 25 times revenue to 5 times revenue, right? So you've seen a material decel in the past when you've had, that happen. And so I think we're not out of the woods yet. I think ultimately it's going to be super choppy. Things are slowing, and everyone says, well, why does this matter for tech? If rates go higher and all of a sudden companies are tightening, the expansion, you're going to have a weight on, hey, how much do I need? Can I consume, right? Theoretically, if commercial construction slowed, right, you have fewer commercial companies spending on technology. So I do think this has an impact. But I do think a lot of these stocks are reflecting that. And as you know, right, these stocks are looking far ahead and reflecting that. We've seen the sell-off since November in a lot of these names. And so we're down, 20 to 30% plus. In some cases, we're down 50% plus on some of these names. And so I think, we think small and mid cap look really interesting. Large cap, maybe not quite as interesting. And you're seeing a lot of M&A come back in now. The private equity guys are licking their chops because now you got multiples below that at terminal takeout multiples. So I'd say, look, it's selective. We're not saying, hey, back up the truck on the group right now. We're saying be selective. And we think there's some really good stories that are opening.
Brent, really quickly, let's turn our attention to the 2 big names we're watching this week. Obviously, Google today after the bell, and then Amazon later this week. Google specifically, this is one of those names that could be a beneficiary as things really start to ramp up in terms of activity post-COVID, especially in their ad business as well. What's the particular metric you're going to be looking for? And then if you can couple that with Amazon and why you think investors should be looking at that name a little differently.
Well, Amazon's looked at differently because it's a people business. They have to hire so many people, and you can't automate manual delivery. So there's been a lot of concern about the costs and COVID overhang and all that. Google has people, but those developers are building code and then releasing it to the world. So they're more efficient in a higher margin business, right? So for Google, I think ultimately, it's driven off of what you said, the advertising environment. Our advertisers staying with this. We've heard, good feedback from advertisers. YouTube is crushing it with YouTube TV. You've got, all these call options and Waymo, Verily, the healthcare business. Their Google Cloud is doing phenomenally well. So we think Google's in a good spot. But remember, this stock does really well in odd years. As we say, embrace the oddness. Stock had a massive outperformance last year. And then in even years, it tends to digest those gains. We're in an even year. So embrace the oddness. Don't embrace the evenness, as we say. And so it's more of a digestion year for them. And the stocks tend to underperform. Again, don't shoot the messenger. That's just what happens in the last 10 years. So we think things are good. It's just the pace of the revenue growth and the pace of the margin improvement will probably not be as great as we saw last year as things bounce back from COVID. So steady Eddie, good story, cheap multiple. We like it. It's still one of our top large cap names. Amazon's got a lot more debate and concern than investors are worried about, especially around the human labor side of this, right? When they guided, they didn't guide to the additional COVID costs that we all saw in November and January. And if anyone's tested their family, they know how expensive this is and what a time suck and a hit on efficiency. So that's a big issue we're watching on Amazon. We've heard reports they're putting the air brakes on some investments, which I think is a good thing for bottom line. It should help the bottom line improve throughout the year. And so I think, strategically in a great position. I just think the question is, in the back half of the year, are we on Amazon more, or are we back out in malls, on planes, at beaches, doing things out in the wild as this thing passes? And I think many of our clients are still worried about, is this the right place for capital to go to work when the world's going to reopen and Amazon's perceived to be more of a closed trade than an open trade.
Yeah, and expense management, certainly the story for margin compression. It seems like top line's okay everywhere, but it's just making sure that you can handle those expenses well. Brent Thill, Jefferies Senior Analyst, thanks so much for stopping by. Well, on the other side of this break, we're going to turn our attention to the World Bank Group, where they have some thoughts on global economic recovery in the age of COVID and a market slowdown coming this year. We'll chat with President David Malpass on how tightening monetary policy also factors into that. We'll be right back. Welcome back. The pandemic remains a top threat to global growth, and the World Bank is now warning of a hard landing in developing economies that continue to grapple with the spread of the virus. The international body now projecting the economy to decelerate markedly to 4.1% this year. Here with some more color on that is the World Bank's president, David Malpass, who joins us live from Washington, D.C. President Malpass, it's great to have you on the program this morning. I want to ask you, what is the biggest threat to global growth faced this year?
Hi, Brian. Well, there's been weak investment. There's several threats. One is inflation. One is the rising interest rates in the advanced economies. But fundamentally, it's this huge challenge of how do they engage in the supply chain when they really don't have much investment capital coming in?
Can you elaborate that on a bit more? I mean, you've really highlighted this growing divide that we're seeing among emerging and advanced economies as well. I mean, some of those things that you hit on really do magnify that divide that already exists.
Hi, Kiko. Each of the challenges that the world is facing really are magnified for the poor. Take inflation. It looks like it will last longer than had been hoped. And as you look around the world, while the U.S. And some of Europe are really doing this huge government spending that boosts demand. For a lot of the world, there's pent-up demand. So as soon as there's room, they're going to be needing to restock their shelves. They don't have access to government bond markets that are robust. And so this is going to cause lasting challenges for the poor. And then add to that the likelihood of interest rate hikes that gets magnified because the poor countries often have to raise rates more than the advanced economies. They've already a third of the developing countries have raised their rates. And so that just makes it look like 2022 is going to be a long, difficult year. And I'll come back to that original point that there's not capital being allocated toward the things that will create sustainable growth into the future.
So President Malpass, how do those countries, those developing economies that are still grappling very much with the spread of the virus with lower vaccination rates, by the way, get that capital? How is the World Bank playing into that?
We do it somewhat directly, meaning we finance trade finance, for example, working capital finance at the short end of the curve. We've done quite a bit as the World Bank. We've lengthened the maturity of our borrowings, and then we're also working with countries so they can lock in the current low interest rates in what they owe to the World Bank in our portfolio. This is for emerging markets, for example. They can lock in fixed rates, and that might be a good idea in the current environment. So we can do some things like that, but frankly, they don't add up to as much as the challenge of will the advanced economies reorient their supply lines to draw from the developing countries and to allow working capital finance to go to those small businesses, new businesses, women-owned businesses. Those are being starved of capital really by the macro allocation in the advanced economies, the reliance on giant fiscal spending and the reliance on central banks that are really only using a couple of their tools rather than all their tools in order to grapple with inflation.
Now, what's interesting is that the fiscal impulse is still kind of necessary in some of these countries where more spending might be needed to get over the hump, especially of this Omicron wave. But at the same time, these are countries that are dealing with already large stockpiles of debt that they've accumulated through this crisis in what is also a monetary tightening environment. So how do you, as the World Bank, kind of advise them on making sure that your debt stock isn't too unsustainable, but then also making sure that you're doing the spending necessary to keep your economy afloat?
For a lot of the poorer countries, they don't have the luxury of choosing that. They're spending what they can on things like food, on education and health, on vaccines. We finance some of it, but the needs are really big. To give you an example, in 2022, with the expiration of the debt relief that existed in 20 and 21, the countries are facing. These are the low-income countries. 75 of the poorest countries are going to be paying $35 billion just in debt service. And so we can counter that with net flows from the World Bank, but it's just not enough to make up for all the money that's coming out of them to the creditors in the advanced economies. So you've got this double whammy. They're paying a very rich interest rate to the advanced economies at a time when the advanced economies themselves are borrowing heavily in global markets, huge amounts of borrowing from creditworthy countries, and that leaves no space for the poorer countries to have fiscal deficits or to have fiscal space in their economies. And the monetary policy can't be ignored. This idea of central banks buying duration and holding duration really alters the capital allocation in the world in favor of overcapitalized parts of the global market. So you get this. What the world needs is capital to flow to working capital, to the short end of the curve, to floating rate instruments. Instead, it's going in the opposite direction to these really long duration fixed rate instruments that the central banks are buying heavily. Even under the taper, they're going to still be major buyers of duration because they're trying to maintain the size of their portfolios even when they taper.
Let's pull back a bit here because we're talking about a global recovery in the context of the pandemic still. To Brian's point, the latest Omicron wave has only made things worse. You look at the vaccination rate, it's 70% full vaccination for advanced economies, just 5% for low income countries. I mean, how much of this recovery broadly can actually happen, especially in poorer countries when they don't have the basics here to get things back open again?
Yeah, it's been welcome that the supply has increased from the advanced economies and also from India. You know, there were obstacles in 2021 with the supplies staying in the advanced economies in India. So now that those are freed up, but it comes at a time when some of the developing countries have hesitancy. So we work very hard on deployment, on helping the countries have the capacity and the desire, the actual intention to contract for vaccines and to bring them in. We can finance a lot of that, but just not enough as your numbers show. We work closely with the international community, and some of the efforts have been quite successful. We worked closely with the African Vaccine Alliance, AVAT, and that we were able to get a lot of contracts for deliveries into Africa, and so that's helped a lot, and that's one of the work streams into 2022.
World Bank Group President David Malpass, really appreciate you taking the time today. Good to talk to you, and hope to have you back on the show again soon. Coming up, Tom Brady breaks his silence, officially announcing his retirement. We're going to be breaking down Brady's accomplishments on and off the field and how he's grown his brand. That's coming up after the break. Well, it is the end of an era with Tom Brady officially announcing his retirement today after 22 years in the NFL, 7 Super Bowl championships. Considered the greatest of all time, he's also set himself up for his post-NFL career with his own brands like TB12 and his new clothing line, Brady. He's also got investments in the crypto world. To discuss more about that, let's bring in Yahoo Finance's Josh Schaefer. Josh, I feel like we need to kind of take a step back and really look at the accomplishments for Tom Brady. I know, this was kind of expected, but 22 years in the league is pretty unprecedented.
Oh, it's absolutely unprecedented, Kiko. And you can start by just highlighting what Brady did this season at 44, the oldest we've seen a quarterback succeed to this level. He led the league in passing yards and passing touchdowns again and might win the NFL MVP in his final season, which is pretty crazy to think about. They went to the playoffs. He nearly led them all the way back to continue in the playoffs when they just lost to the Los Angeles Rams, who are now in the Super Bowl. So Brady was still playing at a very high level up until the end. And I think that that's kind of the most impressive part here. He finishes as the NFL's all-time leader in passing yards, touchdown passes, and quarterback wins. And just to hit on kind of part of what he said in his retirement, he basically talked about not wanting to he can't make that competitive commitment anymore to football. And I thought that that was kind of an interesting point for him to make. It seems like there's a family-oriented part of why Brady's retiring. I think he's ready to just move on. He's certainly, as we said, he's accomplished a lot, including kind of off the field as well. So in total, he made $293 million per sport track via NFL salary. But then he's also made more than $160 million per Forbes with his endeavors off the field. So that's almost 400 or a little bit over 450 million total. And that starts with the brands that are on the screen now. He founded TB12 with his body coach, Alex Guerrero, in 2013. And since then, he's moved in kind of away from the typical wellness space and moved into some more recent brands that are different now. So he founded Autograph, which is an NFT company, which has worked with DraftKings. He's founded the Brady brand, which is more of a clothing company. And he has a stake in FTX and all those crypto commercials we've been watching all football season. And so in his statement today that he released on Instagram, he touched on sort of what his plans are for the future a little bit. I think he's probably still processing that. But he said, quote, "The future is exciting. I'm fortunate to have co-founded incredible companies like Autograph, Brady Brand, and TB12 Sports that I'm excited to continue to help build and grow. But exactly what my days will look like will be a work in progress." So it seems like it's a little bit up in the air. Hopefully we'll know more from Tom soon on what's next. I'm sure there'll be the final episode of the ESPN Plus series that he's been working on. We've been waiting for that 10th episode. We were talking about it yesterday. I'm sure that will probably include part of the retirement. And a final thing I wanted to hit on here, I know you guys are going to be doing sports betting in a second. We love covering sports betting here at Yahoo Finance. So we took a look at Tom Brady against the spread throughout the years versus his straight up record. Not as good against the spread and wasn't as easy to bet on as you would have thought, actually. So Brady was 243 and 73. So pretty much he was winning 3 out of every 4 games in the regular season. But against the spread, he was 184, 123, and 9. And in the postseason, he wasn't as consistent against the spread either, almost being 500. When he was so dominant all those years, I think a lot of what we remember Tom Brady for and what fans attached him for were those comebacks. But when you're gambling, that doesn't help that much because he's not covering the spread, even if he wins. So kind of interesting to see that maybe the best athlete, best quarterback of all time wasn't the easiest guy to gamble on.
Yeah, it's important to remember, right? When you bet, it's not just about a win or a loss. There's much more to that. Josh Schaefer, thanks so much for that. I know you're going to be covering this story throughout the day here on Yahoo Finance. Well, Brady may be out of the NFL playoffs, now retired, but the NFL games have really helped fuel growth in the gaming space, especially with the addition of New York. New York online sports betting estimated to exceed $1.1 billion in 16 days. Let's bring in Chad Beynon, Macquarie analyst. Chad, let's just talk about that a bit because, we're talking about Tom Brady today, of course, but certainly the inclusion of New York here, really, they timed this perfectly. And the NFL games have really only added to that, just given how tight the games have been. I mean, talk to me about the growth that you have seen in the potential to come.
Sure. Thanks, Kika. So right now, roughly half the United States can bet on sports betting, either in a retail or online fashion. New York, which was expected to come in right ahead of the Super Bowl, actually came in better than expectations in terms of delivering this product to the consumers in the state. The numbers that we saw January to date were astounding, as you mentioned. The way that we think about things is the average American adult will gamble roughly $50 per year. So we look at the population of states and then we multiply that times $50 and that gets us to our market forecast. What we've seen out of New York right now tells us that New York will probably exceed that 50. As you mentioned, there's about 20 million people in the state, so probably 15 million adults, and we can probably get over 1 billion. But the numbers were very strong. The numbers were also strong outside of New York and other states in the fourth quarter. that has led us to actually move our revenue estimates higher for all the companies that are exposed to this sector. Unfortunately, similar to what we've seen with the software space and high growth stocks, the stocks exposed to this high growth industry have fallen precipitously in the past couple months here.
Hey, Chad, it's Brian here. I guess my question is, even though the rising tide is lifting all the boats because all of these markets are now opening up for these companies, who's the bigger winner, at least what you saw from New York? Because it seems like it was a promo bonanza, if you will, people trying to outbid one another to onboard these first-time customers in many cases. Who was the big winner in New York, and what does it mean for the companies that maybe lost a lot of market share or didn't get a lot of market share in that first onboarding? Are they going to be left in the dust for forever?
Sure, well said. So, generally what we've seen with state launches is companies offer anywhere between $200 and $1,000 in terms of acquiring the customer through free bets or deposit matches. Caesars Entertainment had a very aggressive promotion. So it was a $3,000 promotion, plus I believe a $300 first bet match. So people who were willing to deposit $3,000 could place a bet, that day. If they won, they could essentially take back the bonus money that they were being offered. So it was a very aggressive marketing and promotional launch. So we expect for the companies that are exposed to New York at this point to lose money in the near term from a customer acquisition standpoint. Now, in terms of market share, DraftKings, FanDuel, and MGM have been the leaders in the space for most of 2021. Caesars Entertainment, ticker CZR, was a little late to the game, just given an acquisition that was going on. They have over 40% market share for wagers in New York. And as you mentioned, a lot of this has come through promos. So the big question is, do they have the technology and the really the connection to retain these customers, to keep them on the digital site, and then maybe improve the omni-channel experience, sending them to Las Vegas and their properties around the country?
Chad, let's look ahead to the Super Bowl. Obviously, LA hosting the big game, but we're talking about this being held in a state where sports betting has not been legalized yet. And how big of a potential do you think that market holds? And how quickly you think things could move?
Yeah, we definitely expect for the wagers on the Super Bowl nationwide to break any record that we've had, obviously, just given how many people can legally bet on sports. California is an interesting market from a land-based casino side and a potential digital side. In 2021, several of the companies involved in sports betting contributed to a fund to try and get sports betting legislation on the 2022 ballot. So most of the companies actually contributed about $10 to $15 million to get there, collecting signatures, and then you go to the next step. Now, what's complicated about California is there's a big tribal presence on the land-based side. There's also card rooms. There's not traditional commercial casinos like we know with MGM and Caesars and Penn National. So it is a little bit of a tricky state. Obviously, we're looking at the deficit, what it can bring to the state, and the numbers that we've seen in neighboring states like Arizona, again, similar to New York, have been very impressive. So we're projecting that California goes live in 2025, but California, New York, Florida, and Texas, the big four states in the U.S., are certainly big drivers of our model. But yes, as you mentioned, people won't be able to legally gamble in the state during the Super Bowl when it's hosted there.
Chad, real quick, it's not a gambling company, but investors might be treating its stock like a bit of a gamble. I want to talk about AMC here. That stock has actually done pretty well as of late. Again, the meme stock's still getting a bit of volatility after a year's anniversary that we're facing from the GameStop mania last year. What do you see on that front?
Sure. They pre-announced fourth quarter revenues and EBITDA this morning. What we saw for the industry was sequentially Q4 versus Q3. The industry grew about 50% in terms of admission revenues. Most of that was on the back of a very strong Spider-Man release. What we found in the data was the top 10 movies accounted for 80% of the box office. So this theory of the blockbusterization and really most people just going to a few headline films instead of kind of the tail is certainly playing out. AMC's result from a revenue standpoint was slightly better than expected. I think they gained a little bit of share in the quarter. What was really impressive was the operating leverage. They had margins of 13% on the third quarter call. They said that EBITDA in this kind of scenario where revenues would be essentially what they were, would be break even. So it was a strong EBITDA beat. This doesn't change how we're thinking about 2022. People are still a little unclear in terms of why they pre-announced this morning. Is there something going on behind the scenes on the debt side, the deferred rent side? So more to come on that, but it was nice to see that they put up a nice Q4 print.
Macquarie analyst Chad Beynon, always good to have you on the show. Appreciate the time. Coming up, Ukraine is beefing up its military, even as the country's president maintains a Russian invasion is not imminent. The latest developments on that front and much more in our worldview after this break. In our worldview today, Ukraine is beefing up its defenses, adding 100,000 additional troops to its military and raising pay for soldiers. The expansion is set to occur over the next 3 years. The commitment comes as Russia builds up its military presence along Ukraine's border, but President Vladimir Zelensky has pushed back against U.S. warnings that a Russian attack is imminent. Meanwhile, Russian Foreign Minister Sergei Lavrov is set to speak with Secretary of State Antony Blinken again today. The State Department confirmed on Monday it had received a written follow-up to discuss Russian demands for NATO and its allies to reduce their presence in the region. Over in Myanmar, silence on the streets as the country marked 1 year since the military coup. Activists held silent strikes, urging businesses to close in protest of the military government despite threats of arrests. And Yangon, some took their protests public, chanting anti-military slogans early this morning, while others marched in support of the ruling government. More than 1,500 people have been killed in pro-democracy protests since former leader Aung San Suu Kyi was removed from power. Nearly 12,000 demonstrators have been arrested, according to the UN. Outside of the country, the US, Britain, and Canada imposed new sanctions, calling for arms sales to be halted to the country globally. And yet another journalist has been killed in Mexico, making this the fourth murder in roughly a month. A photographer for the local website, Monitor Michoacan, was murdered in the city of Zitácuaro. The director of the website said the shooting followed months of death threats brought on by reporting on government corruption. The victim, Robert Toledo, was filming a new video column for the site when 3 gunmen attacked. Well, coming up, we've got much more on market action on the day. All 3 major indices in the green, but trading pretty flat right now. Much more to come here on Yahoo Finance Live. We'll be right back.
Welcome back to Yahoo Finance. 12 minutes until the hour here on Yahoo Finance. Let's get a market check on what's going on with Yahoo Finance's Jared Blickery. Jared, I'm seeing some green across the board. What's the update?
Some fledgling green, not a whole lot going on in the indices. Russell 2000 here, that's up about 0.5%, but the Nasdaq up about a third, S&P 500 and the Dow up 14 basis points. Europe just closed. By the way, we see the CAC 40 in Paris, that's up over 1%. The DAX up about 0.75%. But let's check out the U.S. markets. And not a whole lot going on in the indices, but that's because we are at some key levels right here. S&P 500 all the way up to about 4,600. Just shy of that is a pretty big area. This is a 2-month chart, and we have the high here, we have the recent low here. Anything in between here is an ideal setup for a short. So if we can get to 4,600, probably going to retest these highs, see all-time highs again. Be nice to say that, but otherwise probably not. In fact, I would expect those lows to be taken out if we start heading back down. Now, Nasdaq 100 also at a pretty big level, 15,000, big psychological level. And let me show you the 200-day moving average. This has been in play, and we see it's just hugging up against it right now. Let me show you the S&P 500. one more time because we did manage to clear it yesterday. So clearing some technical hurdles, but we still have a little ways to go. Also want to check out the VIX. Now, the VIX is coming down quite sharply. You can see it was all the way up to almost 40 just a week ago, and now it's heading back down into the lower 20s. But let me take this off and show you a 3-year chart of the VIX. And this right here, I think, is pretty important. We have a series of lower highs, and guess what? Those highs are increasing now. So the next question is, when are we going to get back up to 50? Probably going to happen sometime this year. So we got to be prepared for that as the Fed takes on its hawkish tone. 10-year T-note yield hugging its recent highs here, back up to 1.8%. And now let's get to some heat maps. We have the Nasdaq 100, a lot of green here. Well, this is energy. Let's just start here. Exxon Mobil up 6%, Chevron up almost 3%. A lot of green on this board right here. And energy, the big leader, again, one more time today, XLE up 3%. Let's take a longer term view of XLE as well. This is going to be a 5-year chart because we are about to clear some pretty big levels here. This area around 60 has been in play several times. We managed to clear it, came back down, and now we are racing higher. So on a longer term basis, very bullish. In fact, just about every time frame, very bullish. Let me show you a max chart as well. That's a lot of sideways action over the last, let's say, 20 years. But with the recent developments here, probably going to head up and test what would be about the 70, 75 area. So I'd be watching out for that. I did mention the NASDAQ, so want to get to that as well. And we see Apple under a little bit of pressure. We do have Alphabet and also AMD earnings after the bell. So we're going to keep an eye on that. But nice to see a little bit of green, at least in the tech space today.
All right. Chevy, Chevron, what's the difference? They're both oil, gas related anyway. Yahoo Finance's Jared Blickry. Thanks so much. Coming up on the other side of this break, investing in Hollywood. We're breaking down Apollo Global Management's $760 million deal with the producer behind major hits like Dune. After the break, we'll be right back.
All right, welcome back to Yahoo Finance Live. Private equity powerhouse Apollo, which of course is the parent company of Yahoo Finance, is making a $760 million investment in Legendary Entertainment. Legendary has produced and co-financed top-grossing box office franchises such as Dune and Godzilla vs. Kong. For more on the deal, let's bring in David Samber, partner and co-head of Apollo's private equity business. David, nice to see you here. Big deal for Apollo. Why'd you make the deal?
First of all, thanks a lot for having me on. It's good to be here. I don't think this is necessarily an out of favor view. I think everyone that's watching this is probably engaging in streaming media in some way, shape, or form, but there's been such an explosion of demand for premium scripted content that this has been a big theme of ours that we've been trying to invest behind. And this deal is a very Apollo-esque way of doing it. It's partnering with an industry-leading business, but in a way that is downside protected, creatively structured. But it all does start with the quality of the team, Mary Parent, Chris Albrecht, and of course, Josh, the CEO, and this amazing marketplace and demand for premium scripted content.
David, is this more a play on the outlook for streaming over the next decade, or more so the return of the box offices?
So I think for this business, they've been able to really navigate the changing landscape quite well. This business is a producer of content that could go either through the theatrical window or the streaming window, and in many ways is a beneficiary of streaming. So we'll benefit regardless. And I think this is one of these deals where it's quality over quantity. If you look and you can see some of the titles that are up there, these are some of the most well-known pieces of content that have been produced. And Dune's a great example of something that has substantial value in the theatrical window, but also has value in the streaming window.
We've seen a lot of, to your point, we've seen a lot of movement in the space recently at Blackstone and Candle, but their bet seems to be more of a naked bet on growth. How is this different?
Yeah, I couldn't have said it better myself. I think that's an interesting way to think about it. Legendary's got a very valuable library, and that library provides a nice stable base of cash flow upon which to invest and grow the business. Our capital is coming in to support the growth of the business, all of the new content that's going to be produced for the various streaming platforms. This is a world-class business. It's what I wouldn't say is kind of a bet on growth per se, even though there is a lot of growth. It's a different type of business in that this business, again, has a very valuable in-place library that we're financing, and then has this upside optionality around growth. So it is a little bit of a different way to play somewhat of a similar trend, but again, in a way that is very consistent with our way of investing, which is downside protection with real upside participation.
I found it interesting, David, what you guys noted in the press release here. You see the opportunity for M&A to bolt onto this. What might be attractive here?
So there clearly is a consolidation happening in production. I don't think that size and scale in and of itself is required. If you think about the streamers, I do believe that you're going to see continued consolidation on the distribution side. And you're seeing that, with the Warner Discovery deal, for example. And I think over the next several years, you'll see more examples of distribution consolidation where it makes sense. I think on the production side, being bigger could help. And we're going to partner with the management team to find ways to consolidate the business. But this is really also a quality play. It's that real premium branded content, things like Dune, things like Jurassic World, things like Godzilla, that Legendary can provide, that's becoming more valuable and more scarce. If you think about, for example, new subscription signups for streaming, it's been well documented at this point that the occasion that drives the largest amount of new streamer signups are big tentpole releases. Things like Dune, for example, drives tremendous engagement on a platform like HBO Max. We develop and produce and package up that content in partnership with streaming partners, and that's in more demand than it's ever been. So it's really size helps, and I think scale will make this business better, and we're happy to partner with the team to find scale, but it also needs to be quality.
Well, speaking of scale, David, Apollo is starting to become a major player in media. Of course, this transaction with Legendary, of course, the transaction with Yahoo, also Cox. Would you ever consider combining all these assets under one roof? And then how does the knowledge share work inside the companies?
Yeah. So media has been one of the key verticals that we've been investing in for the past 31 years. We've owned, for instance, Charter Communications, one of the largest cable MSOs. in the country. We owned AMC Theaters twice. We currently own Cox Media Group, a large television broadcasting business. And then, of course, you mentioned Yahoo. I think when we think about our portfolio, the insights that we derive from these businesses and the relationships we have clearly add value to each individual company and add value to our ability to source, underwrite, and structure these transactions. I don't really think that you would see these businesses being combined per se. The only reason to combine these businesses or any of our businesses would be if we ultimately thought it made the individual businesses better and probably help them go public or be exited from a capital markets perspective. But I do think there are opportunities for some of these businesses to share with each other. For example, could Cox Media Group's broadcasting assets potentially benefit Yahoo? Could Yahoo Finance or other types of Yahoo media content, produced content, be utilized in Cox in their analog broadcasting business? So I think where there are abilities to create linkages, we're very happy to do that and create win-wins for our portfolio companies. But when you think about each one of these platforms, I think we all know that Cox is going to be a broadcast business. Legendary is going to be a premium producer of scripted film and television content. But the ability to provide value behind the scenes, I think is something that we're able to do as a large institutional owner of these businesses.
And lastly, David, of course, this deal comes really before we get that changing backdrop of higher interest rates at some point, whether that's in March or the months after that. What's your take on how those higher rates might impact deal activity?
So for deal activity, I think it's a little bit complicated. I think in general, volatility is not a friend of deal markets. But we're in this phase now where the credit markets have been much more resilient than the equity markets, which I think for us at least creates an interesting paradigm where the value of companies that we might have been looking at has re-rated negatively, which is a benefit to us as a buyer, and then financing markets still are solid. So as I look out at our pipeline going forward, I'm actually quite excited about this type of volatility, which reduces the value of companies from an equity perspective. And we still, if we have a long-term perspective and we're comfortable investing in periods of volatility, which we are at Apollo, creates an interesting deal dynamic. But I do think that if the first 30 days of the year portend the future, we're all in for a little bit more of a bumpy ride, which again, for us at Apollo, we like. We're quite comfortable investing in periods of volatility.
All right, we'll leave it there. David Sambar, partner and co-head of Apollo's private equity business. Good to see you. We'll talk to you soon.
Thanks a lot for having me.
All right, do stick around. Much more ahead on Yahoo Finance Live.
Welcome to Yahoo Finance. It is the noon hour, 12 p.m. here on the East Coast. I am Brian Chung. That's Akiko Fujita. Let's take a look at markets as we head into the PM hours here. S&P 500, the Dow, and the Nasdaq all green after starting off the morning a bit in the red. So a nice rebound so far, although only really just barely in the green. The Dow up about 0.05%, and the S&P 500 also just edging barely above where it closed yesterday as well. Coming up in the show, we've got Senate Banking Chairman Sherrod Brown of Ohio joining us to chat about a proposal to ban trading on Capitol Hill. We'll also ask him about the slate of President Biden's nominees coming up for the Federal Reserve. And then we'll take a look back on the one-year anniversary of GameStop mania with lessons learned for retail investors. We'll chat with the co-founder and CEO behind Tornado, a trading platform that has front-row seats in the retail game. But first, let's shift our attention over to the pharmacy space with a focus on Pfizer, the company expected to ask the FDA to authorize its COVID vaccine for children under 5, a big development. And for more on this, we have Yahoo Finance's Anjali Kamlani with the details. Anj?
That's right, Brian. We know that, of course, Pfizer has been planning to get their emergency use authorization request into the FDA soon. We heard from Pfizer CEO Albert Bourla earlier in January saying that he hopes to submit those details in the next few weeks rather than months. We also heard from the company that they had still needed to collect more data, and that was likely to come late March. So what's happening right now is that they're in touch with the FDA, and the FDA is really pushing for that request to come in sooner, preferably this week, as early as today is possible. But what we did hear from the company is that they're still working on collecting that data. And a quote to us: "At this time, we have not filed a submission, and we're continuing to collect and analyze data from both 2 and 3 doses in our younger age cohort." Now, that, of course, is because they found earlier, late last year, rather, that the 2-dose vaccine was not as effective for that under 5 group. And so they're looking at a 3rd dose. And the FDA's sort of thought process is that either way, if they do need 3 doses, it will take time, as we know, the way that adults have boosters and the time span between. So in the meantime, while that data is collected, to at least start the process of the 2 doses for the kids and wait for that data to come in time. So that's where things stand right now. We have not yet heard of a filing, but of course, staying tuned for that.
Yeah, Anjali, I feel like over the last 2 years, we've become increasingly familiar with the process of filing for emergency use authorization. But there's a lot of parents who are watching this saying, when can I finally get that vaccine for my child? What's the timeline look like once this is filed?
Well, if it does come as early as this week, we could potentially see an end of February or early March start, just depending on how quickly the FDA goes through the process. We know, of course, that it will require both the FDA and CDC sign off, especially for those guidelines. But this is definitely a little bit different from the earlier set because they're willing to go ahead sort of before all of that data comes in. So that's going to be really interesting to see how it all pans out. And of course, Pfizer being the only one that is at this stage does really put a lot of pressure on them. I want to point out, too, that in that 5 to 11 cohort of a patient population, there haven't been that high an uptake. Right now, some information shows that it's sort of stagnant at about 20% of the eligible population getting vaccines in 5 to 11. So that shows that there is still some hesitancy. And while, to your point, yes, there are 5 and under parents waiting, there are also others who are still kind of hesitant. So it's going to be interesting to see how this all pans out, and especially with all this, with the knowledge that this is being pushed, by the FDA and by health officials, to see how that plays out.
All right, Yahoo Finance's Anjali Kamlani, thanks so much for breaking all that down for us. Well, as mentioned, there's a lot of focus on Capitol Hill this week, especially with some nominations for some key positions at the Federal Reserve, the nation's central bank. So let's talk with one of those key policymakers on Capitol Hill, Senator Sherrod Brown of Ohio, also the chair of the Senate Banking Committee, joining us live on Yahoo Finance this afternoon. Senator Brown, it's great to have you on the program. There's the big hearing for 3 Fed governor nominees on Thursday: Lisa Cook, Philip Jefferson, and Sarah Bloom Raskin. And the last name is very important for that vice chair of supervision role, arguably the most important bank regulatory position in the land, but it seems like there's some questions about how aggressive she may be on the Federal Reserve's policing of climate risks in the financial industry. Just wondering if you expect that hearing later on this week to be a bit contentious.
Well, it will be contentious, even though these are three of the most qualified people ever nominated for the Federal Reserve, even though this will be the first time that in almost a decade where the entire Board of Governors, the entire 7-member board, will be seated. President Trump never really made much effort to fill out the complement, and President Biden is. But she looks at it as an economic issue, the same way that Chair Powell does, and the Republican members of my committee and the Senate as a whole generally love Chair Powell. He's said that we need to move on climate. We need to roll in risk and understand and assess risk brought on by climate. So whether it's lending to businesses or whether it's lending to someone to buy a home and it's in a floodplain, all those issues are something that banks need to consider more fully than they have. That's what Chair Powell wants to do. It started to do. That's what the future Vice Chair Raskin wants to do as a Fed Vice Chair of Supervision, as a Fed governor.
Senator, we've seen also some of the Republican talking points that they plan on bringing up on Thursday with regards to the other nominees as well, specifically Lisa Cook, the professor from Michigan State. They're kind of trying to tee up, I guess, maybe some scrutiny on her qualifications and her resume on specifically monetary policy. But at the same time, I guess I'm just wondering at large, the Democrats have the majority in the Senate. It's a thin one, but is there any reason to think that either Lisa Cook or any of these nominees are in danger of not making it all the way through confirmation?
No, we're going to confirm all three of them. I would assume almost all of them will get a significant number of Republican votes in the end. With Lisa Cook, it's, she doesn't teach at an East Coast Ivy League school, and I think that bothers the sort of elitists in the Republican Party, that they want Ivy League. They don't even care if they're economists, Ivy League lawyers. She's a PhD in economics. Not nearly everybody in that board, including Chair Powell. And I will vote for Chair Powell. I voted for him when Trump nominated him. I voted for him when Obama nominated him. I support him. Nobody says he's less than qualified, but she has a PhD in economics. He doesn't. I mean, these are very qualified. I'm sure that some Republicans are bothered because this is going to be a diverse board. In the history of the Fed, there's only been 3 African-American men on the Fed board out of 7 nominees, 7 seats over 100 plus years. Professor Jefferson will be the 4th man. Professor Cook will be the first Black woman. So this board will be diverse. It will be more diverse in its thinking. They have great expertise in study of poverty and study of race in labor issues, especially. And I like those voices on the board. So we will have a diverse board in gender and race, but equally important, we'll have a diverse board in terms of life experience as an outlook and empathy. So I'm thrilled about this. The president made 3 really good appointments. We will finally fill out the 7-member board again for the first time in a decade. And if we're going to fight inflation the way the Fed needs to, you need all 7 people in place. And that's why I'm going to work to get these done as fast as we can.
Senator Brown, it's Akiko here. Good to have you on again. Want to pivot here to another issue that you've been obviously leading on, which is this move to ban stock trading among lawmakers. It feels like there's a lot of momentum here from both parties. I know you introduced a bill last year, but we recently had Senator Mark Kelly on, who said that it's not enough to ban stock trading among lawmakers and staffers. It's got to extend to family members as well. Is that something you'd be on board with?
Yeah, I've been on board with that. I first introduced this bill as an amendment and then joined Senator Merkley on a bill almost a decade ago. The Congress passed a pretty weak bill that kind of required reporting, but too many members of the Senate trade in stocks, and their spouses do. And I don't accuse anybody individually of a conflict of interest in betraying the public interest, but the temptation, if you own shares of stock, Everything looks like a conflict of interest because we vote on everything in the Senate. We vote on banking rules, we vote on environmental rules, we vote on labor rules, we vote on wages, sometimes minimum. So there are all kinds of conflicts, and we need to write the strongest bill that we can get a majority of senators on. And it will be a challenge because a number of senators, especially Republicans, have complained about this, and there are a lot of people in the Senate that hold a lot of investments, and I'm concerned. I'm also concerned. Don't forget about the Federal Reserve. We know about some compromise, if you will. I was almost going to say betrayal of public trust. I'm not sure I'm going to go there, but we've had Fed presidents around the country. A couple resigned probably because of this. They were doing stock trading. There was a senator from Georgia. One of the reasons, the unwritten story, really, of one of the senators from Georgia that Senator Ossoff beat and gave the Democrats majority in the special election the runoff in early 2021. He made thousands of trades while a member of the Senate, buying and selling, and the other senator incumbent who also lost did some significant dumping of stocks. And that's just, you're here for public service, not here to enrich your portfolio. If you want to make more money, stay out of don't run for the Senate, do something else. And I just think we have a public trust here.
Senator, you mentioned Republican senators that are kind of opposed to this move, but if you look over to the House Speaker Nancy Pelosi has come out publicly and said, look, it's a free market. It's very well known in terms of the trades that her husband conducts as well. He's got quite a following. So I wonder what you think the compromise is going to look like. It feels like there's an agreement that something needs to be done, but the extent of the ban seems to still be in contention.
Yeah, well, I'm not going to negotiate here. I'm meeting today with a number of people that support this, and we will work to get something significant through the Senate. It won't be exactly the bill the way that I introduced it, or Senator Ossoff or Senator Merkley, but we need to move, and we need to include the Federal Reserve in it, and we need to include not all family members. Not grown children, but we need to include spouses in these rules.
And Senator Brown, lastly, there's a number of hearings that you have on the docket in the Senate Banking Committee. It caught my eye that there's going to be a hearing on stablecoins with regards to the President Working Group report on that. That hearing will be happening February 15th, I believe it is. What are you hoping to glean in that hearing, and what is the next steps in terms of a possible legislation down the line for how the Congress might want to regulate that space?
Well, first, many of them are operating as financial institutions, but without coming in under the rules. So we want them to explain why they, number one, why they aren't under consumer protections or investor protections. And we also want them to explain why they're not a risk to the financial system as a whole. What this place has done with bailing out the banks is pretty has turned a lot of people off from politics generally. And I don't want crypto to get in the same position. So right now, though, there are a number of regulators. The Federal Reserve's interested. The SEC, Gary Gensler, is leading on this. I've spoken to the FDIC. I've spoken to OCC. I speak to the Consumer Bureau, Financial Consumer Protection Bureau. All of them have some role in some part of crypto to bring them so that the investors are protected, consumers are protected, and the financial system overall is protected. So that's my responsibility as chair of the Banking Housing Committee. It's also SEC's and these other agencies' responsibility to step up as they are doing as a group, and I think in a pretty progressive, pretty direct way.
Senator Sherrod Brown, appreciate you joining us today, the Senate Banking Committee Chairman. Well, coming up, the Great Resignation rolls on. We are breaking down the latest economic data as December job openings hover near a record. We'll be right back. Well, job openings ticked higher in the month of December with 10.9 million job openings posted, according to new data from the Labor Department. Meanwhile, new ISM manufacturing data pointed to a slight slowdown last month, marking a third straight month of declines. But prices actually pushed higher, rising nearly 8 percentage points. Let's bring in Dana Dioria, Investnet PMC co-CIO. Dana, good to talk to you today. I want to start on that last point there because it is still the same story here when we're talking about prices continuing to pressure or to move higher as well. Give me a sense of where you think things are headed. We've rounded out a really choppy month, and it looks like today things aren't necessarily picking back up.
Yeah, I don't think it's a huge surprise. Thanks for having me, Kiko, by the way. I don't think it's a huge surprise to see this. Obviously, we would expect Omicron to start sifting into the data. We know, China zero COVID policy. I mean, we know that the supply chain is still experiencing problems. Inflation is one of the results of that. We know also that labor shortages are impacting. So I don't think a lot of surprise here. We had nice growth in the fourth quarter, but that was inventory buildup for the most part. We're still going to have to be working through some weakness.
Hey, Dana, Brian Chung here. So how does the investment thesis kind of fold into that right now? Obviously, through the volatility, people are having difficulty trying to find the positioning here. So are there certain sectors, industries, companies that you're favoring in this environment?
Well, I would have to say that energy is the most consensus call at this stage of the game. And certainly the news now with Russia and Ukraine and the potential for sanctions on Russia, which is, of course, going to hit energy, of course, drives prices up and potentially you get a bump there. So it's been a consensus call. And I think short term, that's only strengthened. That being said, over the long haul, we're obviously going to have to deal with structural changes, Biden continuing to move forward on plans for ESG and things that can hurt that sector. So, short run versus long run, I guess. I'm still also a fan of the cyclical, the value over growth. I think we have a ways to go on that still. We did see some movement in the spreads, obviously, over the course of the last month, but I don't think that's all we will see.
I mean, to your point on energy, I'm looking at shares of Exxon hitting a new high in the session today on the back of a really strong quarter for them, obviously correlated to higher gas prices. We've had guests on who've said they think that oil could go to $100 a barrel. What do you see there, and how are you playing the space?
I won't make a prediction on exactly how high it goes. I think obviously a lot depends on what happens with Ukraine and Russia. It's kind of a no-win for Biden on this, I think, because if we avoid conflict, then everything kind of stays as is. I think if we have conflict, it's very difficult for him. It hurts his agenda. It increases inflation, makes it again harder for him to do Build Back Better. So I think you're going to see a lot of effort on his part to try to keep conflict down and prevent this. And then maybe that works against energy a little bit, right? Relative to where it's being priced right now. But remains to be seen.
A lot of political headwinds for sure, but Dana Dioria over at Investment, thanks so much for breaking all of that down for us. Coming up on the other side of this break, the streaming wars wage on. We're breaking down how Peacock over at NBC is aiming to go for the gold during the Beijing Winter Olympics. Next. Well, political headwinds have dampened the enthusiasm over the coming Winter Olympics, but they're really actually starting 3 days from now. In fact, I think some of the preliminary events are starting tomorrow, but the event could be critical in the streaming wars space where NBC's Peacock is looking to ride the wave and onboard some more viewers. So let's bring in Yahoo Finance's media expert, Ali Canal, for a little bit more on the trends that we should expect to see from the Winter Olympics. And Ali, I'm not an Office fan, so I don't have Peacock, but is NBC's expectation that a lot of people will sign up that they can watch some downhill skiing events during the Olympics?
I mean, they're hoping, Brian. I mean, the entirety of the Olympic broadcast will be available to stream on Peacock subscription tiers. And relative to some of the other competitors, it's not too bad. It's not going to break the bank. You can watch it with ads for $4.99 or without ads for $9.99. But Peacock is really hoping to learn from the Tokyo Olympics, where viewers had a really hard time watching some of these events. There were even reports that many subscribers were confused if the events were even available on the streamer, and that turned a lot of people off to the service, which was a huge blow to Peacock's business. So Beijing is going to be a really important turning point for the company, because when you compare Peacock to some of the competition, it's just been slow to gain traction, slow to lure subscribers, slow to really make those big headlines. Last week, Comcast came out and noted the amount of subscribers that Peacock has. They said over 9 million people were paying to watch Peacock. And then, of course, Peacock is also available for free to existing cable and broadband customers. An additional 7 million of these customers use Peacock regularly. But those numbers, they're just kind of puny. When you look at Netflix, it has 222 million subscribers. You have Amazon Prime Video, 175 million. That Disney bundle with Disney Plus, Hulu, ESPN Plus, 179 million. So, I have to say here that Peacock has to step it up. Now, heading into this month, they do have some big content. Of course, they're going to be airing the Super Bowl on February 13th, obviously huge. We also have Bel-Air, that's the new Fresh Prince of Bel-Air reboot. That will be out the same day as the Super Bowl on February 13th. We have a new movie coming out with J-Lo, Owen Wilson, called Marry Me. That will stream on Peacock. So we have some bigger name shows and movies. And then, of course, they're really leaning in to the live events, the live sports. And that's where I think Peacock can really create its own little niche. I don't think they are the next Netflix or the next HBO Max, but perhaps they really just lean into live sports. That could be what differentiates them in the streaming wars. And we know how competitive that is right now.
Ali, this talk of the Olympics just reminded me, I did in fact sign up for Peacock during the Tokyo Games and then just canceled it a few days later. I just didn't need, the payoff to me wasn't there. But it sounds like I'm not the only one, because we're seeing increasing churn here, right? Among streaming services who are finding that people are doing exactly what I did, sign up to watch something and then just cancel a month later.
You are definitely not alone there, Kiko. In fact, the Wall Street Journal had a really comprehensive piece about how difficult it is for streaming giants to retain these customers even after big surges. So let's start with Disney Plus here. We had Hamilton debut on the platform during 4th of July weekend 2020. There was this massive surge, far more than any other point of the year. You can see it right in your screen there. In a similar vein, let's look at HBO Max. One of the big standouts there was Wonder Woman 1984. This was exclusive to HBO Max at the time, no theatrical release, Christmas Day 2020. Again, this major bump in signups. And then finally, Apple TV Plus, you will see the same type of graph. We have Greyhound starring Tom Hanks. That also came out in July 2020, same time as Hamilton. And once again, another big jump. However, according to this data, roughly half of those users that signed up within 3 days of those major releases, they were gone within 6 months. And you were just talking about Peacock, the Olympics. Again, there was a huge sign up there around the Tokyo Olympics. But guess what? 4 months later, half of them are gone, Akiko included. So what does this all tell us? That these big releases, although they can attract some subscribers, even if only half of them stay, they also can lead to increased churn. It's really easy to cancel a subscription when you have to pay monthly. If you're just binging something really quick, really easy to just binge it within that time frame and then quickly cancel. We were talking about it during the break. I forget, so I'm not really on top of it as some of these other people are, but clearly it's top of mind. We have seen this overall slowdown in subscriber growth. You can just look at Netflix's latest earnings report to see that. So that just means that content is getting more expensive. The marketing, the titles, the stars, the franchises, all of that is just going to cost a lot more money. And with that could potentially come some churn. So how these companies handle that is going to be interesting to just keep an eye on moving forward as the streaming wars intensify.
Yeah, it just shows how heated the landscape is now. Ali Canal, thanks so much for bringing us that story. Coming up, meme stocks. 1 year later, we are taking a look back at how the retail revolution rocked Wall Street and the lessons learned since then. We've got the co-founder and CEO of online brokerage Tornado on the other side. We'll be right back. Well, it has been just over a year since the meme trade took Wall Street by storm. It's been a rapid decline for some of the biggest meme names so far this year, though. Shares of GameStop down nearly 25%, while AMC is seeing a pop today, but it's seen declines of more than 30%, at least in the month of January. For a pulse check on the retail revolution, let's bring in Bernard George, co-founder and CEO of online brokerage Tornado. So Bernard, I'm just curious, when you compare it to how things were a year ago, to what extent have you seen the trading volumes decline on your platform?
Yeah, it's interesting. We've seen some really dramatic trends over the last year. And I think the key takeaway is that there's more to stocks than meme stocks. And one of the most pronounced trends we've seen on our platform is the increased popularity of index ETFs among Gen Z investors. The interest in index ETFs has actually been up more than 110% in the last year. And that compares to, over the same period, a decline of about 80% in meme stocks. So index ETFs, big tech, ESG, all of these themes have been more popular than meme stocks. So we're seeing a really interesting, healthy evolution in what Gen Z investors are interested in. There really is more to stocks than meme stocks.
Bernard, it's Brian here. So I guess you gave us a good outlay of what people are interested in getting on these investing platforms. But can you tell us about the demographic of who's engaging with your investment platform? Obviously, Gen Z, you just highlighted those trends there. But has the composition changed since February and late January of 2021 compared to now? I know there's a kind of a skew towards a male, younger demographic for the retail investor, right?
Yeah, we've actually seen some really exciting trends over the last year. And I think part of that stems from our platform being so focused on education and community and kind of meeting investors where they are. In December, 47% of our new users were actually women. And first-time women investors were our single largest segment of users. So traditionally, women have been underserved in the space. For most brokerages, they make up only about 25 to 40% of accounts. So really excited to see this focus on engagement, learning, community, and long-term investing resonate. Research has found that women tend to trade 40% less than men, yet many brokerage apps tend to push this active trading use case on everyone. So our goal is really to help everyone take that next step in their journey to becoming a better investor.
Bernard, you said it's not just about meme stocks anymore, but we've heard over and over that especially among younger investors, they put their money behind products or companies that they know. When you talk about some of the newer investors who've come into the fold here on your platform, where's the money going towards? What are you seeing as some of the most popular trades?
Yeah, it's a really good point. And over the last year, and we've seen some really interesting trends. Last January, this narrative of community and empowerment popularized investing like never before. And it's drawn so many people who otherwise might not be interested in investing into the market. And everybody really has a unique starting point. Like you said, people get interested in investing for a lot of different reasons. It might be to be part of a movement or a product that you love or a technology that excites you, or more traditional financial reasons like for returns and dividend income. And everyone also has a really unique destination. So our goal is to help people continually take that next step in their journey to becoming a better investor. And investing is such a powerful life skill. So it's important to start investing, but it's also important to never stop learning.
All right, Bernard George, Tornado co-founder and CEO, joining us from Princeton. Thanks so much for hopping on the show this afternoon. Well, coming up on the other side of this break, what is a 5-letter word for cashing out? The New York Times is buying the hit game Wordle. We'll reveal the jaw-dropping price on the other side of this break. Wordle this, Wordle that, Wordle on the street is that apparently the game is being sold to the New York Times. I came up with that by myself, by the way. Apparently, they've sold to the New York Times in what they describe as a number in the low 7 figures. Again, the game's been getting a lot of popularity on Twitter. Everyone's been posting those little boxes. I, for one, didn't start playing this until literally yesterday. I was like, all right, well, if they're sold now and it's part of M&A, I guess I'll start to take a look at exactly what this thing is. It raises questions. I mean, like, do they really need to sell it? Can you just make it? I mean, I don't know. I'm no computer programmer, but it seems like, right? I mean, don't know.
What are they paying for, right? That was my question, is low 7 figures for what? I mean, let's, back up a bit. Let's talk about those who, may not be as familiar with the game. It's essentially a word game where you have to guess a 5-letter word, and you've got 6 tries. Josh Wordle, by the way, which I did not know Wordle was a play on his last name, Brian. A software engineer from Brooklyn. He created this game for his partner. It was a gift. They released it in October. 90 people played back then. 300,000 people have played it since. And I don't know about you, Brian, but I thought it was interesting to see the reaction to this news that Josh Wordle has sold Wordle to the New York Times. I don't think a lot of people were happy with it because they liked the organic feel of the game, that it kind of came up quietly, although not so quietly, in a matter of 2-3 months. And now you've got the big New York Times backing it.
Yeah, I mean, well, first of all, we have to acknowledge, like, good for Josh Wordle, who, again, I didn't know that was his last name. That seems almost a little too on the nose for me. But good for him that he's getting the ability to cash out on this little app that he probably just made for fun and now gets to cash it on. So regardless of why the New York Times felt they needed to purchase this instead of do their own thing is whatever. That's good for him. But on the other hand, yeah, you do bring up the point that the first initial reactions that I had seen on Twitter, where the social engagement of it is a big reason why it's so popular, was kind of like, oh, well, now that it's part of some big media company and maybe it's going to be behind the paywall at some point, now it's officially lame. Now we got to move on to whatever the new game du jour is. I mean, some of the whole Wordle thing felt very pandemic, trapped in your apartment vibes to me. Like, I felt like this was the type of thing that a lot of people
it's
in
like
the
the
depths
crossword
of the
puzzle,
pandemic
right?
would want to do. Right, exactly. And then I got into the New York Times Mini until I would just be terrible at it during the pandemic. That's what this kind of felt like. But I guess good for people that, even though they can still go out now, can get into the Wordle game or whatever the.
Well, you know what it is? Wordle doesn't take as long as a crossword puzzle, by the way. And yesterday when I saw that news, my first reaction was, we need to come up with a word game so we can cash in on low 7 figures. I don't know. I have no ideas right now. I've got no ideas on a word game.
We could do a Wordle that's I don't know, 20 by 20 or something like that, and then has blanked out spots and it has clues for what each thing is, and we'll call it a crossword or something. What do you think about that? I don't know. I think we could sell it to the New York Times for a
I thought you were going to go Fed related. I thought it was going to be a Fed related word game. I don't always talk about the Fed.
I don't always talk about. I have other interests too, for the record.
Yeah, you do. Yes, you do. But good for Josh Wordle. Congratulations to Josh Wordle for cashing in on Wordle. And if you haven't played it, go out and play it. You don't necessarily need to share it on Twitter. That's my 2 cents. We'll see. I haven't played today's game yet, but I will do that after the show. Coming up, Kanye West says no to NFTs for now. That discussion is up ahead, coming up. Well, NFT trading volume reached a record 6.1, I should say, billion dollars last month, according to new data from The Block. But don't count Kanye West among those who are cashing in. In a post on Instagram, he said that he's all about making products in the real world. Take a look at what specifically he said. He said, "My focus is on building real products in the real world, real food, real clothes, real shelter. Do not ask me to do an effing NFT. Ask me later." Brian, it's not often that Kanye and I are on the same page, but my take is that I think he's right. I think that there's enough to do in the real world right now, but if he were to get into NFTs, I bet it would go for a lot of money, right? I mean, not just in music, but in fashion and art. I mean, he kind of has a very wide range, and that's probably why he's addressing it. He's sick of people asking him about it.
I'm sure he's getting that question all the time, but I mean, the key sentence is "ask me later." He's saying that, well, maybe down the line, maybe I could change my mind, as is the case with Ye's artistic history over the past. But I mean, look, when you talk about things that are in the real world, I mean, who's to argue that music isn't also a type of ephemeral kind of non-tangible thing, right? I mean, art is essentially the big reason why NFTs exist in the first place. That's where the biggest use case appears to be for this type of technology. And kind of on a more serious note, I feel like it's almost kind of inevitable, however you feel about NFTs, that there's going to be more of these types of experiments in the short term, at least. I mean, consider Kanye's kind of presence in the fashion space, right? We're already seeing NFTs become a big part of the implementation for a digital experience when it comes to owning a pair of sneakers, for example. I mean, you look at StockX, which wants to IPO at some point. There's a big financial story for them at some point down the line, maybe to also get into the NFT game, whether or not that's a certificate to verify that you have a pair of sneakers. Yes, I have more sneakers in front of me, in front of the desk here on the metaverse as well. But, you know, there is a use case for that. And I feel like Kanye at some point will probably end up dabbling into it. And then we'll all look back on this Instagram and probably laugh.
Yeah, I mean, there's no question he's going to get into it. I think this is just him saying, look, stop asking me. I'm not interested right now. But you have a point in that music is kind of one of those use cases that makes the most sense. And we've already seen it move in that direction. We've heard from guests who've been on our show who've talked about, you know, in the future, maybe if you go to a concert, you'll be able to issue an exclusive token with the ticket. I mean, there's so many different use cases in that space alone. And then you expand it into other areas he dabbles in, obviously fashion, a big one, art, another one. There's a lot of business opportunities. I mean, having said that, I don't think Kanye is necessarily short on cash right now, but I'd be curious because I think the idea for him, if you go based on his history and track record, you know, he wants to do something that's a little more unique than what's being done right now. So maybe he's already got a project in the works and that he doesn't want to be rushed.
Yeah, and on the music side of things, I mean, there's an interesting trend that's been happening in the industry towards vinyl and also now, as of late, CDs, right? And when you talk about why do people want to pay another $20, $25, $30 in some cases for music that you can just get through the streaming service you're already subscribed to, it's ownership. I mean, yeah, people can say that I can touch it, I have the physical. I mean, I have Kanye's vinyls. I have My Beautiful Dark Twisted Fantasy, College Dropout, and Late Registration all on vinyl. I can listen to that on streaming service, but I want to own that. And I feel like ownership is something that's also a big use case for NFTs as well. So again, it's not just for Kanye. I feel like inevitably for everyone else too, even if this whole NFT crypto bubble pops when the Fed starts raising interest rates. There you go. I brought a Fed angle into it. I think maybe there is some lasting use case for, in some cases, especially with the big artists like Kanye, to have some sort of application to NFTs as well. But let's take a look at markets right now as we do get closer to the 1 p.m. hour here on the East Coast and as we get ready to send you over to the next show. Oops, a little bit of a red across the board, just barely so. Dow down about 20 points, S&P 500 down 4 points, and the Nasdaq down 11 points. Again, essentially unchanged from where we were yesterday, but we've seen a lot of teetering over the course of the day. Now, if we take a look at some of the sectors, it looks like real estate, healthcare, consumer staples, technology, utilities not doing so great, although some of the winners for today, at least from a percentage change standpoint, energy, in line with what Dana Diorio was telling us earlier, a big winner, up about 3% so far today. And also taking a look at the 10-year bond I'm looking at right now, up to around 179 basis points. And we also want to promo right now. Do not miss Yahoo Finance's 1-hour special, The Future of Finance, presented by Grayscale, next Tuesday. That's going to be happening February 8th at 12 p.m. Eastern. But for Kiko Fujita and Brian Chung, thanks again for tuning in to the 1 p.m. And also, by the way, happy Lunar New Year to all of you guys. It's the year of the tiger, bringing that in. So go out to your local Asian-owned business and celebrate. But again, thanks for watching in the last 2 hours. We'll be right back after this.
Good afternoon and welcome to A Time for Change. I'm Anjali Kimlani here with Marquise Francis. Today's the first day of Black History Month, and we're going to kick it off speaking about the jump in Black medical student enrollment in a moment. But first, climate change. It's top of mind right now as storms continue to rage around the planet and as the world prepares for the start of the Winter Olympics, which will take place for the first time entirely on man-made snow this year. Opening ceremonies are on Friday, and people are asking, with global temperatures rising, will we hit the point when there just isn't enough winter for Winter Olympics?
Right, and I put that question.
Well, I mean, we talk about it all the time. It's in decision making, you know, for races, for just skiing in general. I mean, you can't deny that you know, global warming exists and that the world is changing and that we have to make the change in a huge way. But I mean, skiing is not going to exist. Winter sports are not going to exist if we continue down this path. And, we see it firsthand. I grew up skiing on glaciers in Austria since I was 9, and they don't exist anymore. And so, for us, again, it's right in front of our faces, but to many, it's not quite as apparent. So I'm not sure how we can make a change substantial enough to fix what's happening. But I know that sports can have a big role in it, because I think that we can shed light on, to people that maybe don't believe in it or aren't convinced.
And that was alpine skier Lindsey Vonn, who won 3 Olympic medals and is now an NBC Olympic correspondent. She was talking about the effects of climate change to the Winter Olympics. And our first guest today does not need any convincing that not only is climate change a real thing, but it's also catastrophic. In fact, he's working to inform others that it's really now or never. Let's bring in Mustafa Santiago Ali, an environmental justice activist and policymaker, someone whose perspective is necessary to the conversation, but especially this month. Mustafa, thank you so much for joining us today. I simply want to start, are we at risk of losing winter?
Well, every aspect of society is going to be impacted by climate change. And of course, winter and our seasons are connected to these changes that we see happening all across our planet. So the answer is yes. The answer is that, winters will become less cold in many places across our planet. And as we move throughout this century, as temperatures continue to increase, we'll see many difficulties for folks who actually survive on winter-related types of activities and food sources and a number of other things. But the good point is that we can actually make change happen and begin to mitigate many of those impacts.
Right, Mustafa, you've worked at the Environmental Protection Agency, the National Wildlife Federation, and the Hip Hop Caucus, in addition to many more. And oftentimes with working with people, I think you understand probably more than most that folks don't really change unless they're personally affected. So when will people kind of wake up to that idea, and how much is climate change actually costing Americans?
Well, a lot of folks are finally starting to wake up. We actually need some politicians to catch up with folks. But when you look at many of the surveys, especially of younger people, folks who are 30 and under, climate change, they know is not only real, but they expect real actions on that. In many instances, they vote on that issue along with a number of other issues. They also understand that if we don't move forward very quickly and with a very set of comprehensive actions, that it is going to impact their lives more than some of the older folks who are in our society. And the economic costs are huge. We know that over the last 30 years, we've spent over $2 trillion on climate-related crises. We've spent, hundreds of billions of dollars just in our country related to storms, related to floods, heat events, and a number of other items. So all of this comes together for a lot of folks in saying that we have to make change happen. Because if we don't, there will be huge economic cost, both in our country, but across the planet.
Mustafa, Anjali here. Going to your experience at the EPA, we know that we've seen the EPA really have to shift its strength and its strategy as per the whims of various administrations over the years. I wonder, how do you feel that's affected us as a country and our ability to actually tackle climate change now?
Well, we have a president now in this moment who not only says that climate change is real, is willing to actually lean in and put some actions behind it. So you see a number of really positive steps that are happening at the Environmental Protection Agency to address a number of the air pollution. Air pollution is one of the drivers in the warming up of the planet. And we know we've got over 100,000 people who die prematurely from air pollution. And that same air pollution that is taking lives is also playing a role in warming up our oceans and our planet. We also have a president right now who says we have to have an all-of-government approach, which is incredibly important as well, because we know that the Environmental Protection Agency can't do it by itself. We need to have a number of other agencies and departments that are also building the criteria into their decision-making, making sure that resources are making it to the spaces and places that need them the most, and then to also move forward on the technology that's also going to be a part of it. And of course, centering the work around our most vulnerable communities, those environmental justice communities that have been on the front lines for decades fighting to address pollution and now the climate crisis.
And Mustafa, you've been doing this work for decades, as I laid out earlier, all those organizations you've been working with. But I'm curious, are there folks that look like you and I on the front lines of this climate justice activism, but also the policy? And I'm curious, from when you started to now, how have things changed over time?
Wow, when I first started, I started as a student, and I remember going to one of my first meetings at the Environmental Protection Agency, and there were two older gentlemen walking in front of me, and they said, I don't know why we're going to this meeting because what the folks are sharing can't possibly be true. Now we fast forward a number of decades, and you do see a number of folks in the policy space, although we need more, who are folks of color, who are actually bringing their sets of experiences, their innovation, their ingenuity into helping to make sure that policy is more reflective of the needs that are out there. We also, see that there's some real change that's happening across the federal family. The Interagency Working Group, the White House Environmental Justice Advisory Council, a number of these different pieces are bringing forward frontline voices and making sure that their sets of requests, their solutions and recommendations are being integrated. But we have a lot of work to do, and time is ticking. And that's probably the biggest challenge is that we really have to get the majority of folks coming together to make sure that we have comprehensive sets of actions, making sure that we have a just transition, knowing that no one gets left behind, and that we are investing in the clean economy, which is so critically important, especially for vulnerable communities who've often been locked out of many positions, but also in making sure those workers who have been in the fossil fuel industries know that they are still valued and honored and needed as we move toward that clean economy. All of these things are happening in this moment, but we've got to keep pushing and demanding that change happens at an even faster rate.
I'm so glad you brought that up, because speaking of vulnerable communities, we've seen how this pandemic has shown the fractures, not only in our society, but also in our information systems. And so I wonder, even though we've seen, companies maybe take a lead in small efforts or small policies being put in place, we clearly as a country cannot handle mandates. And so I wonder, how do we get out there? How do we start to push for this greater change? To your point of more is needed, what more can we do?
Well, we have our own sets of personal responsibilities as individuals. Where are we investing our dollars? That's a question I always pose to folks. Are we supporting those who are trying to move forward on a 21st century set of actions? Or are we supporting those who are being an impediment to the changes that are necessary? Are we utilizing our vote, getting engaged in the civic process? I never tell anyone who to vote for, but I do say vote for someone who cares about your community, somebody who is forward focused and forward thinking, not only just about the sets of challenges we have in front of us, but also the sets of opportunities that are there as well. So we have so much more power. My mom says you have power unless you give it away. We've got to realize that power. We also have the power to actually reach across and to connect with folks who might not necessarily see things the same way that we do, but after we actually, connect with each other in our own humanity, then we have an opportunity to build collaborative partnerships. And we have an opportunity also to have organizations, trusted organizations like the Union of Concerned Scientists, to be able to make some connections with folks, to make sure that folks understand that science is real, science is not biased, but that science is also helping us to have a blueprint for moving forward, and that our policy and our politics needs to line up so that everyone can be in a stronger and healthier and more sustainable position as we move forward.
Yes, Mustafa, you talked about a clean economy, and I just can't get over your clean pink turtleneck and pink pocket tie. So I appreciate that on the first day of Black History Month. Mustafa Santiago Ali, environmental justice activist, thank you so much for joining us today.
Thank you.
Coming up, from the fight for environmental justice to the fight for health equity for patients and doctors, right after the break.
Welcome back to A Time for Change. The ongoing coronavirus pandemic has disproportionately impacted minorities and vulnerable populations. And amid mounting staffing shortages for many health professional roles, one new statistic stands out. The number of Black medical student enrollment seems to be on the rise, up 21% in the past year, according to a recent NPR report. Here to discuss that and more is Micheline Davis, CEO of National Medical Fellowships and a former hospital executive. Micheline, thanks so much for joining us today.
Thank you so much for having us.
So I want to get your take on this. Black enrollment up, that seems to be tied to the pandemic, is it not?
I believe that it is in fact tied to the pandemic, but also the sense and sensitivity around the level of awareness of the impact and effect of that pandemic in communities that have been made vulnerable as a result of historical disenfranchisement and underinvestment. We literally are seeing the fact that for those of us in health equity who have been talking about how structural and systemic racism and inequity has really created vulnerable communities across this country, that now that others have seen it as well. And so I firmly feel that the students who have applied in these increasing numbers, which is a fantastic thing, not just for us, but for everyone, that truly it is as a result of seeing the impact of something like this virus literally hitting communities of concern, featuring individuals that they love and know, and understanding that they have an opportunity to do something about it.
And Micheline, I'd love for you to really illustrate what that inequity looks like. How equal is the care that people are getting these days? Can someone like me walk into the emergency room and know that I'm getting the same treatment as, let's say, a white man or an Asian woman?
Well, my friend, the issue there is that what statistics tell us is that there's a high probability, a high likelihood that in fact you would not be receiving the same level of care. And that is despite your level of income, that is despite your coverage, your healthcare coverage, whether or not you are a government subsidized payer or whether or not you are a private payer, that is despite your educational attainment, socioeconomic status, right? So what we know is the fact that we really need to strive for a more equitable future where everyone really has an opportunity to the same level of high quality, high culturally competent care. And that is not something that right now we can guarantee that you are actually receiving. And that is not just me that is saying that. Undoubtedly, study after study has evidenced the fact that implicit bias and outright structural and systemic racism has so perpetually influenced the American healthcare system that what we see now is not just the fact that there are certain health outcomes that are bettering, but that literally, as the general population's health outcomes are better, that for BIPOC, that is Black, Indigenous, persons of color, their healthcare outcomes are actually worsening. And so as a result of that, what we are seeing is the widening of the health disparity gap across the country. And this is in many different areas, unfortunately. Lots of folks and lots of talk have recently been really focused on maternal mortality. And the fact that a Black woman with an advanced degree has the same or worse outcome of mortality than a high school dropout who is white is something that is significantly concerning. But when you take a look at the fact that in certain pockets of this country, like New York, for example, a Black woman is 12 times more likely than her white counterpart to literally pass away after the process of actually bearing a child. There needs to be some time for someone to say that is enough. And one of the things that I like to say at National Medical Fellowships is the fact that we are done dying. And so what I believe that we are seeing right now is that students have said, not only are we done dying, but we are also at a point where we realize that we are an aspect of the answer. We are the actual solution for our own communities. And so as a result of that, we literally are seeing the fact that the same students who over the past summer have taken to the street in order to march after the horrendous and unjust murder of George Floyd have now marched into medical school admissions offices and will be marching into medical school.
Micheline, I want to talk about all of this because we know, you and I have talked over the years about population health, which became social determinants of health, which now became health equity. We've seen that metamorphosis of the idea of exactly all of this, and it seems like we somehow end up having the same conversation. So looking at all the data that we have now, looking at the movement and the focus on health equity right now, where's the solution in all this? Does it come largely from a shift in the population of caregivers? Does it come from maybe just more data in the hands of everyday individuals? How do we move forward from just having this conversation over and over again?
Thank you, Angela. I actually think that indeed it's a multifaceted approach, but it is an approach which incredibly depends upon the diversification of the healthcare workforce. And when I say that, please know that I am indeed focused on the physician, but not just the physician. What we have seen is the fact that across the country, state legislation has increased the access and authority for individuals like advanced practice nurses and physician's assistants. So we need to make certain that indeed all of these areas are areas where individuals from the communities of individuals that they are serving, right, that they are present in those spaces. But we also need to make certain that we are holding individuals and institutions accountable. I mentioned earlier cultural competency. Well, that means that you have to face your implicit bias not once a year in some diversity and inclusion training. That means on a daily basis, you as a healthcare practitioner must challenge yourself, understanding all full well, not just the fact that here we have this data and these outputs today, but that historically, healthcare has literally been built on the backs of impoverished and oppressed individuals, right? So if we take a look at just the science of obstetrics and gynecology alone, what we know is that Dr. Marion J. Sims literally built it on the literal backs of African Americans who were enslaved, women who were operated on without anesthesia, right? So we know that this has happened, and yet healthcare institutions at times like to move forward without actually looking back and understanding that there must be something that occurs that evidences that, yes, this happened, we acknowledge it, we recognize it, we wish to correct it. And so as a result of that, we're going to make certain that our own systems and practices and processes and procedures, that who we hire and how we hire, who we recruit, how we retain and matriculate is reflective of our contribution to systemic racism, right? So to that point, you ask about the data. Is it important to get data into everyone's hands? Well, I think this. Not only is it important for just those of us who are devoted to health equity to be well educated about this and to understand it, and not only is it important for the healthcare provider, but it's also important for the everyday patient. Individuals understand, and over 48% of African Americans have indicated that they have experienced a negative experience in a healthcare setting within the last year. So what we know is the fact that if they are also given the data and provided with an opportunity to truly be empowered to advance this for themselves, and if they are doing so within a system that acknowledges what their historical contribution has been to the disenfranchisement, marginalization, and poor healthcare outcomes for certain populations, then we may actually stand a chance. But there is no way through this problem, over it, around it, or under it, that does not center a focus on the need, the evidence of the impactful need, an immediate need to ensure that we are achieving higher levels of diversity in the healthcare workspace, especially in clinical spaces. And Angelique, I'll tell you this, I did not leave high academic medical center system in order to come to NMF just to ensure the pipeline of BIPOC students interested in medicine. I came here to ensure the pipeline of BIPOC physician leaders. We need to make certain that these individuals are poised and given the opportunity to lead the systems and structures that we have already known for years that they need to change, right? And so we need to make certain that they're having access to the opportunities that prepare them, equip them, not just recruit them, but then create environments in which they can thrive, not just survive, in order to ensure that they're matriculating to leadership positions. And that, my friend, may finally get us over the trenches and actually to the land of health equity.
Something that we know we've seen across industries as well. Unfortunately, we have to leave it there. But Micheline Davis, CEO of National Medical Fellowships, thank you again for joining us today.
Thank you for having us.
Coming up, Black History Month meets the Winter Olympics. Notable Black winter athletes still ahead.
Welcome back to A Time for Change. Since today is the start of Black History Month, and this week is the start of the Winter Olympics, we want to take a moment to look at some of the big moments for Black athletes in the Winter Games. Of course, the Winter Olympics is not historically known for its racial diversity, but that hasn't stopped a few superstars of color from making their mark. Like figure skater Debbie Thomas, who became Team USA's first Black athlete to win an Olympic medal. It was in 1988 in Calgary that she took home the bronze. And it wasn't until 2002, just 20 years ago, that Vanetta Flowers became the first Black athlete from any country to win gold in the Winter Olympics. She was a Team USA bobsledder at the Salt Lake City Games. In Beijing, keep an eye out for Erin Jackson, who is back at the Olympics after becoming the first Black woman to qualify for the U.S. Olympic long speed skating team 4 years ago. And one of my favorites, the Jamaican four-man bobsled team. They're back at Beijing this time around, their first Winter Olympics in more than 20 years. And if folks recall, Cool Runnings may have an opportunity for a comeback. That's all for our show today. I am Marquise Francis.
And I'm Angelique Hemlani.
Thank you so much for watching. Stay with us, and there's still so much more ahead.
Workers continue to have the upper hand in a tight labor market. New data shows Americans quit their jobs at a near record pace in December as employees struggle to fill a historic number of job openings. Tom Brady is calling it quits. The legendary quarterback officially announcing he is retiring after an iconic 22-season career with the NFL. We look back at what Tom Brady has meant to the business of football and how he plans to dominate off the gridiron. And the great reopening looms large for companies across the country. Just when will workers return to the office? And what do they want from their bosses when they do? Hello, everyone, and welcome to Yahoo Finance Live on this Tuesday. I'm Alexis Christoforous here with Karina Mitchell, and it looks like investors are kicking off a new month with more choppy trading as they digest the latest ISM report, which showed a slowdown in manufacturing. Also, of course, investors waiting for some big name companies to reveal their bottom lines. We're talking Starbucks and Google's parent company Alphabet, Karina, out after today's closing bell.
Yeah, everyone watching for those results after the bell, as you say. I just want to wish our viewers who are celebrating a happy Chinese Lunar New Year. It is also the start of Black History Month on this 1st of February. A pretty quiet start to the trading month after all the volatility that we saw in January. As you know, the S&P marking its worst start to the month since March of 2020. And JOLTS data showing a pickup in the number of unfilled jobs. Let's hit the numbers right now. The Dow is up by about 15 points. The S&P up by a point, and the Nasdaq also pretty much flat, up by 14 points. Sector-wise, let's take a look at what is happening there. Energy is the big leader today by a mile. Industrials and materials also having a good day. Looking at the laggards, we see that utilities and real estate are some of the biggest losers on the day. Construction staples and tech and health also on the losing side today. Over to the yields, and let's look at the bond market. The 10-year up above 1.8 earlier in the session at one point as investors weigh in on new inflation data. And the ISM, as you said, showing a hike of about 7.9% and the 30-year yield at 2.12. Alexis, let's throw it back to you.
All right, thanks so much. I want to stick with the markets now and bring in Keith Fitzgerald, Chief Investment Officer at Fitzgerald Group. Keith, always good to see you. So look, it is Lunar Year, the year of the tiger, not the year of the bull or the bear. But I'm curious where you think this market is headed after a pretty miserable January. Do you think this market will find its footing, or are we going to take another big leg down?
Well, you know, this is one of those things where you've got to take a step back, look at the broader perspective. By the numbers, we know that this is not unusual. There's been 33 massive corrections since 1950. January, ergo, is absolutely normal. There's a buyer for every seller and a seller for every buyer. Me personally, I think we've got another few percents downward, and then we're going to find some footing and charge higher because the economy actually is strong. The right companies are even stronger. So I think we've got a little more downside. Floor is not quite in yet. We haven't seen the capitulation, the give up. Your neighbor hasn't sworn off stocks, for example, any more than mine have. Until that happens, we've probably got a little bouncy behavior ahead of us.
So then what do you do with the portfolio to take advantage of the bouncy behavior or to at least preserve what it is you've got going on, Keith?
Well, the first rule of behavior is don't do anything stupid. This is not the time when you want to make rash decisions or change your long-term investment philosophy. This is when you focus on finding companies that are winning, companies that are profitable, companies that have great products we can't live without. You sell the laggards. You concentrate on companies that have inflation protection capacity, companies that are in energy, for example, or technology are doing great things. Apple, for example, Exxon just this morning, the roster's pretty full if you know what to look for.
All right, let's talk a little big tech because it's a big week for these names. This week alone, we're going to hear from Meta, formerly Facebook, Google's parent Alphabet, I mentioned at the top of the show, Amazon as well. What are you expecting from these companies and what positions do you have in them at the moment?
Well, I'm completely flat on all three of them. And the reason I'm flat is because I want to wait and see what the numbers have to say. You know, Facebook, Meta is going to be Fantasy Island for me. It's all about what they're going to do with Oculus and how they're going to move into the metaverse. But we don't know what that looks like yet. So I'm going to hang back until I see what the numbers. Google, Alphabet, that's clearly for me the area of interest because they've got a lot of businesses, their cloud, their data, their advertising. That truly is the one that's going to generate the money. On the other hand, Amazon is still under pressure. So I've owned all three of these companies in the past. past, but I'm a very much wait and see right now. I want to see what they're going to do. We've got to get through the Fed. We got to get through that little bounce. I'm not in a rush, and I'm perfectly content to look for those companies that are making money.
What are you doing with Apple's holdings right now? I mean, they came out with pretty stellar earnings.
Oh, that's a company that if I'm smart enough, I'm not going to let go of for the rest of my life. I'm content to buy more and hope I'm smart enough to do it.
All right, so that's your bet. That's your big blue chip. I understand. It's gone from growth to like just being this like blue chip company you have to have in your portfolio. Is that how you see Apple?
Yeah, it's one of those companies that, if you look at the way the world is working and you look at what that company is doing, you don't see growth at 30, 40, 50% in every business segment. The company is so big, you're talking about $600,000, $700,000 that it makes every 60 seconds. So it just dwarfs anything else on the table. And when you're firing on all cylinders, I submit it's very hard to go wrong with a company like that.
All right, got to talk a little telecom. Because we know that 5G, there are lots and lots of hurdles here for 5G sort of taking off the way a lot of these telecom giants had hoped. And AT&T in particular getting hit today. The news there, of course, is going to be slashing its dividend nearly in half. It's going to be spinning off its Warner Media. And it's saying it's doing that in part to sort of catch up in the 5G game. What do you like in that space right now?
Well, first and foremost, I got to tell you, I don't buy that argument. I think they're splitting up because they can't handle the combination of streaming content and the 5G. So to me, this is a deconglomeratization. It's similar to GE. It's similar to Harley, trying to break it apart so they can unlock value is the thinking. But I think they're playing catch up in both business segments. So I'm not keen on the stock either way. If I were going to go into the 5G space, I'm going to go right back to Apple because they're going to make the haystack, not the needle. If I'm going to go into the technology, I'm going to be looking at the chipsets like the NVIDIA because they're going to power the 5G. This country's got a problem. Most of our big phone makers have spent more money advertising 5G than they have building it out. I mean, Verizon's the one that's out in front, but even so, it's a fraction compared to what you see overseas.
Interesting. So your play on 5G is Apple, not the major telecoms.
Correct. Simply because, this is one of those situations where if you're going to look for the needle in the haystack, there's a role in that. That's fine. I'd rather own the haystack.
Okay, fair enough. And finally, you and I have talked crypto in the past. It's been a wild ride. At least today, they're up, the major cryptos, with Bitcoin now nearing $39,000. I'm looking at Ethereum, up now better than 4%. Have you changed your feelings about crypto, and do you hold any?
I'm upside down on the crypto I do own, but no, I haven't changed my feeling because digital money is coming, whether we like it or not. And it's one of those situations where it's very hard to pick the winners, but you got to have a toe in the water. So I own Bitcoin, I own Ethereum, and I'm perfectly content to wait this one out. But again, going to the needle in the haystack, that's going to be JP Morgan for me with regard to all things digital, even though I have some of the currency.
A little bit of an outlier, Keith. Keith Fitzgerald of Fitzgerald Group, thanks so much for being with us. And a reminder that you can step up your investment strategy with a free 14-day trial of Yahoo Finance Plus. You'll get expert research reports, actionable investment ideas, some advanced portfolio tools, and a whole lot more in a sleek ad-light experience. You can check it all out at yahoofinance.com/plus. Karina?
Okay, and coming up, Pfizer getting a step closer to vaccines for kids under 5. Details on that coming up. Welcome back to Yahoo Finance. Well, Pfizer is poised to ask the FDA for emergency use authorization for its COVID vaccine for infants as young as 6 months. And here to help us discuss that is Dr. Marie Elizabeth Ramos, family medicine physician. Doctor, thanks so much for being here. I'm wondering how much of a game changer is this, because it is the last group, right, left to be vaccinated. And many parents with young children who have been dealing with daycare issues and preschool issues are waiting for this shot to be approved. It could come as soon as the end of the month.
We are so excited about this news that has come up. Certainly, you are correct. We have been waiting for this particular age group because we have limited resources as far as how to treat those severe cases. Unfortunately, we have seen in New Hampshire that Omicron does have an increased risk of that MISC-C complication from the COVID virus infection. And particularly for the younger age population that are not vaccinated, there was rising concern amongst the medical community for their safety in essence. So very excited for this news to come.
And Dr. Ramos, in a similar vein, Moderna just gained full vaccine approval as well. It's the second most widely administered shot in the US. So I'm wondering psychologically, how important is that to give people, let's say, who are on the fence about getting vaccinated, a sense of security that it is actually safe and it is worth getting the shot?
Well, the numbers don't lie. And interestingly enough, despite all of the positive effects that we've seen through the cases of administration of the vaccine over the last 2 years, we still are having hesitancy and resistance. And that's partly due because of concern of the unknown, particularly for our pediatric population. And so efforts to make sure that trusted medical and health providers are providing information that is trusted and evidence-based is of utmost importance right now.
And Doctor, I know that hospitalizations do lag case numbers. So I'm wondering, on the ground where you are, what are you seeing as far as hospitalizations, and how are healthcare staff positioned to deal with it?
We are still taxed here in New Hampshire. Unfortunately, most of our hospitals are still at capacity. I am pleased to say, however, that for our children at ages 5 and below, the rate of hospitalization has been less. However, with the actual adverse effects from this population group, we are still seeing a couple of cases here and there. Luckily so. As far as approach from a public health standpoint, we are bracing ourselves for the next couple of weeks beyond this surge. And so public health officials throughout the state of New Hampshire are recommending to continue with mask mandates as recommended, to make sure that we are holding off and staving off the remnant tail infections and hospitalizations. Certainly our healthcare professionals would definitely be encouraged with that.
Doctor, I want to stay on that mask mandate for a second, because the whole issue has become so politicized, and Republicans led by Minority Whip Steve Scalise just sent a letter to the CDC about young kids being required to mask up. How viable is it for a 2-year-old to be asked to wear a mask? I mean, realistically, they'll put it on, they'll take it off, they'll drool, they'll throw it on the floor, they'll put it on again. So how much value does that provide? And then, you know, on the flip side, we see people in leadership positions like the mayor and the governor of New York at a football game not wearing a mask for a photo op. How much conflicting signals does that send? And, there's a sense of at some point you have to sort of be realistic about what should be done and what can be done with masking. Where do you stand on all of that?
A lot of great questions there. As it relates to our younger patients and our pediatric patients, I think that we have to recognize that kids are going to follow suit with what their caregivers are recommending for them and what they are trained to do. So being able to put on masks for kids as young as 2 or 3 years old, for the majority of kids, that could be okay. Certainly developmentally speaking, not all children develop at the same rate. And so that level of sensitivity to mask wearing is going to be different depending on the child. But But I think the bigger question is what kind of practices, healthy practices, are we going to enforce as adult caregivers for our children? Certainly wearing masks is not, as some politicians say, abusive to children. It is not restrictive to them. Are children able to still enjoy their ability to socialize and to grow social emotionally? The vast majority, yes. Will there be some cases where we have to make exceptions? Certainly so. But as with all things with public health, we need to do what we can in order to improve the health of our neighbors in our community. That's mask wearing and vaccination. The other question you asked us. Yep.
Yes, go ahead. Go ahead.
Yep. The other question you were asking was about the mixed messages from our public officials to the common community. And certainly we have to do a better job here in the United States. I think that's the best way to sum it up. We need to do a better job of not providing confusing information to the public who are undergoing science in motion right now. So making sure that we're wearing our masks and we're doing our due diligence as leaders, I think, is of importance at this time.
I feel like we're all living experiments. One quick question before we let you go. So some schools are having a test to stay policy, are rethinking that policy because they're having such an issue coming up with the test. How important is that philosophy to help keep kids safe? As you say, there are so many more hospitalizations with children being impacted.
That's a great question. Right now, our laboratories, outpatient laboratories, are saturated here in New Hampshire. And so getting a test result from a PCR of someone who either has mild symptoms or has no symptoms and had exposure, that can sometimes take 5 to 10 days to respond and to get actual results. And so the goal here from a family physician standpoint would be to have as minimum risk to our community as possible, while still having the advantage of socializing, particularly for our younger students here, socializing and getting exposure and continuity of care in school. The way that we do that is by doing what we've seen has worked over the last couple of years. I don't think testing everybody and requiring tests is going to negate the need and necessity to continue to wear masks and to get vaccinated if appropriate and available for each person.
Okay, doctor, we will have to leave it there. Thank you for everything that you are doing to help keep us safe. Dr. Marie Elizabeth Ramos, family medicine physician. Thanks for your time today. Alexis, back over to you.
Coming up, a look at diversity and inclusion in the workplace and what matters most to job seekers. Welcome back. For millennial and Gen Z professionals, diversity and inclusion in the workplace aren't a preference, they're a requirement. Joining me now is Netta Jenkins, a diversity, equity, and inclusion executive and consultant. Netta, it's good to have you on the show. I know in your role, you talk to a lot of businesses that you consult, but also a lot of job seekers. And we know that people continue to quit their jobs at a record pace, so they feel pretty confident they can get another good job. What are they looking for, though, in that next opportunity?
Yeah, excellent question. I receive so many messages every single day. And the 5 priorities of job seekers right now is diversity, right? That's the first point. 3 out of 4 job seekers say diversity is a critical factor when assessing companies and job offers. And then 41% of Black and LGBTQ plus job seekers won't even apply at a company that lacks diversity. The second piece here is flexibility. So 97% of workers desire more location flexibility, whether fully remote or a hybrid work model. The third here is shared values. Job seekers are looking for jobs that give them a sense of purpose, and they're seeking out employers that share their values. That might be a commitment to sustainability, philanthropy, social impact, or a clear and inspiring vision. The fourth point here is career progression. Right? Many job seekers want to understand growth opportunities in an individual contributor or management role. And then I'd say the fifth point here is benefits. Lack of mental health support reduces cognitive performance about 35% of the time. And caregiving costs US economy $25.2 billion in lost productivity, but about 17% of US full-time workers act as caregivers. So this is a very, very important piece of what job seekers are looking for right now.
And I'm curious, though, if the things you just ticked off there are important to folks, and does it fall along gender lines? Does it fall along sort of age lines? Are these mostly younger job seekers? Do they tend to be female? I mean, I don't know. You tell me. But is there a correlation there between age and gender and what they want out of their job?
Yeah, this is actually across the gamut. We have more senior level folks, women, men, really across all racial lines that are now realizing what's most important for them. So we're seeing this across the board.
So I know that a lot of companies now have sort of people in charge of DEI. These are new positions within the human resources department that didn't exist in some of these companies even a year or two ago. How are you consulting those companies? And I know a lot of folks are trying to put out the messaging that they're trying to make strides with diversity and inclusion and equity in the workplace, but how do you hold them accountable?
Yeah, that's such a great question, because I think the first key part there is removing diversity, equity, and inclusion roles out of human resource departments, right? These folks should be specifically reporting to the CEO or the COO of an organization for that executive level buy-in. You know, typically when I speak to DEI leaders from various organizations, that's the major gap. Some of them that are still reporting within human resource, HR folks are having that gap. You know, so it's really critical for them to be exposed to individuals that will be able to really push the needle forward and make those tough decisions that need to be made. I think another piece of really creating the sustainability within organizations from a diversity, equity, and inclusion standpoint is ensuring that from the onboarding stage, right, there are key learnings and individuals that are newly joining an organization understand what those values are, understand how microaggressions play a very large role on individuals within an organization, and also understand how to dismantle that, right? So that's a critical piece. There are a lot of many ways to go about this, but that's one of the things that I'm actually working on right now within my book that will be coming out this year, the end of this year.
All right, what's the name of the book, real quick, Netta?
Unmasking the Workplace.
Unmasking the Workplace. Okay, good one. We've all been masked for a couple of years now, so unmasking at any level is a positive. All right, Netta Jenkins, DEI expert and consultant. Thanks for your time today. Great to have you on the show. Karina?
Okay, that was a great discussion, you guys. All right, we're going to send you to a break, but before that, let's take a quick check of the markets. They are mixed at the moment. The Dow is up by 26 points, the S&P down by just about a point, and the Nasdaq just turned negative, down by 29 points. We have much more market news ahead, plus a deeper look at the state of the labor market and what's next for Tom Brady after retirement. Stick around. Welcome back to Yahoo Finance. I'm Karina Mitchell along with Alexis Christoforous on this first trading day of February, a relatively quiet start compared to all of the volatility of January. Investors happy to kiss last month goodbye. Let's take a quick check of the markets. They are turned mixed at the moment. The major benchmarks, the Dow is up by about 53 points right now. The S&P up by 2 points, pretty flat. And then the Nasdaq just turning sour, lower off session lows, though, down by 13 points. And of course, all eyes are on Alphabet earnings after the bell today. Everyone looking out for what that does to the markets. But lots of other market movers today. So let's bring in our Inez Ferre. She is at the Nasdaq. And Inez, you are looking at Amazon, Bank of America, reaffirming it as a top bang pick.
Yeah, that's right, Karina. Bank of America reaffirming Amazon as a top pick for 2022 for FANG names, and also saying that it's a buy rating for Amazon. Now, what Bank of America analysts are expecting for the company's fourth quarter results which will be announced this Thursday after the close, is for the company to come in line with revenue, and also for a modest upside to its profit for its fourth quarter. Also, with the analysts there pointing that the first quarter, that being the current quarter, would be the low point for growth in year-over-year margins for the e-commerce giant, and trends should get better from here. Some other areas of focus, though, for Amazon will be the cloud, with Dan Ives from Wedbush writing a note about investors looking at the cloud and growth for the cloud going into 2022, and that will be a key area of focus. And I should also mention another note that came out from Jefferies earlier this week, and that being that Jefferies floating around the idea if Amazon were to perhaps increase its price for Amazon Prime. Amazon Prime was launched back in 2005, and it raised its prices in 2014, 2018 by $20 each time. And this, the analysts are saying, would be a good time, an appropriate time that the company could do this to confront some of the labor costs that it has, because Amazon has been paying some beefy salaries to attract workers to work in their fulfillment centers, and also costs related to its fulfillment centers as well, and as well as the COVID-related costs, which the company had announced last year to make health of the workers a priority. Karina, Alexis?
Okay, and then you also say Starbucks reporting, in fact, today after the close. What do we expect to hear from them?
Yeah, Starbucks will be reporting its quarterly results, and the street is expecting adjusted earnings per share of 80 cents and a revenue of $7.96 billion. Now, what investors are going to be paying close attention to when it comes to Starbucks is the Omicron variant. Did it impact sales? Did it impact store hours, customer visits, staffing also, and labor costs, of course, and the cost of on products, the inflation costs on products such as coffee and milk. Now, the key market, one of the key markets for Starbucks will be China again, as it has been in the past, and any lockdowns there. And Wedbush came out with a note saying basically that it's expecting a more elongated recovery as the international markets are an ongoing risk. Year to date, the stock is down about 17%. Right now, you can see it's down about 0.5%.
All right, and want to get a look at what's helping Amazon today. I know that they had a preliminary release of their quarterly revenue. This is one of those stocks. First of all, it's a meme stock, but also beaten down pretty hard during the pandemic because theaters were shut down. So is this just part of the reopening trade here, Ines?
Well, their preliminary revenue number and adjusted EBITDA, the adjusted EBITDA came in strong for AMC, and the stock today was up about 15% at one point. Right now, it's up just about 5%. But basically, the company coming in with preliminary revenue of 1.17%, would be a beat. Also, adjusted EBITDA coming in anywhere between 146 to 151.8 million. That would be a beat because the street's expecting 82.4 million. Now, it's a net loss is expected to come in on the high end up to 194.8 million. The street is expecting a net loss of about 130 million. So far, this has been well received by analysts, but certainly AMC doesn't seem to be out of the woods, according to analysts. Akiko and Brian had spoken earlier this morning on Yahoo Finance with Chad Bynum from Macquarie, who has an underperform rating and a $6 price target on the stock, and he said that this was a strong EBITDA, a nice preliminary fourth quarter print here, but this doesn't change the story for 2022. And the question is, why did they release these numbers now? Is there something going on behind the scene related to the company's debt, related to the company's deferred rent? I should note that there are 0 buy ratings on the stock. There are 5 sells and 3 holds, and the average price target on the stock is just north of $6 a share. But certainly, this is something that today was driving the stock higher.
Ines, I don't know about you, but I feel like AMC is like the cat with 9 lives, maybe 10 lives. They just keep coming out with something from their hat. All right, we will leave it there. Looking in fine form at the Nasdaq, Ines Ferre, thank you so much for that report. Want to turn things over and bring in our next guest to discuss today's JOLTS report, as well as risk businesses face in 2022. And to do that, let's bring in Ludovic Subran from Allianz. He's a chief economist there. I hope I said your name correctly, sir. Thank you so much for joining us. And would love just to start off by getting your perspective on those JOLTS numbers that came in today. Still definitely a tight labor market. 10.9 million jobs are open. 4.3 million was the quits rate, down slightly to 2.9%.
Yeah, it's very interesting because the labor shortage shows no sign of slowing down as job openings ticked up in December. So it's very interesting that the job reports continues to confirm that the problem is mostly supply driven, so labor supply. So you continue to have a labor participation issue in the US rather than just a wage conundrum or any type of other issue. So it says a lot because with the market correction that we saw earlier this year, I would have expected that some people that were maybe more on the edge when it came to their purchasing power, and so with the market correction would have decided to go back to the job market, not necessarily the elderly or not necessarily people that are further from the job market, but those who are just okay-ish and don't really want to go back to tough blue-collar job. And we don't see any type of respite at this point. So it really shows that the labor market is flashing hot signals in the US. Yeah.
And then I want to get your expectation for the jobs report that comes out on Friday. Some are predicting negative numbers. The average consensus is about 150,000 jobs added, and that we will see the effects that Omicron has had. And I'm wondering, how does that tie into inflation? Do you think the Fed even pays attention to the numbers? Because they seem so focused on now tackling inflation. Fed Chair Jay Powell himself said he personally thinks we are at maximum employment right now. Do you agree with that assessment?
So the jobs report, we also in the tune of 120, 130,000 jobs. As you know, the last report was quite disappointing with 199,000. And to go back to your question, I think the Fed does care about the labor market. The Fed has been even accused of being too woke for its own good by looking at the distributional effect of the labor market. That's really what some pundits reproached Chairman Powell with, and that was a bit aggravated, I would say, or accentuated by Janet Yellen's discussion about making sure that the labor market works for everybody, including people that are further from the labor market. So price stability is, of course, the utmost priority with inflation, skyrocketing. But I do think it's very important to really understand the labor market because it is where the wage price spiral starts or doesn't start. So today, the wage price spiral is halfway there in the US. So it's very important to understand employment rate, but also labor market participation. Where do we get with the Great Resignation? How much are we talking about when we talk about shortage in the labor supply? Unemployment rate is good. Wages are also going up. But to understand the future, you need to understand the composition of the labor market and the potential mismatches that are temporary or that are much more structural. So I think they do care and they should care. And we will know more with the jobs report. But of course, it's a question of the following months, right? Because it will give us a bit of a tempo for the Fed tightening together with the inflation data, of course.
So as far as Fed tightening, do you see them being as hawkish and aggressive as some have made out? The market's now pricing in 5 rate hikes. How many hikes do you see coming?
We only have 3. So as you know, we have only, the range is incredible. It's the narrative is hard for the Fed to regain after having tried this temporary story, which didn't hold for long. So now you have people that go from 3 or 2 all the way to 7, 8, rate hikes. The reason why we are a bit on the dovish side is that we see, for example, more market corrections. And the Fed is somehow officiously in charge also of volatility suppression. We believe that the type of correction we saw in January on the equity market is not something the Fed is very comfortable with. So the more the correction we're going to see on the stock market, the less likely hikes will be, or the less frequent hikes will be. So we keep with our 3 hikes, also because we somehow think that monetary policy will not calm the supply chain inflation. It will not calm the other issues, supply-driven issues that make the bulk of inflation in the US today. So it would be a very costly way to calm inflation with a very tight monetary policy. The last time that happened for the US was in the early 80s, with Volcker. So that came with a recession. So we think they will still be very cautious. They're walking a very fine line, but we think they will keep a bit of hiking under their belt to make sure that growth is strong in the US and we avoid a form of stagflation, which would be unfortunately bringing back Carter's time in the US, which was an economic depression. Yeah.
Ludovic, really quick, only about 30 seconds left. Want to get your assessment of a recent survey from Allianz that shows economic risks that businesses face. So inflation and supply chain issues were the biggest risks last year, but according to the report that came out, skilled workforce and macroeconomic conditions like inflation less of an issue for businesses this year. So is the pendulum swinging? Workers have all the momentum right now, but do we see that slowly swinging back to employers having the upper hand come this year?
In 30 seconds, yes, the pendulum is swinging back. Because I think, we're getting a bit more forward visibility. And so businessmen and the chief risk officers that we surveyed in this report, they go back to the core of what makes the balance sheet, what makes the income statement. And it's indeed risk of cyber, business interruption, natural catastrophes. And they think that the economic is taken care of. But, of course, it doesn't mean that the risks to the downside have disappeared. But it certainly means that everybody is going back to doing business and they want to leave the pandemic behind.
Okay, we'll leave it there. Ludovic Subran from Allianz, the chief economist there. Thank you so much for your time today. And we will switch gears and turn to this week's episode of Influencers. Yahoo Finance editor-in-chief Andy Serwer sits down with Representative Alexandria Ocasio-Cortez for discussion on breaking up Facebook. Take a listen.
When you look at a company like Facebook, you can't kind of put them all in the same boat. They do different things. But when you look at a company like Facebook and the completely corrosive ways that they have exercised an abuse, I believe, in civil society writ large, not just our democracies, but you look at, for example, what we're hearing from other countries when we talk about production of vaccines or perhaps like what we can do to export, help them. They say it's not just, there are some things that the United States provide that are welcome. There's also things that we want the United States to stop exporting. And one of those things is disinformation. And disinformation through US founded companies like Facebook that have absolutely slowed and frankly sabotaged the global effort to fight against the coronavirus. And we see this disinformation used both in the public health sphere. We've also seen social scientists have truly shown the impact that Facebook has had in contributing to social violence and perhaps even accelerating large scale, very dangerous, and some would call genocidal activities in places like South Asia, et cetera, human rights abuses, and also hate here at home.
But I'm curious, what do you think we should do about them, or what we should do to them, I guess?
Facebook should be broken up. We should pursue antitrust activity on Facebook, and there are so many different reasons why. They are acting as an advertiser. They are acting as both platform and vendor. They are a communications platform, which has historically been a well-established domain of antitrust. And so because there are so many businesses and industries in one, the case is, I believe, right there in and of itself as to why they should be subject to antitrust activity.
Okay, that was Andy Serwer speaking with AOC, as the folks call her. Alexis, back over to you.
All right, thanks, Karina. Coming up next, how Omicron is disrupting return to the office plans for countless companies. COVID-19 has upended many companies' plans to return to the office. In fact, a new survey from the Conference Board finds that most of those businesses don't even have a planned date yet for when they're calling back employees to the physical office. Here now is Rebecca Ray, the Conference Board's Executive Vice President. Rebecca, I went through some of these key findings. Break down for us just how many companies, first off, were disrupted by Omicron and plans to return to the office.
Sure. Well, thank you, first of all, for having me on. 71% of the respondents indicated that their offices had been impacted by the latest strain. And set aside, I want to be very, very cognizant that many never closed their offices or adapted. They simply kept on going. But you have 71% who said that they were impacted. They either reverted back to remote work or they just rescheduled or canceled their plans. So of those who were upended, not quite half had a thought as to where they were going to, when they were going to bring people back. And I think that's indicative of the uncertainty and the surprises we've had for this marathon we've been in for a couple of years now, which everyone hoped, I think, was going to be a sprint when we first entered into it.
Oh, and oh boy, is it a marathon. How many workers, I mean, we keep hearing about people who are not back in the office. How many people are back in the office right now, according to this survey?
So we didn't ask that specifically. We asked about those who were impacted and what had been their personal experience. But from other work that we do, you have about anywhere between 15 and 30% of the workforce sort of back in some kind of office. But many are rethinking putting a stake in the ground at all as to when they'll return. And I think that's indicative of, well, we now know that there's a brand new variant that's in, I think, half the states. And so, a lot of people are very concerned. In fact, when you ask people about their concerns about returning, their concerns about either contracting COVID personally or bringing it home to family members, many of whom may not be able to be vaccinated, particularly with small children, that number has doubled in the 8 months since we asked that question.
Yeah, I wanted to talk to you about how comfortable workers are with getting back to work, 2 years into this pandemic. And also, what are they saying they need at the office to make them comfortable once they do return?
Sure. And, to be fair, I think businesses have taken this very seriously. I think they have tried to put plans in place about sanitation, about distancing, about reporting, about being very proactive as soon as they perhaps come to find out that someone is in the workplace and has exposed others. And I think they have taken this very seriously. And just about everyone I talk to in the space talks about the fact that they are looking at worker safety first. Despite that, however, I think a lot of employees are still very, very hesitant. In fact, when you look at the number of people who told us they have at least some level of concern about returning, that's 3 out of 5 employees. One of the things they'll tell us in this survey and in other work we've done is that they're not sure that their coworkers will abide. So companies can do a lot, but people have to trust that their colleagues are going to maintain social distancing, will not come into the workplace if they have a fever or have tested positive. And they're also concerned that they'll wear, masks or do other kinds of things that are part of a return to the workplace in some level of safety. And it's not having a level of comfort with their colleagues comes up often.
And we're certainly missing, I guess, the personal touch and engagement at the level we used to have it when we were back in the office. What did you find people were saying when it comes to what it is they miss, what it is they want to get back to when they get to the office?
Well, they certainly don't say things like, I can't wait to get back to the office because they have a better Xerox machine. And, there's just so many different systems that I only have access to in the workplace. What they do talk about missing is the collegiality of their colleagues. And they miss that, especially if you look at some generations for whom their work and personal lives are more blended. And so they are not just missing out on a workspace, but also sometimes the ability to connect more naturally with colleagues and friends. What they will say is that they are fearful that they may not have the opportunities for development. They may not have the opportunities to be seen and heard or perhaps recognized. And they will also talk about the fact that they miss sometimes just the spontaneity and the sparks that come from random conversations. I do think that presents a challenge for businesses. They need to articulate why you want to come back to the office, because we've seen many simply do not, or they simply don't want to return to the way things were with a 5-day-a-week commute and several hours into the commute process, simply to go there. And especially if you're in an office space where you need to be masked, and so now you're in a mask on a camera in an office speaking to clients or customers when you could be doing this from home without a mask, as I am at the moment. So I do think companies have a unique opportunity. They need to re-recruit the existing employees they have. People have been through a tough sled for a couple of years, and some of us can perhaps not even imagine the challenges that others have had, because this has had disproportionate impacts on people. And so we need to tell people why it's important to come back to the office, because we're going to maintain some of our culture. We're going to talk about new path forward as we rethink about the culture and the way in which we serve clients or customers. They need to talk about developmental opportunities. They need to talk about the ways in which leaders want to help learn more about how they can support them, even if they're working in a hybrid environment, but make it a reason that's compelling for people to come back into a workplace. Because what people are leaving for, and they're leaving in droves, many cases, is they are leaving for a variety of things, certainly better pay and career opportunities, as has been the case for decades, but they are also leaving for flexibility. They want a company to meet them in the middle so that they can put together their personal and professional lives in a way that makes sense to them now, because we are clearly in a whole different place than we were a few years ago.
We clearly are, and so many things for employers to as they try to set a date for return to the office. Rebecca Ray, Executive Vice President at the Conference Board, thanks so much. And coming up next, Tom Brady has ended his record-setting career. Straight ahead, we look at what's next for the NFL great off the field. Americans continue to quit their jobs at a near record pace, including one very high-profile person, Tom Brady. At 44 years old, the legendary quarterback officially announced today that he is leaving the NFL after a 22-season career that includes 7 Super Bowl victories. Joining us now is anchor and sports reporter Dave Briggs. Dave, good to see you. Thanks for being here. So in his Instagram post today, Brady announced his retirement, and he said, quote, "The future is exciting. I'm fortunate to have co-founded incredible companies that I am excited to continue to help build and grow. We know that he was building his business empire even while quarterbacking. Talk to us a little bit about these companies and what you expect him to do now that he has a little more time on his hands.
Yeah, well, most notably, and it's good to be here, he said it's a work in progress. I think, quite frankly, Tom Brady has no idea what's next. He just knows that he can't, in his words, do it as a 100% competitive commitment that he's given the game the last 22 years. So he knows it's really time to step away and focus first on his role as husband to Giselle and father to their 3 kids, and then kind of figure out the business ventures. But to your point, he does name check those 3 companies that he co-founded: TB12, Autograph, and of course the Brady clothing brand. I don't think he knows exactly what his time commitment looks like moving forward. You point to those on your screen. FTX is the one he did not name check, and that's his entry into the crypto space. And I think FTX probably feels a lot like Patriots fans and Bill Belichick and Bob Kraft, not mentioned in a 9-slide retirement announcement. Patriots fans feel jilted. He just tweeted in the last hour, by the way, "Thank you, Patriots Nation. Heart emoji. I'm beyond grateful. Love you all." But that won't stop the calls on WEEI Sports Radio in Boston. They are furious. They can't believe they weren't the focus of his retirement announcement. Those 3 give us a pretty good idea where he'll focus. I think TB12 is the most likely of those to give most of his devotion, because it's the most authentic to his brand. Who doesn't want to look like that dude and train like that guy at age 44? Count me among them.
He definitely lives and breathes TB12 for sure. He's also big into meme stocks. But I'm wondering, what are the odds that he goes into broadcasting? Because he would be a huge get.
I guarantee you every network will reach out to him if they haven't already within the hour, probably throwing in the neighborhood of $20 million a year at Brady. I think he's more likely, quite frankly, to run for president of the United States than to enter the broadcast booth. I covered Brady for 5 seasons while a member of the Patriots as a Boston sports reporter. In the 22 years in which he played the game, 21 he made the playoffs. How many interesting things he said from a microphone in those years? I think you could probably keep your socks on. You could probably count them on your fingers, because he's just not an interesting guy in that way. He doesn't want to be critical of his former teammates, of his friends. I think it's just way too small for a guy that's the greatest of all time. Can you imagine Michael Jordan in the broadcasting booth? No way, no how. But on top of that, quite frankly, I don't think Tom Brady would be any good as a broadcaster, and I think he knows that. And that's the biggest reason why he'd have no interest. In terms of staying around the game of football, I'd also rule out coaching. Way too big a time commitment. The only level at which I could see Brady staying around the game is as an owner, and that may be way down the line. I think it'd only be a team he feels personally connected to, most notably somewhere around the San Francisco 49ers. Yeah, maybe the Patriots, maybe as a minority owner.
All right. Well, you know what, Dave, with about $300 million in career earnings, Tom Brady can do pretty much anything he wants in retirement.
Yeah.
Dave Briggs, thanks so much for being with us.
That's just his earnings on the field, close to $500 million when you incorporate his endorsements, and his wife, Giselle, is worth even more. So yeah, he can do whatever he wants to do.
Lots of freedom there, but coming with all that money for sure. All right, Dave Briggs, thank you. Karina, back over to you.
Yeah, whatever comes next, the moves will be as big off the field as on the field, I'm sure. All right, we will pivot from high energy on the field to a look at the energy sector and how crude oil settled on this first day of February. Stay with us. And welcome back to Yahoo Finance. Well, oil taking a bit of a dip today, falling below $89. Goldman Sachs speculation is OPEC Plus could go further than expected to add supply. With more on the energy sector and how crude settled, let's bring in Yahoo Finance's Jared Blickery. And that meeting happening tomorrow, Jared, so I guess all will be revealed then.
Yes, and we're going to be on pins and needles for that. In the meantime, crude oil basically flat, just settled at $88.20, still moving the electronic market, but you can see some pretty sideways, choppy action for the day. Now, on a longer term basis, this is a 3-month chart. You can see definitely in an uptrend here, and we've just been hanging out just under $90 per barrel, which, by the way, is a price that Brent crude oil, traded overseas, has been trading at very recently. Also want to check on the energy sector. We've been getting energy earnings this week. This morning it was Exxon. They're increasing production next year. These guys are flush with cash. This is a 3-month chart, and you can see this acceleration to the upside here. Huge day for Exxon Mobil. And I was just taking a look at a max chart. This is going to go back all the way back to the 1980s. And you can see basically from 2005 and on, Exxon has been dead money. We did have this, what I would call a false breakdown, huge breakdown. That's, of course, related to the pandemic to the downside, but really climbing back within that range. I wouldn't be surprised by the end of this run for XLE and crude oil to see it test the upper end of its range, knocking on the door of $100 per barrel. So pretty interesting to see the developments in the energy market. I'll show you Chevron as well, which has been hitting record highs, so advancing a little bit more than Exxon very recently. Guys?
All right, and sleeves rolled up there, Jared. You mean all business today.
You bet.
All right, we'll leave it there. Thanks so much, Jared Blickery. We want to turn now and take a deeper delve into the JOLTS report that came out earlier this morning. Let's bring in our guest, David Dodson from Stanford University. He's a business professor there. Sir, thank you so much for your time today. And just want to get your reaction on that JOLTS report. So 10.9 million open jobs, slightly higher than the 10.8, which was revised higher from the month before. 4.3 million was the quit rate, down slightly, so that's about 2.9%. Still about 1.7 jobs available for every person that was unemployed last month. Your take?
Yeah, well, I think the remarkable thing about what you just said is that there's not a lot of change. We're seeing this leveling off in all of the ups and downs of the job market. And it's really important when you look at these job numbers to remember that the recession and the recovery was not caused by economic activity. It was caused by a disease. And that's different than anything we've seen before. And in fact, that disease, the impact of the disease was exacerbated by 3 factors, all of which we couldn't have predicted. I mean, the first one, of course, remember, we thought we were all going to go home for a month and use a lot of Purell and wipe off our groceries and just return back to where we were. But these 3 things came into effect. The first one, of course, is that we discovered that we didn't have to work in the workplace all the time. The idea of remote work came about. The second is that state, local, and federal government threw trillions of dollars at employers and households, which created a lot of flexibility. And then, of course, the last one were the variants. I mean, we thought this was going to be over in no time at all. It's been going on for quite some time. So what's really important when you look at these job numbers is to understand we are not seeing the Great Resignation. We're seeing the great reorganization. The workplace is getting reorganized. And as you watch that, think about this, the job numbers, all of them, the quits, new jobs, unemployment. Think of it like a saw. And the teeth on the saw, ignore them from month to month. Instead, look at the direction of the saw, sector by sector. And there's a lot of information there for smart economists and also smart investors.
I'm wondering, what about some of the biggest areas where we actually saw declines, and then where did we see, some rising job openings?
You're talking about in the last month, or this more general trend that we're seeing?
This more general trend, and the JOLTS report today, we did see, hiring in food services and information and state and local education, but finance saw some leveling off as well. So what are we seeing just generally and more broadly as far as where the jobs are?
Yeah, I think what's important is to zoom back just a little bit. You don't have to zoom back, years and years, but zoom back a little bit and look at these trends that you're seeing, which are profound. I mean, one, for example, business travel, because remember, as you look at the statistics, don't check in your common sense. We know that business travel has changed fundamentally, and that you're starting to see a leveling off of those numbers. But then in contrast to that, you look at, for example, the employment sector around trucking. It's off the charts, right? But that's because we have a temporary dislocation in the supply chain. Ignore it is my view, because that's going to settle back down. So these are the things that, as I said, smart economists and smart investors are going to look at. And you've got these trends that are going on. It's like everybody is rethinking their workforce. Even as you said, the previous guest, even Tom Brady is rethinking what he's going to do for a living.
Yeah, absolutely. I'm wondering, what do you expect to see in the government jobs report that comes out on Friday? Some analysts are saying we look for a soft number. The consensus is about 150,000 jobs added, but some are saying negative numbers as well. Where do you see that?
I would be shocked if it's not negative. I mean, I think it will be negative numbers, but that's because, of course, everybody, or not everybody, but lots of people are staying home because of the Omicron variant. Ignore it. It's going to go away. That's going to flush through the healthcare system. It's going to flush through people's immunities, and we're going to return back to work. So people who are not at work because they've got a relatively minor COVID variant, ignore it. Okay, it's like you wouldn't look at a snowstorm in New York, and because because employment went down for a week in the month of January because of a snowstorm, you wouldn't say, "Oh, well, that's a trend." You would ignore it, and that's what I think the smarter people are doing right now.
And then, do you think that we are at maximum employment at this point? Jay Powell says he thinks we are.
Well, one of the things, I said that this is not a great resignation. This is a great reorganization, but there is one effect that I think is permanent, which is someone who's, let's say, 68 years old, who was thinking, I might retire when I'm 70, and then COVID hit, and they got out of work or they stepped out of the workforce. They're not reentering the workforce. That's a permanent dislocation. What's not permanent is a 35-year-old who, because they got a wad of money in the mailbox from the government, or they decided that they didn't want to work over a hot oven in the middle of the day, and they're rethinking their employment situation, those people will absolutely return back to work. And what we've seen is these people are on the sidelines for a temporary period of time. Jobs have returned. Employers are saying, please, please, please come back and work, and I will even pay you more. And people are moving back into the workforce. But the idea that a 35-year-old who has decided that because they had an opportunity, has stepped out of the workforce, is permanently out of the workforce, is absurd.
All right. Well, we will have to leave it there. The White House is predicting dismal numbers this Friday, in part due to that Omicron variant. Thank you so much for your time, David Dodson, Stanford University business professor. Alexis?
All right. Thanks a lot, Karina. Coming up, the viral LinkedIn post that has sparked a conversation about equal pay. Welcome back to Yahoo Finance Live. A LinkedIn post that went viral over the weekend has sparked yet another conversation about pay equity. This is from Mercedes Johnson. She's a recruiter at Honeywell, and she posted, "I just offered a candidate $85,000 for a job that had a budget of $130K. I offered her that because that's what she asked for, and I personally don't have the bandwidth to give lessons on salary negotiations." Well, that got our Yahoo Finance contributor, Mandy Woodruff-Santos, all fired up. She's not alone. She's here and joins us now. Mandy, we should note the recruiter has since taken down that post. But what did you think the moment you read that?
I think I was grateful for TikTok and Instagram to give me an outlet to get all my frustrations out yesterday so I could come to Yahoo with like a clear head, because my immediate reaction was rage. Rage on so many levels. Rage as a woman who's made it her life's work to do exactly the opposite, to empower women, especially women of color, to know their value by giving them information, not by withholding it and then making fun of them on the internet, shockingly enough. So that was my initial reaction. But honestly, I want to say thank you to Mercedes. I'm sure she's going to get her comeuppance in whatever way, her employer decides or the internet decides. But thank you for exposing what is still happening very much. And the fact that we're telling women, know your value, know your worth, be strong negotiators, but we're actually just ignoring the fact that we rarely have all the information. The people in power, like Mercedes, the Mercedes of the world, there's more than just her out there. And companies have the power to show us our value by doing certain things. So that's what I want to put the emphasis back on, putting the onus and the responsibility where it should lie, with the power and the stakeholders.
Amanda, you yourself have been in a hiring position, and you say you've experienced situations like this, and you've taken positive action. So just explain in your own experience what you've done.
Absolutely. This is a story that I'll never forget because it happened to me. I'm a woman of color. I'm a Black woman. As a manager, I want to do things differently, right? I want to make sure that I hire a diverse team. I want to make sure that women feel like they've got a career path on my team. And yet I also had a massive wage gap between two employees on my team, a white woman and a woman of color. And this was a gap that happened simply by, virtue of there being an acquisition and budgets changing. This happens all the time. There was no malicious intent. But when I see something, I had to say something. So I actually brought this up to my higher up. There's levels of hierarchy. Everyone's got a boss, including myself. I go to my manager at the time, and the response was really disheartening. It was, well, that second employee, she had an opportunity to negotiate and she didn't. The reality is that the first candidate didn't negotiate either. Again, it was just the fact that the budget had changed over that time. And it took me about a year, but I was able to get that gap closed by being a very squeaky wheel and by using every process I could get my hands on to make that happen. But not a lot of managers know that those strategies exist or even how to navigate that when they come across it. And I wasn't a CEO. I was just a mid-level manager trying to do the right thing.
So then what tips, now that you're sort of on the other side of things and you're the one negotiating in a more leadership position, what are some tips that you can share for leaders to address pay disparity within their own workplace?
Absolutely. And thank you, because again, I want to focus on the people who have the power to make the changes, and let's stop telling women it's all up to us to be better negotiators. Okay. So what can companies do? First and foremost, I love the idea of having something called a compensation review board or a compensation review committee, people who are tasked with at least once a year reviewing compensation at the company across the board, just like I did sort of informally, and finding things that don't make sense. Why is someone over here making less than someone over there? Is there an explanation for that? And if there's not, let's close that gap. So that's the first and biggest tip I have. I also love the concept of during those annual reviews, having companies establish peer reviews for the people making promotion recommendations. I actually was a part of a company that had this sort of process, and it was great because there wasn't any of that, giving a promotion to some guy that I like, or, someone that I brought into the company and I'm trying to give them a leg up. You had to actually, debate with your colleagues why you were promoting someone, why you were promoting them over someone else, why you were, recommending this certain raise. And these are two great strategies that I recommend in my article.
Mandy, I've been on the other side of this equation as well, as that person who, is in the lower quartile. I'm a minority, I'm a woman. And I think cultural aspects come into it as well, because growing up in Hong Kong, you never asked for a raise. Your boss just looked at you, knew you did good work, and promoted you. That's definitely not the case. And I found that out the hard way. For years, I had a boss who wouldn't do anything. And finally, there was a boss that came in and he opened up everyone's contracts, looked at everyone and saw what they were getting paid. And he said, I'm shocked by the disparity, and immediately, doubled my salary because that's how much I was underpaid. Now, a lot of applicants now want job transparency, right? And so they want minimum and maximum wages to be posted. That's something that is coming in New York City. That law is going into effect in May. But then businesses are pushing back. In New York, they say it shows that, it sort of takes away from business priority and shows that it's not a good place to do business. What do you think about that?
I think any time that we're giving employees more information about the role they're about to assume, that's giving us power back, and it's giving us power to know our value. Listen, employees out there, the people that companies want to work for them, we are human beings. And by the way, inflation's at record highs. Like, we're in survival mode. A lot of families are. So yeah, don't penalize us for wanting to know how much are you going to pay me for this role before I take time out of my workday to go through the interview process, the whole rigmarole. Now they're asking candidates to do video interviews and, talk to a camera and submit questions like they're auditioning for a Hollywood movie. So I think it's not too much to ask companies to sit down, thoughtfully put together a salary range. This is the real reason I know companies don't want to do it, because it takes time. Oh, how much do we want to pay for this role? Actually taking a proactive step in determining that versus letting whoever comes in off the street and negotiates, determine their market rate. So I think this is great. As I will say to workers who are applying for these jobs, when the salaries are posted, keep in mind that you can still negotiate. It's a range, right? So you can still get above that. I don't think it means you shouldn't negotiate. But yeah, I'm on team worker all day, every day.
What's the phrase? Everything is negotiable. All right. Mandy Woodruff Santos, Yahoo Finance contributor and co-host of the Brown Ambition podcast. Don't forget that. Thanks so much for being with us. Karina?
Okay, and we'll switch from salary negotiation to how you actually get paid when you get the job. Cryptocurrency continues its wild ride. So why are some people asking to be paid in digital currency? That story ahead. Welcome back to Yahoo Finance. Well, New York City Mayor Eric Adams vowed to take his first 3 paychecks in crypto when he took office at the start of the year. But is that easier said than done? To explain, let's bring in our Yahoo Finance's Alexandra Semenova. So Alexandra, he got paid last week. He took his check and he converted it part into Bitcoin, part into Ether. But he did it at a time of a crypto sell-off. So how smart an idea is to do this?
Yeah, Karina, New York City Mayor Eric Adams lost about $1,000 converting his first biweekly paycheck as mayor to Bitcoin and Ethereum after they plunged. And this is according to an analysis by the New York Post. He's one of several high-profile figures who have come out and said that they're going to accept their salary in Bitcoin to make a statement on where they stand on financial innovation. And with digital assets becoming increasingly institutionalized, crypto payrolls are something that have come up often, but are still kind of working their way out in terms of the logistics. So politicians like Eric Adams, like Mayor Suarez of Miami, are doing this to kind of pave the way forward for their cities and try to be the leaders of financial innovation for the cities that they represent. But the recent pullback that we have seen in the crypto market really underscores the risks of choosing to convert your salary into crypto. And one of the biggest, most obvious risks is the volatility that we have seen in this asset class. Big price swings can dramatically affect the actual sum of what is paid out on every paycheck. And while there is potential that this could rebound and there is potential for upside, experts say that the reason that they're taking on only part of their salary is because they can afford to weather this level of risk, whereas ordinary people perhaps can't afford to get their wages paid out in crypto and risk the asset class plunging. Karina.
Oh, hey there, Alexandra. It's Alexis. I know. And just to be clear, Mayor Adams is taking his first 3 paychecks in crypto, and then he's reverting back to the U.S. dollar. But aside from all the volatility in the crypto space, why might somebody want to think before they actually make that decision to take their salary in crypto?
Well, there are several reasons that this is still a bit of a gray area. And one of the other reasons is that we're still ways away from using crypto as a means of payment on a broader scale. So if you want to use your earnings for a direct transaction, like paying everyday expenses, there are very few companies that accept it as a form of payment. So you can't really be paying your rent with it. You can't be paying for groceries or utilities or anything like that. Another reason is taxes. There's a lot of paperwork involved in this. And with looming regulatory clarity, there's still room for the IRS to change some of the guidelines on how it is taxed. And a lot of payroll departments will have to figure out how they pay out crypto salaries and how they properly tax them. And then, of course, crypto scams as well. Once you deposit a crypto payment, it's really hard to track afterwards. And there's possibility of hackers going in and wage theft happening once you submit that payment. So it's still being figured out, and we're ways away from seeing it rolled out on a broader scale.
Okay,
Alexis.
Alexandra Semenova, Yahoo Finance, thank you so much for that report. It's still the Wild West for sure. That about does it for us. We are out of time. For Alexis Christoforous and myself, thanks so much for being with us this afternoon. There is much more on the other side of the break when we send you over to our colleagues, count you down to the closing bell and Alphabet earnings after the bell. Stay with us.
Stocks are trading mixed to kick off February after a stretch of volatile trading saw the S&P 500 post its worst month since March 2020 in January. Earnings are in focus tonight with Alphabet, AMD, and Starbucks each poised to post their quarterly results. We'll have team coverage of those reports after the bell and a breakdown of what all of these mean for your portfolios. Plus, it's game on for video game deals. From Microsoft's acquisition of Activision Blizzard to Take-Two's tie-up with Zynga, and now the New York Times purchase of Wordle, M&A in the video game space is heating up. We'll bring on Wedbush Securities Managing Director of Equity Research, Michael Pachter, to talk about all of it in a bit. And it's official, Tom Brady is retiring. We'll have the highlights from the football legend's 22-year career and a breakdown of what this means for his business ventures from TV12 to his autograph NFT platform later in the show. We have an hour to go until the closing bell. I'm Emily McCormick.
And I'm Brad Smith. Great to be with the viewers. Great to be here with you as well, Emily. We've been keeping a close eye on the markets here going into this last hour of trade. And at the top of this hour, we're taking a look at the Dow, the S&P 500, and the Nasdaq, all holding on to gains right now. The Nasdaq barely by the hair of its chinny chin chin, flat but to the upside, just by about 5 points there. We'll continue to track that. The S&P 500, you're seeing that up by about 0.1, 0.2%, sitting right in between there. And the Dow Jones Industrial Average, that's up 104 points. So we'll see if we hold on to these levels going into the close, Emily.
Absolutely. And for a deeper dive on the market action, let's bring in Yahoo Finance's own Jared Blickery standing by. And Jared, what are you watching in this final hour of trading?
I'm just thinking about Three Little Pigs puns right now, but I want to focus on the market action. I'm not going to blow the market down. We've seen enough of that in the last hour of trading in the last week or two. S&P 500 doing a whole lot of nothing today. It's been up, it's been down. I want to take a longer term look because we are at a threshold right now. Cleared the 200-day moving average yesterday. We are right back up into a potential sell zone. Goes all the way up to just short of 4,600. Market turns around in there, probably at least testing these lows, and they may not hold. You take a look at the volatility situation. We are seeing quite a rapid decline in the VIX right now from these elevated levels, almost 40 there. But I've been showing this 5-year chart. I think this is pretty telling. I'm going to take the moving average off of it. We've been seeing lower lows until very recently in the VIX, and now we're seeing higher highs, and I expect that to continue this year. So even if we are in the clear for this little bout of market rout that we've been seeing here, I think we're going to see more of it in the weeks and months to come, especially as the Fed, are they going to tighten? Of course they're going to tighten, but the balance sheet, it's all about the flows. So I think if they shrink the balance sheet too soon, it's going to be a disaster for at least a couple of markets here. Now, here's a 10-year T-note yield. It's up about 2 basis points today, but relatively muted action relative to what's been going on recently. 30 years up 3, and the 5-year is up 2 basis points. But I want to take a look inside the market. And here we have the Dow Jones. You can see kind of a mixed board here. Tech not doing that well. We do have Alphabet earnings after the bell. Also AMD, going to be huge focus on that. You can see Alphabet already up 1%, Facebook up 1% as well. So this communication services sector doing pretty well. Energy in the forefront, that's up another 3.5%, been on fire this year, followed by materials, industrials, and financials. It's been about the value trade today, guys.
Jared Blickery, thank you so much for that breakdown, and we'll check back in with you later. Let's stick with the topic of the markets now with our next guest. Lee Munson is Portfolio Wealth Advisors Chief Investment Officer. Lee, thank you so much again for joining us as always. Now, the trading that we're seeing this afternoon across U.S. stocks, of course, belies the volatility that we saw over the past month in January. Do you think that volatility is now behind us, or is there more bumpiness that investors should be looking out for?
Well, I mean, I think that when you have a volatility spike like you had last week, generally 6 months later, 100% of the time, the stock market's up. The question is if we're going to see follow through. I'm not sure we're going to see follow through. I think that the concern was a lot about Ukraine. I think that's baked in. I think there's a concern about what the Fed was going to do. But I think the Fed is pretty clear on what they're going to do. They're going to slow roll this thing for the rest of the year. And we'll see if we get 5 hikes like they said. So unless there's some big surprise, right? Like the Fed, hikes by 50 basis points, which I think will be a cold day in hell next month. I think you're going to see volatility might spike up. I don't think you're going to see it back at 40 anytime over the next couple weeks or the next couple months. But that being said, do you want to go in and start buying up all these stocks, sort of the Cathie Wood stocks, the young, unprofitable companies? Or do you want to start looking at analogs from 22 years ago and realize we could go lower? And you don't have to have high volatility to get that slow bleed out of liquidity stocks, the sort of the stay-at-home stocks, and the overpriced companies that don't make any money stocks.
And I guess that's the big question. If you did get a surprise on the size of the hike, how would that impact where, for some of those traders that have already piled into names that they saw discounts on, would that spook them at all at this point?
Well, I think it should spook them. I think that if you want to be in, let's just call it the Nasdaq, the things that are not value, the growthy names, we all know what those are. I think you got to trade them this year. For me, I'm not going to go long. I like to hold stuff for a year and a day or even longer. Most of my clients are older. They want to be investors. They don't want to be traders. But even for me, as a value-oriented guy having his day in the sun this month, I still think that you're going to have to do a little bit more trading to generate excess returns. So I think that if you were going down deep into that NASDAQ, you're getting nice pops here. And I think that if you want to do that for the rest of the year, in the face of the ludicrous idea that higher rates are going to help those stocks. And if you believe that, good luck. But if you're smart and you're a trader, you'll just trade around these bounces and, make sure you have tight stops and don't fall in love with any of this garbage right now.
Well, in one area of the markets that you've been watching outside of stocks has been in precious metals. And you mentioned long gold, silver, and some gold miners. Why precious metals in this environment?
Well, last year, I guess I like to lose money and look stupid, but the ultimate reason is that when you look at a hiking cycle, which can last 2 or 3 years, we've had 6, 7 of them since 1970. And in general, on average, once you get that first rate hike, gold and, by virtue of that, the gold miners, remember, gold miners are just a hyped up version of owning gold, and silver is just gold on crack. Is that you tend to see most of the time in those hiking cycles, gold go up, 30, 60%. The problem is you have to be patient. The problem is that a lot of times to really get all those gains, you have to be in the trade 12 to 24 months. Remember back in 08, 09, gold didn't peak till 2012 after the hikes had already sort of come and gone. And so a lot of people think of gold as this thing that pops right during a crisis, and that's true. I like to go in after the crisis when all the gold, the panic buyers of gold kind of float off away, and then you accumulate positions like last year, which can be very painful, and then you sit on it for a year or two and see if this time it works again. I think it will, and I think that it has a little less to do with how the Fed hikes and all of that. I think it has more to do with the hiking cycle in general, and also the resilience of the purchase power of emerging markets where you get a lot of marginal gold purchases.
Is any of that applicable to digital gold on the other side? And the dips that we've seen with Bitcoin last week touching 33,000 and still trying to set its own bottom and perhaps rebound a little bit. It's up over 5% over the past 5 days.
Well, I was concerned last year, mainly because I wasn't making a bunch of money in gold, and you make a lot more in Bitcoin, that somehow, let's just say digital gold, we mean Bitcoin when I say that. I don't mean Ethereum, I don't mean Dogecoin. When I say digital gold, I mean Bitcoin, the granddaddy, the thing that adults and people over 50 in the biz will buy. And so I think that there was a lot of speculation, I thought of it too, wasn't sure, that it's going to be this new gold. But look at its price action over the last couple months. It's going down big double digits, 30, 40% down. So I think that kind of blew the thesis that people are really looking at Bitcoin as some sort of gold substitute for an inflation hedge or a substitute for, let's say, strange central banking policies on a rate hiking cycle. I think it's really just a risk asset. I always suspected it as a risk asset, and this year it's acting like a risk asset. Honestly, I think that the diamond hands are out. I think if you want to buy digital gold or you want to buy some Bitcoin, I think the prices here are fine. It could go to zero. It's not really real. I think the New York mayor's crazy and just it's a big PR stunt in your last bit about it. But I think that if you want to own some Bitcoin and sock it away with the idea that somehow we all agree it's going to go to 100,000 in the next year or two, I think this is a perfect time to buy. But don't think that it's a replacement for gold, and don't think it has really anything to do with inflation, all this nonsense. It's just a risk asset that seems to front run the market by 4 to 6 weeks, but that's another whole topic.
Lee, going back to central bank policy and what we might hear from the Fed in March, what data or what signs are you looking for on the margins to really inform whether we do get these 5 interest rate hikes that the market seems to be increasingly pricing in as likely for this year?
Well, the first thing is that, there are 2 mandates, which we can't say enough and remind people. Unemployment, it's low. Where are they going to go on unemployment, right? It's back where we were around pre-COVID. So I think that's now off the table. The box is checked. So what they're really going to look at is inflation. And they're going to look at these outputs, and they're not going to take into account energy, which is going to be sticky on its pricing all year because we're only putting 75% of CapEx into the energy sector versus pre-COVID. You do the math, it's going to stay high. And I think they're not going to look at food. So I think what the Fed's going to do is they're probably going to do a 1/4 point because everybody wants them to. I think all the CIOs out there are saying, oh, they could do a 1/2. They're just trying to get some publicity for themselves. And I think the Fed's going to look at starting slow and calming people down and telling us bedtime stories that somehow they're going to tell Treasury to print another trillion, of which they're not going to mop up, and they're going to say there's enough space out there for people outside of the Fed to mop up all that liquidity. And I think that's going to be more important when they look at their data than what inflation is going to be. Because I think there's a general sense of people who watch this, including myself, that we're probably peaking on inflation the next couple months, and the second half of the year it's going to slow down. I think it's all about the taper, and I think that that's what the Fed is going to have to message. I think they're going to choose to run off because, again, I think I'm an inflation guy. I believe there's inflation. I was talking about it a year ago, but I think it's going to cool off the second half of the year. The Fed knows it. They're going to taper slowly, and there are going to be some people really shocked that the Fed's just going to let this thing get out of control. Maybe. We don't know. Time will tell.
Absolutely, time will tell. Definitely inflation being something we're all watching closely. But Lee Munson, Portfolio Wealth Advisors Chief Investment Officer, thank you again so much for your time. Coming up, Pfizer and BioNTech are expected to ask the FDA to authorize their COVID-19 vaccine for children aged 5 and under. We'll have the details on the other side of this short break.
Welcome back to Yahoo Finance Live, everyone. Pfizer and BioNTech's vaccine is expected to be submitted for emergency use authorization for children 5 years old and younger, which may offer another countermeasure against the spread of COVID-19 for daycares and schools. For more on the review and approval process, we bring in Yahoo Finance's Anjali Kamlani. Anjali, what do we need to know about this process that we may be moving towards for Pfizer and BioNTech's vaccine?
Well, what we do know is that there have been a couple of small updates towards getting to that EUA. Currently, we know that there was a recent report from Bloomberg that cited that the company had already started submitting the data. Meanwhile, there had been some reports yesterday that they could have filed for that EUA by the end of today at earliest or by this week. But we have actually heard from Pfizer, and I just want to remind everyone that we did hear a similar timeline from Pfizer's CEO, Albert Bourla, recently. Listen to what he had to say then.
We are in discussions with FDA and we will submit everything to them. I hope that things can move very, very fast. Actually, not in months, in a few weeks.
In a few weeks, and that was in mid-January. So here we are a few weeks later, and we did get that report, of course, of that filing of data. Now, that data does point to a 2-dose vaccine for ages 6 months through 5 years, and that is going to be different. We already know because the trial did indicate that a 3rd dose is going to be needed. So it appears that the strategy is, with a little bit of push from the FDA and health officials, for the company to be starting to submit the data and then expand it on a rolling basis to include that 3rd dose, potentially getting a green light, knowing that the catch-up period, whether or not those kids are going to need that additional dose, will come later in time. As we've seen, of course, with adult vaccinations, there's a time gap between the vaccines. So it gives the company enough time to continue submitting that information. In a statement to Yahoo Finance, Pfizer did say that they are looking to submit, but not at this time, and they're continuing to collect that data from the 2 cohorts. Back to you.
Anjali Kamlani, Yahoo Finance's own, with the breakdown there on this impending process that could be started any time here. Thanks so much, Anjali, for those updates. And for more on the analysis as to what this could mean going forward from here, Dr. Payal Patel joins us now. She is the infectious disease physician over at the University of Michigan. Thank you so much for taking the time here with us today. First and foremost, what does this EUA application potentially signal for schools who may soon add the COVID-19 vaccine to the historical prerequisites that have been in place?
Oh, yeah, that's a great question. I think we forget that, vaccinations have been a part of our daily life for schools, for colleges for so long. And so I think it's just another step in protecting kids' public health as we move forward. And I take it as really, really good news for parents of young kids who have been struggling with, daycare and outbreaks in school and classrooms and then having to stay home. So I think protecting every member of our household is going to be really, really helpful moving forward.
In terms of the COVID cases that you're seeing right now, of course, in Michigan, I've been reading that quite a bit of community spread has been taking place in schools, even as overall cases have been coming down throughout the rest of the state. Are you seeing cases get severe enough among the school-age population to actually require hospitalization or visits to the doctors? What's the situation looking like on that front?
Yeah, definitely. We're actually preparing for a huge snowstorm as well this week. So there's a number of different things going on with school-age children and people going to work. But what? Unfortunately, we have continued to see kids come in, and at this point, because we've had the vaccine for so long for adults, the kids are really the ones that are still at risk. Fortunately, many kids don't get sick enough to have to come into the ER or go to the hospital, but we are, just like many other hospitals in the US, still seeing kids who do have to come into the ER. If you're sick enough to come into the ER, many times you are going to have to get admitted and come into the hospital. So if we can prevent even one of those hospitalizations, I think that's making a big dent.
You know, when we consider where we find ourselves at right now, and our colleague Anjali was laying this out a moment ago, and where adults, many of them already in the booster phases, where kids are continuing to catch up to where the rest of the population has seen emergency use approvals or even full approvals, Moderna, Pfizer being two of those main approvals that the FDA has given in full. And so with this in mind, vaccine manufacturers, they haven't signaled when they're going to shift their production into a for-profit model. But what do you anticipate the continuance will be of people who get vaccinated when we reach that pivot in the future?
Ooh, that's a good question. I mean, I think that, one thing, I think a lot of people have been waiting for this moment when kids can get vaccinated. A lot of people have been waiting, I'm gonna be able to feel so much better about my child going to the classroom or going to their outside, sports activities or indoor sports activities. So I do think that just having that last part of our population be eligible for that first vaccine is going to be a pivot in itself, because as soon as we can get everyone kind of vaccinated in those different age groups, it's going to really be a game changer, because going from unvaccinated to vaccinated is, that's a big step in itself. It's really protective to your family unit. I think, it's still to be seen what vaccine companies are going to do. How many boosters are we going to need? A lot of that is still the unknown. But I would say for now, given all the news that we've had about variants and everything, the vaccines continue to hold up. So the best thing that you can do definitely as a parent is don't wait, as these vaccines are available. And I say this to parents of teenagers as well as, children above 5. And then again, in that younger age group, the most effective time to get that vaccine is now.
In other vaccine news, of course, yesterday, as Brad was alluding to, Moderna's COVID-19 vaccine just received full approval for adults by the FDA. Do you expect this to meaningfully increase vaccination rates among those who had still been holding out and waiting for that full approval? Or does this not necessarily move the needle, considering that we have had that full approval from the FDA for Pfizer and BioNTech's vaccines since last August now?
You'd have to, go find that one person who is waiting for Moderna to get the full approval, but not Pfizer. So I think, there was a group of people, I always think about the iPhone. There's the early adopters who get the iPhone early, those who wait. It's very similar with all sorts of technology, and it was similar with vaccines. There were people who got it early and were willing to get it. That was a lot of healthcare workers. Those who maybe wanted to wait a little bit. I think we're starting to really fulfill all of those. And then there's people who, I'm not sure that the FDA approval will affect them or not, but we've already had that for Pfizer, which is a very similar vaccine. I do think that all of this is good news, though, for all of those folks who want to see more evidence. At this point, we've had millions of people vaccinated. Very few people have had any kind of side effect. And really, we've protected all of those that have been vaccinated. So, for folks who are waiting, I think the evidence is already out there.
Absolutely. Some important updates that we're going to be continuing to track even as more of the approval processes move forward. Dr. Payal Patel, who is the infectious disease physician at the University of Michigan, thank you so much for the time and helping us break this down here on The Day. And on the other side of this short break, everyone, coming up, the video game landscape has hit a consolidation power boost, with major acquisitions reshaping the way that games may be developed, distributed, and enjoyed. We'll discuss the latest tie-up on the other side of this quick break.
Welcome back. Deal-making in the video game industry has been heating up, from Microsoft's record deal to buy Activision Blizzard to Take-Two's acquisition of Zynga, and now the New York Times deal to buy Wordle. Michael Pachter is Wedbush Securities Managing Director of Equity Research, and he joins us now for more. Michael, thank you so much for joining us. And you have a new note breaking down all of these deals and more that have been taking place over the past month. But I'm wondering, what do you think really has been driving all of this M&A activity, and why now specifically?
Well, the Times for Wordle, I think, is just a nice fit with Crossword Puzzle, and it's a tiny deal, single-digit millions compared to multi-billion for all the other ones. I think Microsoft has a vision and a strategy, and they made a bold statement with their acquisition of Activision, and it fits their strategy. Take-Two surprised us, and explained it very well when they did it, but we didn't know that they wanted to be big in mobile. And they clearly do. And so they bought, one of the two big public mobile companies, the other being Playtika, and they paid up for it. And Sony, I think, just did a Me Too statement and said, we're not going to be left behind, so we'll buy Bungie. The Activision deal and the Zynga deal were both done below those stocks' recent highs. So Activision had traded over 100 and the deal was at 95. Back in October, it was at over 100. Zynga had traded over 11, I believe, and the deal was done at 986. So, they didn't really overpay either of the acquirers. Bungie went for $4 million per developer, and most deals are between 250,000 and $1 million. I've seen deals as close, as high as $2 million per developer. This is crazy talk. And just to compare and contrast, EA bought Respawn about 3 or 4 years ago for $700 million with 400 developers, and those guys generate $700 million a year in revenue. Bungie does about $200 million in revenue. So I think Sony vastly overpaid. I think this was a statement that we're not going to let Microsoft get ahead of us, so we'll just buy something out of desperation. It's not really a deal that makes a whole lot of sense to me. The others do.
Mike, how much of the acquisition fever in gaming is metaverse driven, or is there something else in the near term that these companies are going to have to rely on to bridge them to that point where the metaverse and the acquisitions that they've made are a reality in that immersive realm?
The two guys, the two public company CEOs who talk the most about the metaverse are probably the two public company CEOs who know the least about the metaverse. So that's Mark Zuckerberg and Satya Nadella. If you actually read Phil Spencer's blog post, Phil runs Xbox at Microsoft, explaining the acquisition to Microsoft employees, the word metaverse didn't appear in about a 4-page post. So nothing to do with metaverse if you're actually Phil, who runs Xbox. Everything to do with metaverse if you're Satya Nadella, who has no idea what metaverse is. So truthfully, I think content is going to be the lead as the metaverse evolves, much like games are the lead application on phones. But you don't buy phones to play games. You happen to use them to play games more than anything else. The metaverse is going to have tons and tons of content. That'll be the hook. But the real opportunity in the metaverse is for brands to sell you goods that follow you anywhere you go and to advertise. So I actually think Facebook's right to be getting into it. I don't think their approach is right. They have a walled garden, and I don't think they're going to let anybody in who comes in from outside. So I think they're going to fail. And I think Zuckerberg's vision is the metaverse is like Ready Player One, put on your headset and live in virtual reality. That's not what it is. This is just an internet with no barriers and universal wallet. Anything you buy, you can take anywhere you go on the internet. Much like if you buy a pair of Nikes, you can wear them into a Puma store and they won't kick you out. In the metaverse, you're going to put Nikes on your character in Fortnite and then wear them into World of Warcraft or whatever other game you play, and nobody's going to stop you. So I think knocking down walls is key. Microsoft may do that. I don't think that Facebook has a chance of doing that. And the metaverse, the real metaverse, is half a decade to a decade away.
So, Michael, I'm wondering, if not Microsoft and potentially not Facebook Meta, who do you think is best positioned right now to be taking the right approach to growing and becoming a leader in metaverse gaming?
Okay, aside from pundits, Matthew Ball being a pundit who is easily the smartest guy on the planet on metaverse, The two company CEOs who know the most about the metaverse are Tim Sweeney at privately held Epic Games. They make Fortnite, and they have the Unreal Engine, and he really is smarter than everybody else combined. And John Riccatello at Unity. I think those two guys, because they make game engines, are going to provide the toolkit for creators to actually build a metaverse. And I think that you'll get a Unity store module put in. You'll get a Unity Getty Images like repository for NFTs. It could be on the blockchain, maybe elsewhere. But Unity is going to tell game creators, build in anything you want to make portable anywhere. We'll provide the storefront, the universal wallet, the ability to license your creations or to sell them. And so Unity and Epic win. Epic isn't public yet. When it goes public, I think your viewers should strongly consider buying it. And Unity, I just added to our best ideas list. I love that stock.
All right, we'll leave it there for now. Michael Pachter is Wedbush Securities Managing Director of Equity Research, and we thank you so much for your time and your insights. Today is the first day of Black History Month, and as the media and cable landscape continues to evolve, so too has BET. Scott Mills was recently appointed new CEO of BET, and we'll bring him on to discuss the future of the network on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. It's time for 2 and 2, where we're always in the double bonus. Emily and I have two names that we're tracking on the session to keep an eye on as we head into the market close. We're just about 25 minutes out from that. And so, Emily, I'll lead us off here on the day. First up, I got to talk about AMC. Earlier in this session, they were up by over 13%. Right now, they're clinging on to some gains by about 4%, if I'm seeing that correctly. Now, this is on the back of some preliminary quarterly results that the company shared this morning, where total revenues for this most recent quarter, that hit approximately $1.17 billion. That's compared to $162.5 million compared to the 3 months ended December 31st of 2020. And this makes it, for their year-over-2 comparison, one of the best quarters that they've seen since 2019. And so that is notable. We're keeping a close eye on shares of AMC going into the close. And then UPS, got to talk about this one. We've seen some new highs for UPS here on the day. Shares are up, holding on to about 14% in gains. Fourth quarter 2021 consolidated revenues, you saw that come in at $27.8 billion, 11.5% increase over the fourth quarter of 2020. And Carol Tomé actually joined joined Yahoo Finance earlier, the CEO of UPS, saying that these results that they saw are sustainable. So continue to keep a close eye on shares of UPS. With that, I'll toss it on over to you, Emily.
Brad, I'm watching shares of Exxon Mobil. Now, this company just came out with its biggest annual profit since 2014. It reported earnings results earlier this morning as rising oil prices boosted the energy company's latest results. Now, specifically, those full-year earnings were at an almost 8-year high of $23 billion. And the company also generated $48 billion in cash flow from operations in 2021, or the most since 2012. Now, as a result of this increasing cash flow, Exxon Mobil now says it plans to increase the pace of its $10 billion share buyback program, which was previously set to take place over some 2-year period. Now, that news is definitely being taken favorably by investors, and ExxonMobil's stock at session highs was up by at its highest level since mid-2019, still holding on to gains of more than 6%. Now, switching gears now to talk about shares of SiriusXM. That is another company that just reported quarterly earnings results before market open today. They were also better than expected on many major metrics. Now, the company brought in revenue of $2.28 billion for its fiscal fourth quarter, which rose 4% over last year and came in ahead of the $2.25 billion that had been expected. Now, in terms of guidance, SiriusXM sees $9 billion in revenue this year, ahead of the $8.9 billion that consensus analysts on Wall Street had been looking for. And SiriusXM also said it will now pay out a special dividend of 25 cents a share, with that news of an additional capital return also helping boost the stock this afternoon. Those shares have risen more than 4% so far for the year to date, currently up about 5.4% during today's session alone. Brad.
All right, there you go. You got our 2 and 2 to track going into the close, everyone. Switching gears here, today marks the first day of Black History Month, and with hit shows over the years like 106 & Park, Being Mary Jane, Sunday Best as well, BET has been a beacon for Black culture, community, and content. And as the media landscape continues to adapt to viewership trends, so too does the brand BET. So here with more, we've got a real good one for you today, folks. Scott Mills, CEO of BET, joining us. Scott, we appreciate the time. BET is a significant part of Black history, its existence, its continued gateway into culture. So what does the new era vision look like for the network and its properties?
So first, thanks so much for having us here. We're thrilled to be here with you. The new era vision is really that we continue to do that on which we've always focused, which is that we exist to serve our community. And our community is not only our audience, it's all of the talent that you see across the video space, across the music space, across all of the creative talent in this world. In addition to the creative talent, it's the institutions that work so hard to service and support our community, like the NAACP and the Urban League, and it's the leaders in our community. And so we work to service the entire community. And in service of that community, we understand that we have to be everywhere that's important to our community. So we started as a cable network, we moved into the streaming space and now have the largest streamer serving Black audiences. We announced at the end of last year that we were creating our studio that's now supplying content to an array of buyers. And what we'll continue to do is focus on this idea that the opportunities exist for us everywhere where content, community, and culture intersect. And that BET thrives at those places, and we'll focus continuously on wherever those places arise to making sure we have large footprints.
Scott, this is Emily here. You talked about a number of the businesses that BET has been in, from cable to streaming to your studios. Where do you think the biggest opportunity for growth lies right now for BET?
The two big growth engines for us right now, streaming's been unbelievably the growth in streaming has been really extraordinary. In 2021, we generated nearly 100% growth just on the revenue side of that business. We generated 50% growth on the subscriber side of that business. And we expect that business to continue to grow as we continue to just add content to the service that resonates most with our community, and that our audience sees as a supplement, as a complement to all the other great content that's available on other streaming platforms. So that's a big growth driver for us. The other big growth driver for us is really our studios business. What we've seen is that there is incredible talent that's coming to BET that says, I want to be anchored in an institution that understands the breadth and depth of Black perspectives and Black experiences and Black stories, and is interested in supporting getting those out across a broad array of platforms, whether those platforms are Paramount Plus or Showtime or BET Plus. So we see that as a very big driver. That service that studio has gotten a great deal of interest and support, both from the talent community as well as the buying community. So we see those as our two big drivers.
You know, that's significant in terms of the subscription numbers that you were mentioning, that 50% growth. I would love to know the outlook, the forecast. Where are you targeting for, especially a BT Plus streaming service unit that you launched in September of 2019? By the end of this year, what would be a good marker for the company to hit?
So we defer to our parent company to share the aggregate numbers, but we have millions of subscribers at this point, which we think is an incredible accomplishment. When we created the service, there was a real question as to whether or not, given the plethora of offerings that are available in the streaming space, was there really a lane for a service that was targeting Black audiences with Black content? And what we discovered was that while our audience loves to stream content and absolutely values the broad services like Paramount Plus and like Showtime and like others, that they clearly see BET Plus as a supplement to those services. And that understanding of this idea that there is kind of continuous and persistent value in creating content specifically anchored in the Black experience and delivering that to our audience is driving continued growth in that service. So we're expecting another year of significant double-digit growth for BET Plus.
As you've got other platforms in the competitive landscape that are also looking to add more diverse stories and inclusive stories on their platforms as well, I would wonder how much of a premium in price that you've had to see as you're competing for some of those titles, for some of the major actors, actresses, and just the stories to be able to make it to the BET platform.
It's a great question. I think first, lots of conversation in the space in general around price at the moment. We are a premium price service at $9.99 a month. And what we're seeing is that our audience is valuing the very specific proposition of premium content created specifically to super serve our audience, and that as a supplement to that which is being offered by other general entertainment services. The other exciting thing is how many creators are coming to us and saying, yes, I may have a show here, I may have a series there, a movie there, but I really, really want to have something with BET. And that it's a testament to the power of the brand and the relevance of the audience and the relevance of the offering. And so we're really able to say, we don't need to have every project from someone. The example I like to use is Lee Daniels. Lee, who's a great friend of BET and has lots of projects in lots of different places, came to BET and said specifically, I have a project that I think is so well suited to BET and BET Plus. It's a show called Miss Pat. We greenlit the show, and it is one of the best performing series on BET Plus. And it speaks to working with talent that really understands our community. Tyler Perry has amazingly successful series on BET Plus with us. And we have a number, Kevin Hart, we have a series coming up with Kevin Hart. It launches later this next week, I believe. It actually launches next week, Real Husbands of Hollywood. So what we're seeing is extraordinary talent is saying BET is an important part of our overall offering to the marketplace. And we're going to do deals with large streamers, we're going to do deals with large media companies, but it's critically important that we have presence with BET, and that's deeply resonating with our audience.
Scott Mills, CEO of BET, taking the time here with us today. Thanks so much. We appreciate it. And we're going to be looking forward to some of those new content and titles that are coming forward as well. And everyone, on the other side of this short break, we've got much more Yahoo Finance. End of an era as Brady bounces. Tom Brady may be stepping away from the gridiron, but his investments off the field sure to keep him busy. We're going to dive into the legacy of the greatest quarterback of all time. Yeah, I said it. And how his football IQ translate into business acumen next.
Welcome back. Tom Brady's football career may be coming to a close on the field, but he has plenty to keep him busy elsewhere in his sprawling business empire. Yahoo Finance's producer and sports reporter Josh Schaefer joins us now for more. And Josh, between TB12 and Autograph and a host of other business ventures, Tom Brady certainly has quite the expansive portfolio of ventures. Give us the rundown of these and what are they worth actually today?
Yeah, Emily. So we'll start with just highlighting what Brady did on the field and how it's almost starting to equal itself off the field to some extent, at least monetarily, right? So Brady retired today. He announced his retirement via Instagram at 44. He played 22 seasons, 7 Super Bowl rings. He leaves leading the NFL in passing yards, touchdown passes, quarterback wins. And for all of that, he got paid a total earnings of about $293 million. Forbes estimates that he's made about $160 million from endeavors off the field thus far. And so now he's gotten into different brands that we'll probably see him kind of start to build as he gets away from the field. And he's already started to build those. And I think that's part of what we saw with his retirement announcement over the week, or not over the weekend, when it was reported over the weekend. Then he waited to announce it himself. Brady's kind of built his own brand. He's a content creator, and he's now into other things as well. So he started TB12 in 2013 with his body coach, Alex Guerrero. He now has an ownership stake in FTX, which is the cryptocurrency exchange that we cover a lot here on Yahoo Finance. He's now also a founder of Autograph, which is an NFT platform that's become very popular and is teamed up with DraftKings. And then he also just recently started his own clothing brand, the Brady brand, that we don't really know what that's quite worth yet. But it seems like he's in on pretty much some pretty big deals that are going to add up to maybe more than he ever earned as a player. He addressed that a little bit in his statement today. He said as part of his retirement statement, he said, quote, "The future is exciting. I'm fortunate to have co-founded incredible companies like Autograph, Brady Brand, TB12 Sports that I'm excited to continue to help build and grow. But exactly what my days will look like will be a work in progress." So we're not quite sure just yet what Tom Brady's going to do with these companies, how front-facing he'll be, if he's going to come on Yahoo Finance and talk to us about his NFTs and talk about the brands he's growing. But it certainly seems like, and we know from talking to TB12 over the last couple of weeks, he's very involved in them and he plans to be an active entrepreneur in those ventures.
All right, Josh Schaefer, Yahoo Finance's own producer and sports reporter, thank you so much for that breakdown and look back on Tom Brady's career. We're sticking with this topic with our next guest and friend of the program. Dan Roberts is editor-in-chief at Decrypt. And Dan, I feel like this is the perfect topic for you since you've been covering both sports business, of course, and crypto for quite some time now. And Tom Brady does have a stake in the crypto exchange platform FTX. He also, as Josh was mentioning, has the NFT platform with Autograph. How do you see these crypto-related ventures being impacted by his retirement from the NFL?
Well, first of all, Emily, you're right that sports and crypto have converged like never before during the pandemic. So there was a time when I was covering sports business more heavily, but also crypto. Now I'm heavier on crypto. They are really colliding. That Venn diagram has huge overlap. And Brady is a terrific example, although there is now a story just out today about Drew Brees doing something similar. A lot of these current and former NFL players have really flocked to crypto. It's funny, we did a story at Decrypt today about this. Our newest staff reporter, Kate Irwin, wrote it. And a friend texted me and said, "Stop trying to make the Brady thing a crypto story." But it really is. He invested in, along with his wife Giselle, FTX, as you mentioned, which has quickly become one of the biggest exchanges and has obviously spent a lot of money on sports marketing. So he is an investor in that, and he's an ambassador. They've been running ads with him all over the airwaves for weeks. And I wouldn't be surprised if you even see him appear in the FTX Super Bowl ad. FTX bought a Super Bowl ad. So that's FTX, a major exchange. Then there's Autograph, which you mentioned. He co-founded that platform. It is an NFT platform, and there are a lot of videos of Brady and the other top athletes that have done NFTs with Autograph, quite literally physically autographing tablets so that the autograph is, digital, but it's true to their real signature. And they've added a ton of big names. And they also have people on the Autograph board from Apple, Spotify, and DraftKings, so a lot of heavy hitters there. And in his retirement post, he mentions that he wants to focus on his businesses like Autograph, the Brady apparel brand, and TB12. So he really is going full crypto. I think you'll see more, not less, from him in the next few years.
You think about high-profile figures, whether they be celebrities or athletes historically, and whether they achieve the same type of Oprah effect. Does Tom Brady, is he set or positioned for his Brady bunch of businesses, if you will, that he's invested in, set to hit some of those markers that we've seen some of the businesses that historically Oprah has invested in, they tend to skyrocket thereafter. How can Brady kind of amass that same type of business success?
Yeah, Brad, I think he will be at that level. Now, of course, I'm from Boston, so I'm a little biased. I love the guy. My friends who are from New York and are Giants fans hate him, and they would disagree. But I think as the years go on, it becomes harder and harder to dislike him. I think he's one of those people whose brand seems to be, even though it is extremely kind of buttoned up and he's very PR'd, I think that the general consensus is he seems to be genuine and he seems to be a good guy, a nice guy. I think that he has built a very careful, strong brand. And, you mentioned the apparel brand Brady or Josh Schaefer did. That has the potential to be like a Jordan brand, probably never that big. But if it's taken seriously and if it catches on, I think you could see him do anything. He might end up on TV as an occasional commentator, but I think he wants to do more than that. He certainly is going to be a sort of symbol of healthy living. He's got his nutrition line and all those products. There was a time where people would make fun of the TB12 method. But what I always said to that was, well, it can't be completely crazy because it works for him. Right. So I think you'll continue to see him run the gamut in business, from cookbooks to apparel to workout products to equipment to, of course, the NFTs and the crypto play.
All right, we'll leave it there for now. Dan Roberts, Decrypt Editor-in-Chief, thank you, as always, for your time at joining us this afternoon. Coming up, we've got the countdown to the closing bell. Keep it right here on Yahoo Finance Live.
Just minutes away from the market close here today, everyone. And as we're getting closer to the 4 p.m. hour and the closing cross, we're taking a quick look at the Dow Jones Industrial Average right now, holding on to gains, fractional move higher on the day of about 0.8%. We'll round that off to 299 points to the upside there. S&P 500 also in the green. That's up 33 points. And the Nasdaq, it's up triple digits right now by about 0.75%. We'll round that off too. We're going to be keeping a close eye on three big names after the close as they are set to report earnings. We've got for you AMD, Alphabet, and Starbucks, and all of those holding on to gains going into the close. We'll see exactly where their quarterly results come in at. This comes as we've got 9 out of 11 S&P 500 sectors in positive territory, led by energy. We'll continue to track that. We'll see you with the closing bell next. Welcome back to Yahoo Finance Live, everyone. We are going into the closing bell here, and the closing bell has just rung as we're striking 4 p.m. We're going to go live to that shot in a moment. But first, take a look at the U.S. markets here. Dow Jones Industrial Average, S&P 500, the Nasdaq, you're all seeing those in positive territory. That, as we mentioned before the break, we've got 9 out of 11 S&P 500 sectors still holding on to gains, with energy leading the way here on the day and up big by nearly 4%. So we're keeping tabs on that going into the closing cross here on the day. We've got some earnings that are going to be coming out as well in the form of AMD, the artist or company formerly known as Google, of course, Alphabet, the parent company. They're going to be reporting earnings, as well as Starbucks, plus another major automotive brand. There you're taking a look at FedEx ringing the closing bell at the New York Stock Exchange. Let's listen in as they ring the closing bell here on the day. All right, so the end of trade, that is what we've just struck here on the day, end of trade, and this is exactly where we close things out. Dow Jones Industrial Average closes higher by about 0.8%. There you're seeing gains of about 272 points added on the day. The S&P 500, that closes in the green as well, 30 points to the upside there, 0.7%. And giving us the trifecta, or the hat trick on the day, is the Nasdaq Composite. That closes higher by about 106 points. Just about 0.75%. We'll round that off to there. For more on the markets and how things are moving, we're going to bring in a few of our guests here as we're going to be breaking down earnings throughout the afternoon. We've also got some markets analysis, and first and foremost, we've got Giles Coughlin, who is the HYCM Chief Analyst, as well as Mike Vogelzang, who is the Cap Trust Chief Investment Officer. Great to have you both here with us today. Michael, I want to begin with you and just get your takeaway from what we've seen, if you want to kind of look back to the month that January was and bring us into your expectations as we move through February. Is the worst behind us, or is perhaps more of the declines that we'd seen during January yet to come?
Yeah, that's the $64 question, isn't it? We had a pretty rough January. I think we're seeing a little bit of short covering and some bouncing here off the bottom. I don't think the market's settled yet. We don't quite know yet what the Fed's going to be doing. We don't have a good sense of the path of inflation for the rest of the year. We have Russia, hovering over the Ukrainian border, waiting to invade. That has the potential to send oil prices up even higher than they already are, which of course could slow the economies down and drive inflation higher. So I think the market's really unsettled, and I think it's trying to find a bottom. But I wouldn't. We're not terribly bearish, but I just don't think we're settled yet.
Giles, we talk a lot about the Federal Reserve, of course, here on Yahoo Finance, but one place in the markets that we perhaps should be focusing on as well is what's happening in China. The PBOC, of course, has been maintaining its accommodative monetary policy, cutting interest rates, whereas the Fed is moving towards hiking. I'm wondering, do you think now is the time to really be doubling down on emerging markets and Chinese stocks, assets specifically, or are there risks still in that geographical region as well?
Well, there are risks, but I think technically entering into, say, China's A50 index looks very good around the 15,000 region. It's a key area of support, and it has been holding. So it means risk can be limited quite tightly. So I think there is some attraction there, especially with the People's Bank of China cutting interest rates. The Fed is surging higher. The People's Bank of China is cutting them. There's also due to be fiscal stimulus. And China's very well placed in terms of its clean energy metals. It has a whole range of metals that it both produces and processes in China, particularly rare earth metals, also nickel, copper, all of which are likely to see substantial demand in the next sort of 3, 5, 10 years time frame. So I think China has a lot going for it at the moment. There are risks, but I do think China's A50 index offers really good value, particularly now.
Giles, sticking with you for a hot second, energy sector, the big winner here on the day from a sector performance perspective. What do you believe played into some of that activity here?
Well, oil markets have got this sort of twin factor pushing on them. So first of all, inflation expectations have been dropping recently, which typically you'd see oil prices fall lower, but they haven't been. Now, there's been geopolitical issues with Russia and Ukraine. There's questions about OPEC, whether even if it does increase its production level, can it actually meet that quota? There's also been a series of low inventory demand levels. We've seen the EIA has 8 out of the last 9 inventory reports have been draws. So the near-term factors keep driving oil higher. And I think as long as there's that Russian-Ukraine issue in the background, it doesn't give anyone confidence to be shorting oil, especially if OPEC can't really ramp up production. It does put the pressure on the UAE and Saudi Arabia. So perhaps if those 2 nations could increase production, we might see some downside in the oil markets. Until then, it does look like oil's heading on the way up to $90 and $100 a barrel.
Mike, I want to stick with the topic of the energy markets and specifically energy stocks with you, because for January, we saw the S&P 500 energy sector was the only major sector in the green, up nearly 20%. I'm wondering, is that outperformance a little bit long in the tooth and something that investors should be wary of in terms of how far and how fast this has run up? Or is there still further for energy stocks to continue rising?
Yeah, we think most of the easy money's gone. Most of the money that was, when oil was coming still off the COVID bottom has been made. But, understand, we think Giles is right. There's still a lot of pressure, at least short-term pressure on the upside. The question we have is what actually happens to inflation and, more importantly, the global economy in the second half of 2022. People are starting to use the R word, that is recession, for 2023. So if the Fed continues to raise rates, at the same time the economy continues to roll over, we think energy prices will be significantly weaker by next year. So, it depends on your time frame. I think you could probably make a little bit of money if you bought some in anticipation of a Russian invasion of Ukraine. But I think the weakness in the global economy will eventually trump that demand and that oversupply or that undersupply, and we'll see some softening. We've generally been overweight our energy exposure, and we're beginning to bring that back in line, and probably a bit under. So yeah, I would guess that most of the easy money's gone.
Mike, sticking with you for a hot second as we're standing by for some earnings that are set to be coming out any moment now. When you think about the tone that the companies that are reporting this week, and particularly today as well, where we've got Alphabet, we've got, of course, the advertising side from Alphabet and all of their other bets as well, cloud included. But you've also got a semiconductor name in AMD, and then you've even got a food beverage service company in Starbucks. What type of tone do you believe that'll strike for the rest of this earnings season from these companies and even a major automotive manufacturer as well later on?
Yeah, wow, that's a really wide range, and I think it's impossible to encapsulate that in a pithy phrase, right? I think the biggest, largest, most dominant companies we've ever seen, the Facebook and Alphabet and Amazon and Microsoft and Apple. I think those companies are so large and they're such huge cash flow generators, growing their earnings, growing their margins, growing their profitability and their cash flow, that those are, they are the true unicorns, right? We overuse that word too much now. I think the consumer issue is a problem. I mean, take a look at what's happened to the consumer names that had demand pulled forward because of COVID. Whether it's Teladoc or Peloton or Zoom, those have imploded, right? That demand, that they pulled so much demand forward that now, as it's normalizing, we're seeing those stocks really, really struggle. So it's a wide path. It doesn't take easily to a single sort of characterization. We think the financials are a little toner. We like them. We like the tone that they're coming from. We think obviously the UPS numbers today were terrific news for the industrial, delivery side of the economy. So, again, it depends on the pocket you're in.
We got to go. Giles and Michael, we appreciate the time. Giles Coughlin, who is the HYCM Chief Analyst, and Mike Vogelzang, Cap Trust Chief Investment Officer. Everyone, as we mentioned, we're tracking shares of Google and after hours trading moving higher by about 3% right now. For that, we want to bring in Jared Blickry with the earnings. Jared.
That's right. We hit 2,900 and change. You can see it's right there on your screen, up 5% right now. I'll get to the numbers in a second. I just want to announce that Alphabet has pre-approved and declared a 20-for-1 stock split. So that is going to shave the price. You'd have to divide it by 10. That get you down to 300, and it's going to be a $150 stock. very similar to Apple. So you got to wonder what's next. Dow, another index. Very interesting to think about. But here are the fourth quarter results. Revenue coming at $75.33 billion. That is up 32% year over year, crushed the estimate of $71.8 billion by over $3 billion. Services revenue up to $69.4 billion, up 31% year over year. And that is a beat by $3 billion almost of the $66.64 billion that the street was expecting. Cloud revenue, another small win there, $5.54 billion. Estimate was for $5.42 billion, but that is up 45% year over year. And then other bets. This is kind of the research arm, not looking to make a lot of money here, but they did make 181 million. Estimate was for higher by 209.6 million. EPS came in at $30.69 versus the estimate of $27.35, so beating it by over $3. Operating income, $21.89 billion, up 40% year over year, a little bit higher than the estimate of $21.6 billion. And Google Cloud operating loss, that was $890 million. The estimated loss was $820.9 million, so a little bit wider than expected. And then services operating income beat the street, coming in at $25.99 billion. Overall operating margin coming in at 29% versus the estimate of 28.8%, so just edging out the street bet right there. And then capital expenditures a little bit lower than estimated, $6.38 billion versus the estimate of $7.42 billion. So just looking at the headline number, huge beat on revenue, huge beat on EPS, and they are doing that 24-1 stock split. It's going to send the price right down to just a little bit less than $150. So really interesting to think about the implications for that, maybe addition to an index, or maybe simply to appeal to retail traders a little bit more, because that has been the theme over the last year. Guys?
Absolutely, Jared. And I did want to ask a follow on that stock split, because of course, this isn't the first tech company we've seen in the past couple of years to implement a move like this. What do you think investors should be keeping in mind with this move? Like you said, potentially appealing to the retail investor here by bringing down that per share price anyway. What do you think traders should be keeping in mind with this move?
I think whether it's just to gear it up towards retail traders and make it a little bit more available. Of course, with Robinhood, you can buy fractional shares along with some other brokers, but that's not universal. So it seems like a pivot to me, and I wouldn't be surprised to see a few other companies do this. If we remember what happened with Apple way back in the day, and I think it was GE, they got switched out in the Dow for. They announced a stock split just a month or two prior to being admitted to the Dow. And I don't want to get ahead of ourselves. I'm not saying that's going to happen, but you got to wonder. It seems like it's in the cards, at least.
All right, Yahoo Finance's own Jared Blickry. We're going to be tracking shares of Google here in after hours trading on the big news as well, not just of earnings, but also on that 20-for-1 stock split. Thanks so much, Jared. Appreciate it. Everyone, switching gears here, and pun fully intended, we're going to shift and go over to GM earnings. Our own Pras Subramanian is standing by for those as shares are moving lower. Pras.
That's right, Brad. We got a miss on the top line, 33.58 billion revenue versus 34.46, but then a beat on the bottom line, Q4 adjusted EPS of $1.35 versus $1.20 estimated. Also noting that GAAP income of Q4 net income of 1.7 billion. Last quarter they had 2.4, so a little bit less than prior quarter. And also adjusted net income coming in at 2.8 billion. That's a beat over 1.75 billion. Now, the big stuff here is the outlook. GMC's full year EPS of 6.25 to 7.25 a share. That's versus 6.92 consensus, so right in the middle of that consensus. And then also they see net profit in the range of 9.4 billion to 10.8 billion. I don't have a consensus estimate there to compare that to. One thing I want to note in the shareholder letter, Mary Barra said that with an improving outlook for semiconductors in the US and China, we expect our 2022 results will remain strong. In fact, we expect our EBIT adjusted earnings to remain at our near record levels in the range of 13 billion to 15 billion, while also investing more year over year into our growth businesses like Cruise, BrightDrop, and our rapidly accelerating portfolio of EVs. So looking ahead to the call, we're going to see what is Mary Barra going to say about that EV portfolio. They said just this week that they're going to expand spending in that to $6 billion on a new factory to make more EVs. And then also we'll see Mary Barra go more into that production capacity with the chip situation seemingly improving at the moment.
All right, Yahoo Finance's Pras Subramanian on General Motors earnings. Thank you so much. And the earnings bonanza continues. Starbucks results also just crossed the tape here this afternoon as well. And Yahoo Finance's Inez Ferre is standing by with those. Inez?
And Emily, it's a bottom line miss for Starbucks with adjusted earnings per share coming in at 72 cents. The street was expecting 80 cents a share. Meanwhile, its revenue came in at 8.05 billion. The street was expecting 7.96 billion. So that was a beat. Its China comp sales were down 14%, and the estimate was to be down 9.5%. And international comp sales were down 3%. The estimate was for those to be up 1.27%. CEO Kevin Johnson in a statement saying, although demand was strong, this pandemic has not been linear and the macro environment remains dynamic as we experienced higher than expected inflationary pressures, increased costs due to Omicron, and a tight labor market. We remain focused on actions that drive both top and bottom line growth. And this is something that analysts had been talking about prior to this earnings release, were the costs that the company was facing, costs as far as labor was concerned, and also costs as commodities were concerned, coffee, milk, logistics. This is something that the company had warned about last quarter, saying that it would get better later in subsequent quarters, but not this one yet.
Yahoo Finance's Inez Ferre with the latest on Starbucks after their earnings report. We'll keep a close eye on shares. They are moving lower by about 3.5% right now. Inez, appreciate the update. And everyone, we're going to go to a quick break, but on the other side, we've got a much fuller breakdown on what to expect here from Google going forward, given what the company just announced in their earnings. We've got much more on Alphabet or Alpha Google, whatever you're calling them, here on the other side of this quick break.
Quarterly earnings results continue to roll in this afternoon, and Jared Blickery is standing by with the latest from AMD. And Jared, the stock is up in late trading. How'd they do?
That's right. Another winner here. We got a 5% movement in AMD, and it was a beat on most of the key metrics here. So adjusted EPS for the quarter coming in at 92 cents. Estimate was for quite a bit lower, 75 cents. Revenue coming in at 4.83 billion. That's up 49% year over year, and that beats the estimate of 4.5 billion. It breaks down in a couple segments here. Computer and graphics revenue, 2.58 billion. That's a small beat. And then enterprise, embedded, and semi-custom revenue. That's up 2.24 billion, a small beat as well. Up 17% quarter over quarter. Adjusted gross margin, another key stat coming in a little bit higher than expected, 50% versus the estimate of 49.5%. One of the few metrics I'm seeing that missed. Capital expenditures, a little bit heavier, 86 million, but not by much. Estimate with 78.2 million. Adjusted operating margin, now that is beating the street estimate. It's coming in at 27%. Estimate was for 300 basis points lower. And then free cash flow, 736 million. The estimate was for a little bit higher, 932.9 billion. And then as far as their outlook, they see first quarter 4.9.1 billion, and that is much higher than the estimate of 4.33 billion, probably adding to some of the optimism there. And also Xilinx, that is that is a company that they are slated to acquire, and they're saying that they're going to close that in the first quarter of 2022. Xilinx, by the way, is up 5% as well. And then finally, I have a statement from the CEO, Dr. Lisa Su, saying 2021 was an outstanding year for AMD with record annual revenue and profitability. Each of our businesses performed extremely well, with data center revenue doubling year over year, driven by growing adoption of the AMD EPYC processors across cloud and enterprise customers. We expect another year of significant growth in 2022 as we ramp up our current portfolio and launch our next generation PC, gaming, and data center products. So again, beating on most of the headline numbers, also a very favorable outlook. AMD up 5%, 6% now in after-hours trading.
All right, Yahoo Finance's Jared Flickery, thank you so much for bringing us that report. And just moments ago, Alphabet posted fourth quarter results that beat estimates across most major metrics. Now, the company also announced a 20-for-1 stock split, and Daniel Flax, Neuberger Berman senior research analyst, is here with more. Now, Daniel, that stock split definitely caught our attention here at Yahoo Finance. What do you think was behind this move here for Alphabet?
I think they may want to make the share price a little more accessible to some investors who would prefer to own a $150 stock or more of a $150 stock versus a $2,500 or $3,000 stock. But stepping back, I think what's going to matter most for the shares is their ability to innovate, to grow, to deliver value to the users, to the advertisers. And so that, I think, will matter certainly a lot more than the stock split. And the results this quarter attest to strong performance.
Let's talk more about those results. I just did some simple math looking at the total revenues and looking at the advertising business, which we know historically has come in above 80%. And I remember a time when just years ago, it was sitting at about 86% of their business on a quarter-over-quarter basis. But we're seeing that tick now down to 81%. And the significance of that is because you're seeing the growth in Google Cloud as well. Where do the opportunities, especially as they relate to the margins that this company is going to be able to see in the future beyond advertising, where does that lie for Google, and how can they continue to lean into the cloud at this particular point?
I think the cloud is one of the biggest and perhaps somewhat most underappreciated elements of the story here. I think the company is very early in their build out of the cloud business, but you have strong leadership with Thomas Kurian and the rest of the team there. And when we speak to buyers, they are getting a lot of value from the Google Cloud Platform in key areas like analytics. So I think it makes sense to be investing aggressively as the company is doing. You're seeing strong top line performance. I think you will get to profitability over the next few years. And then importantly, beyond that, this can contribute to the free cash flow generation of the overall company. I think it strengthens the Alphabet story, having this third leg of the stool, if you will, along with search, which remains very durable, and YouTube, which is also a very attractive asset, and in many ways is just getting going.
Well, in terms of the competitive landscape, though, for cloud, of course, Google Cloud revenue was up about 45% year over year in this latest quarter. Microsoft just reported last week that its Azure revenue growth was up by a similar margin for its latest quarter. Is Google Cloud growing fast enough to keep up with Microsoft Azure and Amazon Web Services when you think about these larger competitors?
I think Amazon Web Services and Microsoft Azure, they remain formidable. They're leaders. I think what's important is that the overall market is growing and that there's room for a few companies and a few more beyond that to be successful over the next several years. the key really is around the innovation. So for example, if Google Cloud is able to offer key innovation in key areas like artificial intelligence or analytics, when we speak to customers, they're going to put workloads on the Google Cloud. That is not to say that Amazon Web Services and Azure can't also be successful in many of their key services. When we think about this opportunity, this is multi-year. As we've talked about in the past, this cloud story, as big as these companies are getting, it's still relatively early. So we see room for Google Cloud and Azure and Amazon Web Services to be successful over the next 2 or 3 years.
Okay, earlier, kind of right before the close, we were discussing some of the gaming acquisitions that we've seen. Of course, Google's play has been Stadia, and it's been some of the strategic partnerships along the way. Is Google due for an acquisition, a major one, in the gaming space from this point?
Google, like all the other technology platforms, I think is going to look to innovate, to develop, in this case, games on its own, perhaps, but it's also going to license and could look to acquire some gaming assets. I think we'll have to see with Microsoft and its own gaming strategy, certainly with Activision, whether a deal of that size will get approved. I think anything that Google or the other platforms might look to do from an acquisition standpoint will rightfully get a lot of scrutiny. But I think over the next few years, Google will continue to look at ways to augment, to strengthen its gaming platform. This shift to cloud gaming is very early. And so I think the experience will continue to get better and better. And if you're Google, it makes sense to look for ways to both license content, perhaps have some of your own, but really ensure that the user experience is first rate. That, in my view, is what's going to help drive growth.
Daniel, we're seeing shares of Pinterest, Snap, and Meta Facebook all up in after-hours trading in sympathy with Alphabet after these earnings results. Do you think there's anything that we can glean, any positive information in terms of the broader internet advertising landscape that you think potentially bodes well here for these companies as we soon get their results as well?
I think the environment remains healthy overall. All these companies are cyclical, and they're parts of the economy that are improving. So, for example, travel helped Google. I would suspect it's going to help Facebook and some others as we look forward to their results. But the key for each one of these companies is going to lie in their ability to innovate, to be able to create a lot of value for their users as well as the advertisers on the other side. So I think the read through from Google is that the environment overall remains healthy. I think as we all appreciate these companies, you mentioned Snap or Pinterest, certainly Facebook as well, they have to navigate, as Google does, some of the changes from the Apple iOS updates. And so all of those companies need to continue to refine their measuring and targeting and their tool sets to make sure that advertisers can realize their returns. But overall, I think a positive that we're seeing from Google here in terms of the demand backdrop. But ultimately, it's going to be about the innovation.
All right, we'll leave it there for now. Daniel Flax is Neuberger Berman's Senior Research Analyst, and we thank you so much for your deeper dive on Alphabet's earnings results. And we're going to dive deeper into AMD's latest earnings results on the other side of this break with Patrick Moorhead, More Insights and Strategy founder, CEO, and Chief Analyst. Stick with us.
Welcome back, everyone. AMD shares moving higher in after-hours trading as we're tracking them up by about 8.7% after the company reported its fourth quarter and full year 2021 financial results. The revenue for the fourth quarter of 2021 came in at $4.8 billion. Investors reacting positively to this news. And for more on this, to break down the earnings report, we've got Patrick Moorhead, who is the More Insights and Strategy founder, CEO, and chief analyst. Patrick, great to have you here with us. Help us walk through exactly what investors are taking away from this particular report and sending shares higher here in after-hours trading.
Yeah, so a lot of things going on here. I mean, first off, records for the quarter, record revenue, record net income, and record EPS, and a gross margin of 50% that investors haven't seen for a long time. And then when you add to that an improved outlook for 2022 and for the quarter, it's all coming back for AMD. I'm trying to look for a blemish, but it's hard.
Patrick, as you mentioned, AMD really beating here on every major metric that we've been tracking as well. And I'm wondering, should investors be taking these results as a sign that chip shortages, component shortages that have been plaguing the industry for the past year now are starting to dissipate?
It's interesting. AMD as a percentage of the overall high performance computing chips isn't as high as, let's say, NVIDIA or Intel. I think this is much more of a reflection on its competitiveness and its ability to execute on its roadmaps. And even AMD CEO Lisa Su acknowledges that it's going to be a tough 2022 when it comes to availability.
They saw a year-over-year increase, 67% in their gross profit that came in at $2.4 billion, it looks like. And so with that in mind, where do you expect them to continue to invest back into their operational efficiencies, as we've seen across the chip space? 2022, 2023 even could shape up to be a year of heavy investment to bring more processes to produce online, and then additionally kind of ramp up that capacity in order to meet some of their consumer and customer demand for a company like AMD.
Yeah, so AMD is investing even further ahead on CapEx. And while they don't have their own fabs, they have very strong relationships with TSMC and global foundries. And as you might notice, their CapEx did go up, but I really feel like that's a sign of expected growth into the future. Their profits were driven less by operational efficiencies and more of ASP and revenue increases. They had ASP increases all over their client computer line for PCs, driven by what's called the Ryzen 5000 line. And I also believe, given that data center doubled again, those margins on a percentage basis and on a whole dollar amount are absolutely incredible. Some of these chips sell for thousands of dollars each as they're headed for the data center, and AMD is gaining share, and they have a very competitive lineup for 2022.
We were talking earlier in the show about the M&A deals that have been happening over the past month in video gaming, Microsoft and Activision Blizzard, of course, Take-Two and Zynga. And I'm wondering, how do you see AMD perhaps being impacted by this latest wave of consolidation and potentially growth in the future in video gaming?
So AMD is obviously a supplier of gaming from end to end. They have graphics cards for the biggest gamers that are $1,000 each, all the way down to their console gaming with Sony and Microsoft. I feel like both Sony and Microsoft are making huge investments in gaming and gaming content because they see it as an area of growth. And I believe as the interest in gaming increases, AMD will be able to piggyback on top of that increased demand, as long as they keep the sockets for Sony and Microsoft, and they're gonna rise with the tide as well.
Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst, joining us here to break down AMD earnings. We'll keep close tab on AMD shares here after the bell and in after hours trading. Thanks so much, Patrick. Appreciate it. And everyone, on the other side of this short break, we dive in on the brand of the green siren, which is in the red right now by about 4.7% after reporting their most recent quarterly results. We dive in on the other side.
Starbucks just reported quarterly results that missed estimates on the bottom line. Adjusted earnings per share for the fiscal first quarter came in at 72 cents. The estimate was for 80 cents, and net revenue of $8.05 billion was slightly ahead of expectations for $7.96 billion. Both of those estimates coming from Bloomberg compiled data. For more on these results, we have John Zolaitis, Quovatus Capital President, with us now. And John, Starbucks shares are down in after-hours trading. What do you think is the main takeaway that investors should be considering from this report?
From an investment standpoint, I think the margin performance was weaker than expected. I think there's also some weakness in the Chinese market. So we're going to be looking for some explanation on both those fronts.
You had a 3% decline in comp store sales attributable to the lapping prior year benefit in China, they mentioned, and some unfavorable foreign currency translation. All this considered, when you look across the different geographical regions that Starbucks has been trying to best as they can navigate, where do you expect or perhaps believe that they may see some of those continued headwinds?
Well, particularly in China with the zero COVID policy in place, it's unclear whether customer mobility will return to previous levels that will aid some of the stores that happen to be in transportation hubs, for example. And that's also true in some other markets as well. But primarily in the US and China, that's where the company operates its stores. The licensed stores in some of these other markets are less important from an investment standpoint to the results on both the near and intermediate term basis.
John, taking a look at Starbucks' earnings statement here, the company said that its bottom line results were impacted by greater than anticipated inflation and COVID-19 related pay and staffing costs. This is, of course, something that we've been tracking for companies across the service economy. But how long do you expect these pressures to be impacting Starbucks' margins?
So the COVID related costs in particular, I think we should expect those to roll off. And I think in general for the fourth quarter, what we've already heard from some companies, we'll hear for other companies, is staffing concerns, unable to get enough employees into the stores and therefore reduced hours, reduced service, and that's impacting both sales and costing the company more money. The bigger challenge, I think, the surprise rather from this reprint is really around the inflationary costs. And it's a little bit surprising that Starbucks wasn't able to estimate those accurately 3 months ago when it provided its original guidance for this year. So I think that's going to be among the major topics on the conference call when that starts at 5 o'clock.
John, attempting to marry two metrics together here, North America, U.S. comp store sales, they were up 18%. They're saying that it's primarily driven by a 12% increase in comp transactions, 6% increase in average ticket. At the same time, you had Starbucks Rewards loyalty program, 90-day active members in the U.S. That was up 21% year over year. The significance for us of those Rewards loyalty program members going forward from here, even at a time where they're navigating some of the international headwinds that we were discussing a moment ago, and some of the direct impacts of inflationary pressures as well.
So that's really the highlight of the report, is the strength of the US market, even taking into account that there was a easy comparison from the prior year when there was still some disruption related to COVID. The increase in transactions, and you called out the loyalty program signups, that's increasing at a rate much faster than the overall store growth. And so you could argue that the company is taking share, it's adding new customers, and that bodes very well for future revenue growth.
All right, we'll leave it there for now. John Zolaitis is Quovatus Capital President, and we thank you so much for that breakdown on Starbucks' latest results. The infrastructure bill signed into law late last year includes some new legislation with major implications for cryptocurrency investors and other market participants. It's now up to the Treasury Department to clarify who will be considered a crypto broker under this legislation and be subject to a sweeping set of disclosure requirements to the IRS. We'll have a discussion of this and more on the other side of this break.
Welcome back to Yahoo Finance Live, everyone. We're keeping close tabs on shares of PYPL, PayPal here. They're moving lower after hours by about 15%. It's on their earnings report that has just come out, and lighter guidance than expected here, particularly on the outlook for the upcoming quarter. The revenue is expected to decline by about 0.6%. And so with that in mind, they're also looking at revenue excluding eBay expected to grow, but that's about 14%. So excuse me here, revenue expected to grow about 6% on a spot and fixed income basis, and then revenue excluding eBay expected to grow about 14%. And so lighter than expected outlook. The most recent results for the quarter, we're continuing to keep an eye on the shares as the total payment volume that hit about $339.5 billion. That grew 23% over this most recent quarter. We'll keep a close eye on shares of PYPL, but down heavily here in after hours trading. Well, switching gears here, everyone, we want to get to our next guest as there is a lot of aggressive and accelerating talk on Capitol Hill, especially surrounding cryptocurrency. And for more, joining us now to help us break this down and get his perspective on what is to come, we've got Representative French Hill, Republican from Georgia, joining us today. Representative, thanks so much for taking the time here. First and foremost, in the way that the discussion and the dialogue has moved forward, what are you materially looking for to come out of those conversations as it pertains to regulation around cryptocurrency over this year?
Well, Brad, it's great to be with you. I'm from Arkansas, not Georgia, not to take anything away from their football prowess. It's great to be with you. Look, Republicans in the House Financial Services Committee want innovation in blockchain and cryptocurrencies and the development. We want that development in the United States, benefiting the U.S. GDP, U.S. innovators, and U.S. workers. And most recently, what we have now is an issue connected to the infrastructure bill that was passed and signed into law. It has a provision that's a very bad provision that, in my view, will inappropriately tax digital assets in a bad way and force a lot of that business offshore. So under leadership of Patrick McHenry of North Carolina, Tim Ryan of Ohio, we're proposing that Congress make sure that Treasury write the rules where we will not hurt the business of developing digital assets. And so what we're doing now is we're trying to get that correction through regulations issued by the Treasury.
Congressman, this is Emily here. Thank you so much for joining us. Who specifically do you want to see defined by the Treasury as a crypto broker, and who do you want excluded from that definition and those reporting requirements?
Yeah, well, let me give you sort of the philosophy. You know, a broker we typically think of as someone who's customer facing, someone who's engaged in the transaction. And yet the way the language was in the Senate bill that was drafted for the infrastructure measure, it really could sweep up software developers, miners, people involved in the blockchain far away from customer facing. So I think the philosophy would be is that Treasury narrows that definition to somebody that's actually a broker and therefore is customer facing. That would be the philosophical approach.
Representative, when you think about the committee assignments that you do have and on the Financial Services Committee, considering the amount of attention that cryptocurrency is getting right now and the cryptocurrency that gets traded on platforms like Robinhood, which prompted some of the retail Reddit trading frenzy, if you will, of 2021 and the discussions that ensued thereafter among your committee, particularly, following that frenzy, were there going to be or are there going to be any decisions to come on investor protections, whether in cryptocurrency or even in capital markets, stemming from the hearings and the falling action that took place?
Yeah, great question, Brad. We have a fintech task force of the House Financial Services Committee, fully bipartisan. I was the senior Republican on it in the last Congress. It's doing good work, exactly holding hearings on how to keep America competitive, how to protect customers, and how to educate the future of amendments we need to make either regulatorily or by law to facilitate a token digital economy on a blockchain. And it's been very educational. And so in this particular next year, I think you could see issues around the securities aspect of that on capital markets with Gary Gensler at the SEC. You could see the definition of a stable coin. What is that? How is it defined? how does it have to be issued, following up on a recent Janet Yellen Treasury report on that topic.
Congressman, I want to switch gears and ask about another piece of legislation recently introduced in the Senate. Now, I understand that you are in the House of Representatives, but I do want to ask, because Senator John Ossoff has introduced the Ban Congressional Stock Trading Act with Senator Mark Kelly that would require that lawmakers and their spouses and dependents place their stock portfolios in a blind trust while they're in office. What do you think about this kind of proposal?
Well, there are a number of proposals that relate to essentially stopping members of Congress from owning individual stocks. And I would remind all the listeners that the Congress in 2012 passed the Stock Act, which was signed into law by President Obama, which has rigorous reporting of any position that's held by a member of Congress, and reiterates that there is absolutely a ban on using any information that's derived from one's work in Congress, the House or Senate, or the executive branch for that matter, that could be considered insider trading. So that's fully illegal now. The penalties are quite strict, and the reporting is monthly of transactions. So I'm happy to look at proposals from the House and Senate that go deeper, but I would suggest the Stock Act is really working. A number of members have filed incorrectly or filed erroneously and have been disciplined for that. So one member has left Congress because of breaking the law. So we have that process now, but I'd be happy to look at what the House and Senate might consider in a further clarification on securities ownership.
Regardless of rigorous reporting mechanisms, should congressional members be allowed to hold names of companies in their portfolio who are directly impacted by their decisions on key decisions that they are privy to information and hold policy decision-making stances over how those companies may either be detrimentally impacted in one sense, or in the other sense, may be beneficiaries?
Well, you have full transparency, Brad, would be one way to look at it, which is you have a full position disclosed of everybody in the person's family, spouse, dependent children, of all those positions, all the net changes up or down during the course of the year reportedly. And you have the ability to investigate what a member is doing or not doing in their committee work, and are they in fact trading that stock. And so that's what I'm saying is I think it's transparent. I think the work in Congress seems to be transparent. And members own mutual funds, exchange traded funds, and individual stocks currently, individual bonds and bond funds currently. But that transparency, I don't believe, would let somebody get away with breaking the law and not leaving a major paper trail. That's essentially my point. So the presumption that it's unknown, or that they in some way have a advantage, I think a hidden advantage, I guess I would say, or that they're exempt from federal prosecution for insider trading. I don't believe that's an accurate description.
Representative French Hill, the Republican from Arkansas, joining us here today. We appreciate the time and the conversation. We'll have to check back in the future as well. And everyone on the other side of this short break, all of the eats coming up in this next segment, where we're testing out some new Baskin-Robbins ice cream. Stick around. You don't want to miss it. It's hitting just in time for Valentine's Day, too.
Welcome back. Baskin-Robbins is out with a new ice cream flavor just in time for Valentine's Day. Yahoo Finance's own Alexandra Canal is here with the reveal. And Allie, I have to say, this one sounds pretty tempting. I'm pretty jealous that you're getting to try it, but give us the details.
That's right, Emily. We have a brand new flavor in honor of the month of love. I'm wearing my pink shirt in celebration. And you know what? I'm pretty excited to try this. It's called Secret Admirer. It is the new flavor from Baskin-Robbins. It basically has pink cake flavored ice cream swirled with a rose ice cream. Yes, that's rose extract in this. And then also has some strawberry kind of swirled in there. So it looks very good. Smells like strawberry. Let's give it a whirl. Okay. This is pretty good. And I'm not even a big fan of strawberry. I'm more like a chocolate Oreo cookie kind of girl. But this is very good. It's only for a limited time. It's released for the month of February. And we really see a lot of big brands come out with different menu innovations this time of year. But I'm pretty impressed by this, not gonna lie. But maybe you're watching what you eat around Valentine's Day. Maybe you don't want the food. So if you don't want the food, but you just want to cuddle something, KFC has you covered with this giant chicken snuggler. I'm going to actually stand up so I can show you guys. This is a 3-foot long pillow. Okay. It costs almost $100, $99.99. So if you're single, if you're in a relationship, you just want something to snuggle, why not go with this bad boy? So, again, KFC always out with these wacky, innovative marketing schemes. Giant chicken sandwich that's not edible, or Baskin-Robbins ice cream.
Nothing says Valentine's Day like a fried chicken sandwich.
Exactly. Absolutely. Yahoo Finance's own Allie Canal, thank you so much for that taste test and that reveal of that giant pillow from KFC. I love it. Always coming out with something new, that company. But let's get one more final check of the markets before we say goodbye. All three major stock indexes in positive territory during today's session. The S&P 500 up about 0.8 of a percentage point. The Dow Jones Industrial Average and the Nasdaq also both higher. But that is going to do it for Brad Smith and me this afternoon. Yahoo Finance kicks back off again tomorrow at 9 a.m. Eastern. Tune back in then. But until then, have a great night.